All right, ladies and gentlemen, distinguished guests and esteemed speakers, welcome to the Moneycontrol Global Wealth Summit 2025 in Mumbai. The city's relentless energy makes it the perfect stage for gathering the brightest minds in markets, business and policy. We stand today at the cusp of extraordinary financial transformation. India's GDP has surged, our markets have deepened, and the retail investors have reshaped wealth creation. As we aim for a $10 trillion market cap, the opportunities and challenges are immense. Global capital is watching, and domestic investors are driving unprecedented flows. Amid dramatic global shifts, digital transformation and high volatility are at a moment of great change. The question then is, how do we ride this next wave? How do investors navigate volatility, harness mega trends, and how do businesses and policymakers ensure stability, growth, and wealth generation? So that's why we are here today, to learn how to surf the wealth wave with market stalwarts, global investment gurus, industry titans, and policy architects. But before we start the day, let's take a moment to extend our heartfelt gratitude to our partners. Presenting partner, IDFC First Bank, co-powered by PhonePe, and associate partners, World Gold Council, SBI Mutual Fund, and Reliance Industries. Their support and vision has made this day possible. Now, to kick off this incredible journey, please welcome Nalin Mehta, Managing Editor, Moneycontrol, to set the tone of the day.
Thanks very much, Sonal, and a very good morning, ladies and gentlemen. I'm delighted to welcome you all to the inaugural edition of the Global Wealth Summit. India's rising global heft, its unparalleled opportunities for wealth creation, and the deep complexities that define the sinews of Bharat are now critical for global wealth creation as never before, for global wealth creation, for growth, and the future of money, especially now when we are seeing such seismic shifts in the global economic order and a breakdown of old certitudes that were once taken for granted. Wealth creation in India matters, not just for Indians, but for the rest of the world. Just 10 years ago, we were the world's 10th largest economy. We are now the world's 5th largest, having doubled in size in the last 10 years, and on track to becoming the 3rd largest. Just 10 years ago, our equity market was the world's 10th largest. We are now the world's 5th largest by market cap, having quadrupled in size. Just 10 years ago, we were doing less than 100 IPOs in a year. Last year, India saw the highest IPOs in the world, 327, and the second highest IPO proceeds of any country globally, $19.2 billion. That's more than double of China last year. But more than the size, it's also the culture and nature of wealth creation itself in Bharat that is shifting at a breakneck speed. With 185 million demat accounts at last count, compared to just 22 million in 2014, India's change is being driven by a new generation of investors. Almost half of assets under management in mutual funds now are from cities outside of the big 5 cities of India. And about 1/5 of these assets are coming from outside of the top 30 Indian cities. So how do global investors negotiate these breathtaking shifts in Bharat? What are the opportunities and the challenges of the Indian markets? What about new asset classes such as REITs and older ones like gold? What's the long-term view on India and what should investors do? Above all, how do markets and investors navigate today's complex and volatile world where things change minute by minute, social post by social post, and tweet by tweet? At Moneycontrol, it is our daily business to track these questions. With 100 million unique users a month and over 1 million paying subscribers, we are India's largest digital financial news platform and among the top 15 digital news platforms in the world. So we are delighted today to bring together this fantastic collection of global investment leaders, fund managers, titans of industry, and thought leaders to deliberate on these issues. Later today, we will also have the new SEBI chief, Tuhin Kanta Pandey, making his first public comments since taking office. The Maharashtra Chief Minister, Devendra Fadnavis, will also be here to talk about his vision for growth and investments. We couldn't ask, ladies and gentlemen, for a more powerful set of movers and shakers to think through questions around wealth and growth in India. And I hope we find as many answers as there are questions. Thank you very much for making the time for coming to the Moneycontrol Global Wealth Summit. Let's have a great day. Thank you.
All right, thank you, Lalin, for that. It is now our privilege to introduce Howard Marks, co-chairman and co-founder of Oak Tree Capital Management, a legendary investor known for his contrarian thinking, deep insights in market cycles, and expertise in value investing. His famous memos are widely read by top investors, including Warren Buffett. Please welcome Howard Marks and Mahalakshmi Narayanaswamy of Moneycontrol for this conversation.
Thank you so much, Sonal, and thanks so much, Howard, for this incredible opportunity to talk to us. I won't waste even 10 seconds talking about anything else, straight diving into the questions. And I just picked up something you said in your latest memo, and I read this out. There were only 4 times in the history of S&P 500 when it returned 20% or more for 2 years in a row. In 3 of those 4 instances, the index declined in the subsequent 2-year period. The exception was 1995 to 98, when the powerful TMT bubble caused the decline to be delayed until 2000, but then the index lost almost 40% in the 3 years later. In the last 2 years, it's happened for the 5th time. The S&P 500 was 26% up in 2023 and 25% in 2024, marking the 2 best year stretch since 97-98. What is different this time, in your view? I know that you hate to do predictions, but probabilistically speaking, it looks like stocks will underperform bonds, inflation, and cash over the rest of the decade. What's your view?
Well, I think if you accept the past numbers, and it's dangerous not to, then you have to accept the fact that today's valuations imply modest returns over the coming decade. One investment bank said 3% a year in early November. Another said 5.5%. Certainly, the historic average return on the S&P has been 10, but we're at an above-average valuation. We invested will have below-average prospective returns. What's different this time, if anything, is the constitution of the S&P 500. We have the Magnificent Seven. It appears that some of them, or if not all, are some of the greatest companies we've ever seen. Better than the companies that led the S&P in the past. When I started work, reported for duty at First National City Bank in September of 1969, we were investing in the Nifty 50. And those were the magnificent companies of their day, selling at much higher PE than today. Some of them didn't last very long. And if you held those stocks for 5 years, you lost more than 90% of your money. These look like better companies to me, although I'm no expert. I'm not an equity person. I'm not a tech person. Selling at lower PE ratios. So, there's always an argument this time is different. Usually it's not different, but sometimes it is. This could be one of the times when it's different. But I think that it's hard to argue that the S&P is positioned for above average returns, and maybe not today even for average returns.
Fair enough. I was just about to come to that. Do you think the craze around AI today is reminiscent of the Nifty 50 era?
Well, it's reminiscent in the sense that the Nifty 50 era was based on the new thing. It was dry copying for Xerox, was computing power for IBM, super drugs for Merck and Lilly, instant photography for Polaroid, and so forth. And most excesses in the markets, I hesitate to use the word bubble, but I will, most bubbles are by necessity built around something new, something where there's no precedent, permitting the imagination to fire and confidence to reach escape velocity. In 1999, we had the internet, and people said the internet will change the world. Guess what? The internet did change the world. They were right. But they were wrong to value the companies as they did. They were wrong to assume the persistence of the companies that they did. And most of the companies that went public in the TMT bubble of 98, 99 are worthless today. So now we have another new thing, the AI. AI is expected to change the world. I'm no expert. I assume it will. Nobody knows how. Certainly nobody knows when or to what extent. I think it's going to have a profound impact. But again, assumptions are being made about persistence and leadership. I can't dispel them. I can't endorse them. I only say they require attention.
Fair enough. But is it some kind of a warning signal, you would say, for investors, because the Magnificent Seven have contributed to more than 40% of returns for 2023 as well as 2024?
Again, numbers that on their face are a yellow light at minimum. On the other hand, I think that the experts, and certainly the optimistic experts, would say wonderful companies at reasonable PE ratios. So the mere fact that they're up isn't troublesome if, in fact, they are indeed great companies at reasonable prices. Somebody else will have to tell me whether that's true today, and of course, we'll get the judgment of the market in the coming years.
Right. Moving on to interest rates, something you've said recently. Interest rates will not return to ultra-low levels, nor will they continue to decline. Why do you say that? High interest rates in the U.S., I also want to, just say that high interest rates in the U.S. have historically been correlated with low stock returns. What's your take?
First of all, I want to clarify. Today's interest rates are not high. Everybody says to me, oh, you mean, you're saying that rates will be higher for longer. Higher than they have been in recent years.
Right.
But not high in the absolute. I refer to a chart of the Fed funds rate for the last 70 years, most of which I've seen, and it averages just under 5%. Today's interest rate is below average on that basis, and I imagine will be brought down a bit in the coming years. But, we went through a period from the beginning of 2009, when the Fed took the Fed funds rate to zero to fight the global financial crisis, until the end of 2021, when the Fed gave up on inflation being transitory and concluded that it had to raise rates to fight inflation. Over that 13-year period, even I was surprised to learn when I studied it that the Fed funds rate was zero most of the time and averaged about 0.5%. So that's the abnormality.
Right.
That was abnormal. I merely think we're not going back to that abnormality. Today's rates are quite normal, and I see no reason why we shouldn't stay here.
It seems like the markets are very stuck up on, decline in interest rates as a trigger for stock prices to go up. Is that expectation sort of misplaced? You think this is a new normal, whether there are pulls and pressures on monetary front or fiscal front, these interest rates are okay for the U.S. economy to continue to fare the way they are?
I think that today's rates are within the band of normalcy. I think they can stay there. Our economy in the U.S. is functioning well. It's not booming, and thus it does not necessitate a bust. It's not sluggish. It's performing well. And I think that today's rates, or rates a little bit lower, will be perfectly appropriate for that. Our economy does not need stimulus by taking rates way down. It does not have to be restrained from overheating by taking rates way up. I think rates can stay here, and I think they're quite reasonable.
Sure. History doesn't repeat itself, but it often rhymes, said Mark Twain. What is history teaching us now?
Well, of course, today isn't history yet, and when today becomes history several years from now, we'll learn its lessons. The important message from that quote from Mark Twain, which I think is one of the most important quotations in my world, is that the details of history change. The events change, the reasons for them change, the results of them change, but certain things do persist and rhyme, if you will, from year to year and generation to generation. And most of those things, or I should say many of those things, are behavioral. And, people will always get overexcited when things go well and take asset prices too high. And then when things come off, they'll get too depressed and they'll take prices too low. These are the things that rhyme from cycle to cycle, and we have to be alert to them. When things are going well, people will lever up their enterprises in order to magnify the gains. And they'll do that because they underrate the probability of losses, and they forget about the potential of leverage to magnify losses instead of gains. But it works both ways. This is another lesson that repeats from generation to generation and usually has to be relearned from generation to generation because it's a lesson that's forgotten in good times. So I believe we'll always have cycles. Optimism will be taken to excess. Bad deals will be done when spirits are too positive, and those will be exposed in slower times through losses. Now, you asked what will we learn from today? Today, I think, as I say, the economy is performing well. The prices are generous, let's say high. In my memo of 2 months ago on Bubble Watch, I said lofty but not nutty, and I stick with that. I don't see massive psychological excesses today. And of course, the events of the last days and weeks have even reduced the enthusiasm further. But I think that, we know that the PE ratio on the S&P 500 is at an above average level, maybe warranted based on the excellence of the companies in it, or maybe not, but certainly not underpriced. And certainly not, in my opinion, a time for unusual aggressiveness.
Sure. This question may sound like it's a bit of an exaggeration, but probably it's not. Is value investing extinct? Buffett says that all investing is value investing, but if the essence of value investing is buying assets for less than what it is worth, we haven't seen anything close to that in Indian equities for the past 2 years, not in US, perhaps in China. What would you say?
It's a very complex subject. I can't do it justice, and if I try, you'll run out of patience with me. But I wrote a memo in January 21, and all the memos are available on the Oaktree Capital website under the heading of Insights. It was called Something of Value. It ensued from discussions I had with my son, Andrew, when
Right.
he and his family moved in with my wife and me during the pandemic. He's an investor. I'm an investor. We actively debated the question of value investing. Now, value investing, to me, means not thinking of investing as pieces of paper that you trade daily for profit, but thinking of an enterprise that you want to be an owner of and are willing to hold for the long term. And you know, if you're looking at a business and thinking about whether you want to buy a share of that business and hold it for the long term, you're probably going to want to make sure that the price is reasonable. And I think all of that makes sense. Now, all semantics eventually get taken to an extreme, and it morphed into value investing with a capital V. And what value investing with a capital V was taken to mean was disregard for the future, concentration on the present, insisting on discount valuation parameters. Andrew insists, I accepted his contention that doesn't have to be the definition of value. That's too extreme. It's too dichotomous, separated from growth. And people like to dichotomize and codify things very formalistically. But I think, you know, the way you're using it, let's say you're using it in a sense kind of in the middle. And, you know, the world tends to think that growth stocks are companies with high rates of growth projected into the future, and value stocks are companies with modest growth rates with an emphasis on the present. I think if you think about it that way, the lesson is that since, quote, growth investing is future-oriented, it is accepted more readily in optimistic times. And when people turn less optimistic and are less willing to credit the future with great events, then they become a little more cautious and they want value in the here and now. So they look at what are called value stocks. So I think if you look, for the most part, not precisely, but I think that growth investing, value described that way, rises when people are optimistic, and value does better when people are defensive or pessimistic. Well, the answer is that people haven't been defensive or pessimistic in a long time. You know, the last serious, prolonged negative incident we had was the global financial crisis, which started in 2008, so it's almost 17 years old. We had something called the pandemic in 2020. It was a very serious event. A lot of people lost their lives, but the markets and the economies kind of shrugged it off in short order. So it didn't really last, and it didn't have a profound effect. So I think that if you look, you would conclude that for the most part, optimism has prevailed for 17 years, or at least 16, or maybe 15, and that's a big part of why what you call growth, what most people call growth, has done so well. There will be a time for value, a time when people say, well, those stocks are being valued very highly because people say they have a bright future, but I'm worried about the future. And I think people will return. It's not growth of value. It's that these sorts of companies have dominated the calculation of the S&P 500 for years. And the trend towards passive and index investing has amplified the power of the S&P companies relative to the non-S&P. And I think that's been an important contributor to the success of, you know, there's an overlap, if you have a Venn diagram, an overlap between growth and S&P. They're not the same things definitionally, but there's a coincidence, and I think that indexation and passive investing have directed a lot of money towards, it happens, the growth aspects of the S&P. It's hard to know when it's going to stop, but you would think that if the S&P companies appreciate a lot longer and the other companies appreciate much less, you would think that eventually the S&P companies will become so rich that they can't keep outperforming. But my answer to that is the same as my answer to many things. We'll see.
Right. So there is also a contrary logic that some people argue. One argument in favor of high price multiples and strong equity valuations, especially in the US, is that industries are consolidating, and we're not talking about just new tech or AI, but even traditional industries, which is making companies significantly more efficient and profitable. Corporate profitability in America is at a historic high at 11.5%. Of course, real wages are at a historic low. That's a different matter altogether. Do you think this is good enough reason for equity valuations to sustain at elevated levels, despite higher interest rates?
I don't have an answer to your question, but what I'd like to do, I'd like to discuss the form of your question for the benefit of the audience. First of all, it's dangerous when you assess the appropriateness of the market pricing based on one factor at a time, because there are so many factors that matter. People tend to say, well, there's more concentration, there's more profitability, companies are better today, it merits a higher ratio. That's the line of argumentation. Well, I would say maybe. The question is, how much better are the companies? How much better do people assume they are? Are their assumptions correct? How much superiority is priced in to the prices today? Is that degree of superiority appropriate? So, better companies, higher multiples, easy to say, but hard to be sure that the increase in superiority and the increase in valuations are appropriate for each other.
Sure. Howard, how do you think Trump's policies are likely to reshape business and financial markets globally? For US particularly, do you think tariff-induced inflation, the cut in government jobs, poses a real threat to US demand and therefore economic growth? We've been talking about a recession for the past 3 years. It never happened. Growth has been fairly buoyant. What is your view on that? And secondly, what should global investors be watchful of?
Well, the overarching thing that everybody should keep in mind is that Donald Trump is a pro-business president. And, there's an old saying from my youth that what's good for General Motors is good for America. And, I would say in general, this is a vast overgeneralization, the Republicans would agree and the Democrats would disagree. And certainly today there's a whole element in the Democratic Party which thinks that business and free enterprise aren't such a great thing. Donald Trump thinks they are, and he will try very hard to make business do well and American business do especially well. But some of the actions can have short-term negative effects. For example, the tariffs, which he thinks will, discourage imports and encourage exports and produce revenues for the government to balance the budget. All of that seems like great things, but they should have an inflationary impact. That's just one example. I think his policies taken to their logical extreme, and we don't know how far they'll be taken, would end up in a lower level of globalization than we otherwise would have seen. Globalization, in my opinion, is a wonderful force. It raises boats all around the world. It lets everybody and every nation do the things they do best, and everybody in the world benefits from that degree of specialization and division of labor. If we globalize less, I think the whole pie shrinks. Of course, I think it's fair to say that Donald Trump is less concerned with the size of the whole pie than the size of America's slice of the pie. But, you know, when you introduce inflationary forces, which of course could necessitate higher interest rates to cool off the inflation, which would be bad for the economy. When you reduce the level of globalization, when you introduce high levels of uncertainty, I think those things together are tough on business collectively and tough on investors. So, you know, where Trump is going to go with his ideas, how he will implement them, and how good a job of the implementation he does, all those things remain to be seen. But ironically, you have a highly pro-business president who has introduced a lot of questions along the lines I just enumerated.
Sure. China. China has been waiting for a recovery for nearly 3 years now. It's not happened. To you, Oaktree, what is your view on China? And qualitatively speaking, how do you compare India vis-a-vis China?
Well, let me say up front that I'm not an expert on either. I travel, I visit India, and by the way, let me say, I think it's coincidentally ironic. Here I am in India today, but not with you in person. I'm in Hyderabad for the opening of Oaktree's Hyderabad office that we're all very excited about. Unfortunately, I can't be with you in Mumbai today. But I'm no expert on China. I'm no expert on India. I travel. I go on impressions. I read. You probably know more than I do. I only know what I read. Look, I think that China has great potential. It has great human resources, educational resources. It's very purposeful, and it is highly motivated to become the biggest economy in the world. It has problems of a declining population, low birth rate, and the high-functioning private sector operates alongside the state-owned enterprises, which generally, I think, don't do as well for the economy as the private sector. There's kind of an unusual, what might you say, a strange bedfellows there. But, you know, China has done very well for the last 30-plus years. If they settle on the right policies, it can continue to do well. But it has to make up its mind about whether it's going to be truly socialist or encourage the private sector. India, on the other hand, has a growing population, and coming off a low base, it has incredible opportunities. And of course, you have a very constructive government right now, which is trying to move this country ahead. My last visit here was exactly 8 years ago. I feel a different energy today, and India seems very positive. But of course, you have a large sector of this large and growing population that you have to move into the middle class. You have to educate with skills. You have to get jobs for. and you have to increase your capital base. Different challenges, but hard for me to say better or worse right now, especially because of the geopolitical overtones. Many people have described China as uninvestable. People want, I think people inherently want, the term the BRICS was coined 30 or 35 years ago, and I think everybody who's optimistic wants to have some money in some subset of the BRICS. I think India seems to be a great candidate for that right now, and in fact, of course, India has benefited from the fact that so many people see China in a less positive light today. I'm optimistic on India. Very glad to be here, both physically, myself, and with our office and with our lending activities. And I'd feel a lot worse if we were not participating in India as we are today.
Sure. For the benefit of our audience, what advice do you have for people out here to become second-order thinkers, second-level thinkers?
Well, the first piece of advice I have is that to be a superior investor, you have to achieve what I call second-level thinking, which is thinking different from the herd and better. Not easy. By the way, not everybody can be different from the herd and better. Most people will be in the herd and know better. Some people will be worse. So it's not easy to be different from the herd and better. And if you can't, then you shouldn't try any fancy shots. You should just settle for participating in the growing Indian miracle. And my own guess is that being an average participant in India in the coming decade will be a pretty good thing. To be an above-average participant, to have higher returns than the averages, you have to have a knowledge advantage. And it takes a lot of hard work and understanding of companies and markets to achieve that. If that's people's goal, if they want to be above average participants in these markets, they have to achieve that. They have to do the work. They have to achieve the understanding, the insight. I can't tell them how to do that. I can only tell them about the importance of doing it. And to be a second-level thinker, to be an above-average investor, you have to achieve a rare, higher level of insight and sophistication. And you have to understand that if you have the same data, you see things the same, have the same thought process, engage in the same actions, you'll be an average participant. Nothing wrong with that. But if you want to be above average, you have to excel in one or more of those elements, and it's hard. And my most fervent advice to our audience today is that if you aspire to be above average, go for it. Put in the work. Try to achieve that level of insight. But the more important thing is participate in this economy and in this market. I don't mean buy today. I mean, you don't want to, in my opinion, you don't want to miss out on the India of the next 10 years. And if you engage in market timing, in, out, buy, sell, you just might miss it, And some of the most important lessons are based in humility and an understanding of the limitations on what we can achieve. And an example of that is, one of my sayings is, if you wait long enough at a bus stop, you'll catch a bus. If you run from bus stop to bus stop to bus stop, you may never catch a bus. So, mere hyperactivity. Merely trying harder is not necessarily the route to success. A lower level activity combined with a higher level of thought might be the way to go.
Sure. One last question, Howard. Buffett talks about ovarian lottery. You know, a big part of his success was because he was born a white male in America at that time. Today, if you were to pick a country, US, China, India, or any other country, what would you think will qualify as ovarian lottery, number one?
Well, I don't know who's going to win the race among those three countries. The greatest luck is to be born at this time rather than 200 years ago, and to have access to education. And, you know, you can get a great education in all three countries. And I'm fortunate that as I travel in all three countries, I meet the students at the leading educational institutions. And they're the ones who are winning the lottery today. The great news is, I was born almost 80 years ago. Buffett was born almost 95 years ago. Our lottery victory was to be born a white male in America in the mid-20th century. Today, you don't have to have been born a white male in America. Just participate, just living in any of our three countries, if you can access the educational system and work hard, you can have success. It's not nearly as dependent on your gender, race, or location.
Thank you so much. On that note, Howard, that's all we have time for. But thank you so much for this opportunity. It's been a real privilege and honor. Thank you.
Well, thank you for your good questions.
All right. Thank you for that. Global investing is being reshaped in real time with Trumponomics, a mix of tariffs, tax, and America First policies redefining the capital allocation. Now, as manufacturing reshoring, trade alliance shifts, and deglobalization unfold, investors must adapt to a world where old playbooks no longer apply. So what does this mean for emerging markets like India? Will global liquidity favor Indian equities, or will protectionist policy shift capital elsewhere? Let me welcome back Mahalakshmi on stage for a conversation with our special guest. It's Mark Coombs, CEO of Ashmore Group, who has flown in this morning from London to give us his review. Please welcome on board with a warm round of applause.
First of all, thank you so much, Mark, for, again, this incredible opportunity. You've flown in especially for our event, and this is a premier platform, and this is our first time, and doubly happy to have you here. Before I dive into the questions, since the time you started Ashmore, has this been the toughest phase for emerging markets?
I think it depends on which market you are. Emerging markets
as a whole, I'm saying as a whole.
Yeah, emerging markets are not the same. They're different. They're different sizes, different aspects. I think it's harder for some than it was, and it's easier for some than it was. As a whole, there were more people attracted to emerging markets through the 2000s. They followed, if you like, the superior growth rates and the opportunities. Some of the conflict that's gone on since 2021, 22 has made people, certainly the Americans, think that they're a bit concerned about being outside America. So that's reduced the natural flow to emerging markets. But within emerging markets, I think growth is superior and there's a lot going on. And for our businesses, which are based on domestic markets, not just international flows, I think times are not too bad, actually.
Okay. So first things first, what is your view on Donald Trump's policies? There has been a lot of back and forth in terms of tariff. First he announced some tariffs, then it was deferred, then it is back on the table. What was talked about with respect to China, 60% tariff, we are nowhere close to that. Some of those fears seem to be receding. Some others are coming back to the table. What's your view?
Yeah, I think the problem with policy is that people like certainty. Investors like certainty and clarity. And so at the moment we've got a situation where nobody is quite sure what degree of tariff may or may not be charged on who and for what kind of sectors. So in terms of the idea of tariff, I mean, there was a world years ago when it was all tariff and no tax. The tariff was the tax. That's what happened in terms of the US, and that's a little bit how we believe Donald Trump is thinking. I think things need to settle down. We need to understand at what point tariffs are set to come into force and remain with a degree of permanency as opposed to a geopolitical negotiating tool. So I think we need a little bit of time to see how it all works out. I mean, there is no question that if you're trying to drop personal tax rates in the US and you're trying to reduce the deficit, there's a series of things you can do. And if you can find thoughtful ways to tariff certain trade flows in a relatively non-inflationary way, you can see why that's attractive to an incoming president. The devil is in the detail. Can you do that?
And what do you think will be the impact with respect to China and India? You know, there was this thought process that if there are high tariffs on China, then maybe India will benefit because a lot of sourcing can happen from India. But the counterpoint to that is if there are lots of overcapacities in China, that will sort of flood the rest of the markets, and India will actually not benefit from that.
Yeah, that's a really good question. I mean, you see that fear moving around with flow. If you think about not just domestic investors in India, but you think about global investors trying to pick the winner between India and China. I think it's going to depend on a few things. I think if you're the American president that currently sits there, you would regard China as your greatest competition. You may or may not be right in the long term, but clearly China plans to be the biggest economy in the world and has made no bones about it and plans to exercise that any way that it can over the long term. If you're not a Chinese investor, that makes it quite a difficult place to invest from time to time because you're not certain about policy. It is relatively opaque in the way that it operates. Yes, it's big. It has some big structural challenges at the minute, not least massive youth unemployment. And it's going through a difficult reset. Does it long-term do better than it is now? Almost certainly. Is it in the price? Some people would say yes. There's been a big shift out of Indian equity into Chinese equity, for example, having been the other way around for a couple of years. I think the way we think about it is, and I said this right at the start, you want to be in countries that are that you're relatively certain of what the policy is. Business will work it out. If we know what the rules are, and as long as there are rules and a rule of law to enforce them, we'll figure out how to invest and where to invest. So we can absorb a tariff here, a tax rate there, a particular incentive to stimulate tech in that place or not in the other place. But we require certainty. So for me, in terms of long-term structural investing, I want a place that has that and where capital can flow relatively freely. The challenge for non-Chinese investors now looking into China is, yes, the stock market may be relatively cheap and one can trade that, but to be a very long-term structural investor is quite difficult if you're not certain what the rules are going to be if you're not Chinese and if you're from overseas. So what I think you're seeing at the minute is the relative attractiveness of India. Geopolitically we can get into, but even economically, where there's certainty of policy and there's some structural reform going on here and the whole move to digitalization and bringing more people into the net, it's a very attractive place to invest if you were doing a straight one-to-one comparison, not just on scale, but on certainty and on terms of rules under which you can operate and invest for the long term. As investors, we can trade everything. That's all jolly good fun. But what really helps us is not day-to-day and second-to-second trading, but being able to commit capital for the really long term and then trade around the margins. But you want to be long and right and then trade around the margins. What you don't want to do is have to keep going, oh my goodness, they're going to shut the gates on capital flows, or they're going to start saying they don't want foreign companies, or they're going to start saying healthcare should no longer be a private sector business. These are things not happening in India, but they are the risk in China. So for me, structurally, India is more attractive long term. China's, of course, massive and will be the biggest global economy. How you play that is much trickier without certainty.
Okay, this is also a thought actually a lot of other investors echo, and I often find this, most foreign investors, at least we speak to, seem to be saying that we are good to invest in China as a tactical opportunity. There might be a bounce and we'd want to capture that, but because we've burnt our fingers over the last 10 years, the Chinese markets have gone nowhere, paltry returns and equities, so big money is not going back to China. So are we just extrapolating? Are we prisoners of, a long period of outperformance? Are we underestimating China's ability to come back and score in the next decade? Will that be a mistake?
I think there's a lot in that question. We've been investing for a really long time, and we've been investing in China for a really long time, and India, and in different ways and at different times. And you've always have the issue in China, and at some points you're concerned about having that in India or in anywhere, in the UK. Is it a level playing field with the state? Am I going to be competing with the public sector, and am I going to be able to play in the right way? And for a long period of time in China, you were always concerned, was subsidy going to SOEs? Was there a problem with SOEs? You invested private capital for the long run. Could you make a good return on it because you were going to get structurally beaten by the domestic investor or the domestic party? So that was a big concern for us in terms of China. I think that concern still exists. I think what is going to happen, though, the sheer numbers of people, the sheer scale of the market, means that the market will over time grow. Yes, it'll have its moments where you have a population trend that isn't so fabulous at the minute. They'll fix that. Whether it's 25 years away or not, that is going to get fixed. It's big. There's lots of people. There's going to be lots of consumption. So I don't think you can afford to ignore it. It is true that one has to take, I would say, a much more tactical view of China today, and you can, because the markets are liquid enough, than you might have done 20 years ago when you said, I've just got to be in China. I mean, there are people that are doing just fine, foreign investors in China. There are sides of the financial sector that are growing. It's just, it's more tempting to be tactical.
Sure. You talked about Indian markets and some of the allure, but somehow over the last 6 months, we've seen such accelerated pace of foreign selling. It just seems to be unrelenting. Nearly $26 billion has moved out of Indian equities alone in the last 6 months. Now, we have a long structural story, there is certainty with respect to policy, then why this level of exodus?
Yeah, because everybody's not a structural investor. Unfortunately, or fortunately, depending on how you want to look at it, India is regarded as up there as one of the most significant economies in the world in the future over the next 10, 20, 25 years. And it is a natural choice for big global investors to look for bigger markets to invest in. If we just leave the domestic side, the domestic investors out for the minute. So what happens is when people get excited, they look for a big market to play in. And if you think about it, what you're seeing now, the last 5 or 6 months of foreign capital disappearing from India, the equity market in particular, the daily traded equity market where they can change their minds, was really about two things. It was about, had India run too far? And based on very long-term numbers, you could say that the level of PE, et cetera, was high in terms of a 25, 30-year period where it should have been, particularly in the small and mid-cap space. But it was also people going, well, hang on a minute, I'm an emerging market investor with a global fund. It's about relative value. And China had been slammed for so long. And the big way we've outperformed in equities over the last 4 years, to be honest, was massively overweight India 3 or 4 years ago and underweight China. And a lot of global investors have switched that trade. They've said China is so cheap, The monetary policy bazooka in China was fired in September. They are getting serious about the fiscal. Eventually, you will get some level of growth coming back. If the state is underpinning property asset values by sucking them up from the private sector, you're hitting a floor. And once you do that, the chance of the natural demographic growth, which hasn't been great, comes back. China is just a whole hell of a lot cheaper, and India got so expensive in relative terms globally, not just against China. So there has been a lot of switching out of India into China. Not a lot of which is not permanent capital.
Okay. Now, a lot of money that has come into India, at least in terms of fund flows, I'm saying in terms of fund collections, has come through India dedicated funds, not through the emerging market funds, post-COVID at least. Now, do you see any time in future, now of course we are underway a fairly serious correction, at least if you just look at the post-COVID period, this is the first time we are seeing a more than 10-15% correction in the market. Do you see India becoming an asset class by itself? How far are we from that point?
Yeah, I do. I think that will definitely happen. All markets
By when?
A week on Friday. I'll be here Thursday. I'll take the hat around, give me the money, we'll invest it, you'll do great. Which is a basic rule, of course.
No, on a serious note, like 3 years, 5 years, what would be your bet?
Well, I think it depends on your perspective. I mean, and a lot will depend on what happens geopolitically. And it's been very interesting seeing the evolution since 20 of how some of the larger institutional investors invest globally. It used to be when we went and spoke to the biggest investors, be they pension funds, be they sovereign wealth funds, they said, oh yeah, EM, I should buy that, here's some money. Or maybe I won't give you the money, I'll give it to some other idiot, but here's the money. They didn't really get into the nitty-gritty of what they were buying, and they just, we'll leave it to you to pick China over India, over Russia, over Brazil. And that was one of the biggest frustrations for my colleagues as we built local businesses, where our longer-term bet was two things would happen. The domestic markets would get much bigger, and that would drive the machine, but also global investors would start to say, I need to pick the winners. But while you had it's ironic that while you had all the benefits of globalization, you had a bit of a blurring at the edges of the foreign investor picking who to win. So yes, structurally investing in terms of manufacturing happens country by country, but the financial pool of capital tended to be just buy EM. So we spent 20 years trying to say to people, yeah, but there's a time you might want to buy Mexico and not Brazil, and a long time trying to persuade people to do that. The geopolitical stress of the last 3 or 4 years, ironically, has started some of the biggest investors thinking, wait a minute, I've got American pension funds are now asking us to pitch to manage money ex-China. We want EM ex-China. And as soon as they start thinking that way, that means that they start thinking, well, hang on, if I don't want China, maybe I do want something. And what we've seen over the last 18 months is we're having increasing conversations. We have an Indian team who are very good at what they do, and they're being asked to go and speak to the Americans, the Europeans, and those in Asia, talk about India-only money. And when people start thinking about India-only fund investing and India-only separate account investing, that immediately tells you you're getting to the point where you're a market of your own. Is it a black and white switch on, switch off? No. But is it happening over the next 5 to 10 years? Yeah, I think any serious global investor will have to have money in India, more or less, from 5 years' time, maybe from today. I mean, we do.
Right. Now, Indian markets have been actually the worst performer this year. Amongst emerging markets, I think it's the third worst. There was only, I think, Indonesia and Taiwan, which have lost about 11%. We've lost about 8%. Now, in one way, it is good because valuations become cheaper. A lot of the foreign investors who are probably waiting on the sidelines might want to get in. But how do you think realistically foreign investors look at this when you see this level of volatility?
How do I think they look at value here?
Yeah.
I think.
How do you view the volatility in India at this point in time?
Yeah, I think if I look at my fund managers who manage global books, it's quite interesting. You see a lot of investor psychology through the people you work with. I think they've all been looking for a moment to buy the market. I think they felt it's expensive, and they thought it was very expensive, and then they thought China was cheap, and so they reduced their massive overweight to India, and they started to buy China. At the same time, the institutions I mentioned before that are starting to look at single countries and trying to pick winners that have already started to pick India are saying, yes, it's all too expensive, but yes, I'm in here. And if my allocation is this, it goes up and down around the margin, but structurally I'm committed, even in liquid product. They're all looking at a chance to buy. I think they're saying, well, we're getting questions from the US through Europe, through Asia. Is it time to buy India now?
Right. I asked this question to Howard Marks also, and I'm going to ask this question again to you. What is your sense of what are the chances that the U.S. economy will actually slip into recession this year? Because government job cuts, potential inflation coming back, all of these look like not very happy things.
I think there's definitely a reasonable chance. Recession, obviously, depending on, let's say you define it as 2 negative quarters of growth, which is a traditional definition. That would be a lot. I think it's going to depend. This is what I talked about earlier about policy. If you have too much policy uncertainty, the first thing investors do is get out or do nothing or sit in cash. And there are a lot of investors in the US already sitting in cash, and there are a lot of foreign investors who say, I've got way too much US dollar. What on earth do I buy? Where do I go from here? And the longer policy uncertainty continues and people aren't sure of the direction, I think the chances are that the consumer in the US listens, hears, and feels that, and then whether they're losing their job or not, they find the guy down the road lost their job, and they just do less. So the things to really look for are activity levels in terms of consumer construction and all that kind of stuff. You know, employment is really a lagging indicator for all of that. It's really what do you see in terms of the front end, in terms of what purchasing managers are thinking. All that kind of inflation, again, is a lag. It'll follow all of that. So I think there is a chance that there's already, the conversations we're having in the US at the minute, there's definitely, if you're talking to people in the Midwest, it's, well, I'm just going to wait and see what I do for now. And yeah, I had cash, and I was going to buy long bonds now because I thought duration rates were going to keep coming down. Maybe I'll just wait for the minute. So I think what you're getting is a little bit of a pause into, you had the election, this is a pro-business president, everything's going to be fabulous, markets went crazy, everybody bought AI, isn't that fabulous, the world's over-changing, and now people go, oh, wait a second. And at the same time, you've got the suspicion that, like every other technology advance, the second level advance is to reduce the cost of it dramatically. So as the first producer, you make a lot of money initially, but then you have massive competition. Doesn't stop the adoption, it still becomes a widespread thing, but it gets steadily less profitable for the manufacturer. So where do I see that in terms of the US? Do I see recession? Probably not. But I think what we will probably not get is a lot more rate cuts, despite the fact there'll be massive political pressure. Because if you're the central bank, if you're the Fed, you should be taking a longer term view. And although the president might try and lean on you, this Fed president, he's got 18 months to go. He's going to try and do the right thing. So I think you're probably it's going to be a little bit wait and see. You might get one other cut. But then the real question is, do you get rate increases? And it's totally going to depend on inflation. But what I do think is the Fed will take a wait and see between 2 and 3% inflation. If inflation doesn't pop through 3% and get going, I think they're going to do nothing. And if it doesn't pop through 3%, I think they'll resist some kind of recession. And also, we just don't know how inflation these tariffs are going to be. There are tariffs that are not that inflationary. There are tariffs that will impact some countries, not others. You know, services tariffs are not there at the minute, which is a good thing for India. Services are a big deal for India, and tariffs are not there, which means the relative cost still stays pretty cheap. Also, India's producing some things that are pretty hard to tariff equal to start producing them in America. So there'll be winners and losers of the tariff stories. But so I think recession is possible. I think it's not likely in the next 3 months. I think interest rates will sit in quite a narrow band.
Okay. What is your sense on fund flows into emerging markets? Do you see a huge reversal this year, or is that wishful thinking?
Well, what we saw from 22 was American capital panicking and hiding behind the sofa, so exiting pretty rapidly. So we saw a lot of negative flow, through 23, 24. That's slowed down quite dramatically. We're now seeing, as I say, people starting to say, is it time for me to buy emerging market equity and fixed income? Let me think about value. What supported that a little bit, which I think has slowed the flow down, is people just are so long the US. I mean, if they had a US equity position, shut their eyes, it went up 20% for a while. What's also supporting it a bit, I think, is they're seeing absolute performance is pretty good within EM equity and EM fixed income. I mean, EM fixed income was the best performing bond market the last 3 and 5 years, despite outflow. So I think we're seeing investors sort of take stock. If I look at our client base, our best clients have been with us a really long time, and they have a strategic allocation, and they bring it up and they bring it down. So they're nervous. They brought it all down tactically through 23, 24. So they're still in the game, but they're much smaller, and they're open to be reallocating to us. That's true in equity and in bonds. And if anything, the US is very much an equity market, so they prefer equities. So the first thing that will be a flavor of return from the US will be people buying equities. We're seeing a tiny, tiny bit of interest in the mutual fund space, particularly in things that are seen as friends, looking for single country product or for product where it's friendshoring type story, not something that's seen as a competitor to the US.
Will it be necessary for Fed rates to come down for, a reverse flows to start to happen?
No, I don't think so. I think the key thing is positive
It's just that
spread.
it's perception.
I think it's a perception. I think what, again, like most things in life, when people feel there's some kind of floor or some kind of range that's established, then people start looking for the next place to go.
Incrementally.
Yeah, I mean, when everything's in one direction, people just tend to jump on the bus. But once things have settled down, people start looking backwards at numbers and start trying to look forwards. So I think we're in a position where we get a little bit of stability in terms of US policy, and people say, figure out, is geopolitics going to literally blow me up? If it isn't, then I can start investing properly. And as I say, in terms of flow, we saw big outflow in 23, less so in 24, less so now.
Sure. One last question. What's your take on the dollar and gold? Gold for a large part was seen as a hedge for the dollar, but both of them have been pretty much moving in tandem.
What was the first thing? Gold and?
Dollar and gold.
Oh, the dollar and gold. Yeah. Well, gold is obviously a particular asset class that people here are very expert in. I'm not. So I think I don't really have a strong view in terms of dollar and gold, to be honest with you. I think the dollar is expensive. I think the dollar needs to weaken. I think rate cuts are unlikely to be the driver for weakness from here. I don't think we're going to see massive rate rises, but just in terms of absolute flows, I mean, the US is now a massive, massive debtor to the rest of the world. I talk to our clients in Asia and Europe, and they said, we can't buy any more dollar assets, we can't buy equities. So I think that's quite interesting. It's an EM positive story, but I think it's also, ironically, I think we're going to have a euro positive story. The euro is going to have to use interest rates to support issuing a lot more debt to rearm. So I think actually, ironically, euro, which has been a bit, oh dear, what's happening with growth, I think the currency might see some support over the next year or so. I think EM will be part of the beneficiary of that. A lot of EM countries in that euro ambit.
Okay. Mark, just one last question. What is Ashmore's, how large are you in India? How bullish are you in India? And how do you look at India right now as a tactical market, or is this, do you exit at all? How is that portion managed?
Well, India is one of the economies that we've decided we want to be a long-term investor in. What does that mean? Ashmore invests in bonds, equities, and private capital. We do private debt, private equity. We're trying to be in any asset class where we think we can be good, and in a place where we can be good at it. That depends on people, and depends on the demographic being good for the economy. You want the bigger economies generally, and rule of law. So all those things, India ticks the box for us. We've been investing here for donkey's years, longer than we care to remember. It's one of the economies that we decided we wanted a local business. So we didn't just want to bring in global capital, which can flip from India to China and vice versa. We said to ourselves, wait a minute, India is an economy which, given the growth dynamic, we ought to be able to build a domestic business where we're appealing to domestic institutions and domestic retail investors to say, hey, we can manage your Indian money for you better than you can. We believe we found a group of financial professionals. I think we've got a great team here that can basically do a better job than the market and do it consistently over time. So for us, India is a place where not only do we like to invest bonds, equities, and alternatives from offshore, we also want to do that from onshore. So we're building a domestic business, we're building a domestic asset management business, and I see India as one of the 5 or 6 economies where Ashmore will have a big Ashmore domestic business, unrelated to the global business, loving it, kissing it, feeding off it, sharing flows with it. But I think it's a place where we're going to build a big domestic asset management business. That's one of our targets.
Sure. That's all we have time for, Mark. It was absolutely incredible talking to you. Thank you so much.
Great. Thanks for your time. Thanks for listening to me. Thank you, everybody.
All right, thank you, Mark. Thank you, Mahalakshmi. Now, while discussing India's road to a $10 trillion market, the foundation of its journey lies in how businesses are scaling and growing. Let's hear now from a finance expert on how financial planning, credit solutions, and microfinance can further be enhanced using AI and digital transformation and its role in India's growth landscape. Please join me in welcoming on stage V. Vaidyanathan, MD and CEO of IDFC First Bank, to take the stage.
Good morning, ladies and gentlemen. It really is a pleasure for us at IDFC First Bank to be at this very fantastic gathering, and we heard some wonderful speakers thus far. And Mahalakshmi and everybody who triggered such a wonderful debate, thank you very much for bringing those perspectives to all of us. Today, the key thing that I wanted to actually share with you is basically some key numbers about how the Indian credit market is growing, AIF, PMS, wealth management, and how all those numbers are coming together to position India, let me say, for the next 10 years. If you think currently there is some talk in the country at this point of time, is consumption demand slowing, is two-wheeler sales slowing, is FMCG sales slowing down, is rural consumption coming down, rural people are still saying good things, but urban consumption people are saying, is there a little concern there? And people say, is private capex slowing down? So these are some concerns people have. But, you know, it will really be useful to know that in the last 10 years, while these may be issues at this point of time, partially, but there are also so many things going India's way, which we should put it in context. Now, when you see India's growth over the last, evolution over the last 10 years, there has been just so many significant events that have happened. In the early stage of 2010 to 2014, there was rising interest rates, and you know, the inflation was rising, GDP growth was slowing down. Then 2016, there was demonetization, which is a really big event because it sucked out 85% of the current country's cash, and you were looking to replace it with a new currency. Then you actually saw that there was a period of a twin balance sheet crisis, when the Indian lenders were short of capital and Indian large corporates were debted, and therefore both sides there was an issue. Then there was the 2018 ILFS crisis. Then there was COVID that came in 2020, going on up to 2022. Right now, you know, we're talking of the Trump tariff. So the last 10 years, literally year after year after year, there's been something in the country that's been going on. But let me just share with you how the numbers have played out during the last 10 years, despite these crises that have been coming along. So this is how the Indian credit market during the last 10 years has grown. It has now grown from, say, 125 lakh crores to 324 lakh crores. So this is the GDP. India's GDP has come along. That's like touching about $3.8 trillion. And then you see the Indian credit market has moved from 64 lakh crores going up to 183 lakh crores. That's like about $2 trillion for easy conversion. And that's a 2.8x in all the crises we talked about. Then let me share with you how the agricultural credit in the country has been growing in the same window, has been growing from about 8 lakh crores to about 23 lakh crores. That's 3x growth in the last 10 years. You can see how the deposits have been growing in the country. Deposits have grown 2.6x in the last 10 years, from 85 lakh crores to 228 lakh crores. That's like about $2.5 trillion. Then you see how the savings balance has been growing, like 28 lakh crores, going by 2.4x to 67 lakh crores. You've got the term deposits, that's grown from 49 lakh crores to 140 lakh crores. So you can see, and 140 lakh crores, I'd imagine be like close to about, maybe about, let me say about maybe 1.7 or 1.8 trillion dollars. And then you've got the equities market has moved to about 384 lakh crores, which is the market cap. The mutual funds in the country has grown 6x, from 11 lakh crores to about 67 lakh crores. you've got to see how the AIFs in the country has moved from about maybe less than 1 lakh crores, 70,000 crores to about 12.4 lakh crores. That's a big growth. Let me call that about maybe $150 billion or so. And then you've got the PMS market has grown about 5.5x. Of course, it started from a early stage fledgling situation to about 11 lakh crores. That's about about $140 billion. You've got the Provident Fund market has grown from 6 lakh crores to 27 lakh crores. That's grown 4.5x. So these are the areas when you see this in the light of the context of the fact that India has had all these issues, global, domestic, inflation, COVID, etc. In the light of all this, broadly give or take, things have been multiplying by about 2.5x to 3x in the last 10 years. You can see from the numbers. And in the markets like your AIF, PMS, etc., it's also growth markets. You can see the numbers for growth about 6-7 times, mutual funds 6 times. So these are the really big numbers. So when you look ahead and you hear some of the news flow, you should be aware that regulator is watching, government is watching. They will push some fiscal button, they will push some monetary button, they will do some reforms, and India is capable of pulling off really amazing reforms. We saw it in the case of how GST was implemented in the country, and ease of doing business is going on. Income tax norms are being refined. So India is moving on, maybe ease of doing business and many other reforms. And even if you see some temporary slowdown, people will push the levers and pull up the numbers. Now, when we look at this sort of a growth in the country across all asset classes, we need to now next think about who is availing of this big growth of this Indian market. Now, if you think of wealth management as a proposition, you can see that wealth management as a proposition is normally afforded to people having balances of, let me say, maybe 20 lakh, 30 lakh, 50 lakh, and so on and so forth, because these are largely supported by humans. What is the issue with this growth? I talked about how things have grown between 2.5 to 3x in the last 10 years. Now, how do we expand this market for the normal people is going to be a very key issue to address in the times to come. Wealth management and multiplying the value of wealth, and because of all the reforms India is doing, is, of course, great for people who have the wealth, but people who are, let me say, just off their radar and having maybe even earning, say, 1 or 2 lakhs per month, saving maybe 20,000, 30,000 a month, even for them, that is wealth in their life. In fact, for them, to create that wealth and to multiply that amount of 20, 30, 50,000 or so is super important. For the rich, wealth is exciting. But for the not so rich, let me call the middle class, for them, growth of wealth is an absolute imperative. Now, we can't afford it through relationship managers. We all know that because relationship managers are expensive. So there comes the whole concept of how India's digitization and digital ecosystem is going to enable this wealth creation, let me say, at the middle class, lower middle class, upper middle class, in this sort of ecosystem. So at IDFC First Bank, frankly, we are looking at this all the time. When we are talking of lending, of course, all the big banks, everybody gives home loans at maybe 8.5, 8.6%. But what about the Kirana store? And what about the farmer who wants to buy a home? So figuring out how to take mortgages to them. Similarly, how to take deposits to them. Now, in today's context, how to take wealth management to them. We also agree cannot be done by human beings. So I want to show you a quick demo to you about how we brought this together, or how we are bringing this together for the common people, so to say. Now, this is a mutual funds. Now, I talked to you that India's mutual fund industry grew from, say, about 12 lakh crores to 70 lakh crores in the last 10 years. If all goes well and reforms goes well, and reforms and India's entrepreneurship and growth, all of these create wealth. digitization of the new digital ecosystem in India can take wealth to the, can make wealth management more accessible to the 300, 500 million people of the country for whom it is equally important, like I said before. So I wanted to share with you that how do you make this enabled? So I want to just, if you say, we are trying to make something called wealth management for all. So one of the things here is, say, invest in mutual funds. Now, invest in mutual funds, we are putting together a platform for public at large to say how you can do your own research. You do not have to follow IDFC First Bank's research about you buy this mutual fund or that. We provide you a platform. Say, for example, we say, okay, you can invest in equity. Within equity, supposing this is the fund that we've been talked about, in this fund, you're able to see what is the 1-year return on this fund, what is the 3-year return on this fund, what is the 5-year return on the fund. This platform is available for you to do your own research. You can live see what is the 3-year performance, 5-year performance of this fund. You come down from there and say, okay, what are the companies this particular fund may have invested in, and you can what are the companies being holding pattern. So you can see the companies that are there inside this fund and what the fund is holding live. You can see the companies held by that particular fund. And then you say, okay, I want to invest in this mutual fund. You can say, I want to select this for one time. And then you can say that I want to say invest ₹1 lakh rupees. And then you say, I want to here to invest. And then you say, this is the OTP. And then you verify. And as we speak, this investment is done. Now think, to make the funds available on platform, you can sort them, select the best, or you can accept a research that is maybe done by IDFC First Bank in this example, and make an online investing. This is super important for the common people. And one of the agenda of this should also be how to make wealth management accessible for all, because it's important for everybody. Now let me give you an example of, again, people at this pyramid who typically would like to have let me say retirement planning. One of the issues that we find in India is that most normal people, certainly middle class, upper middle class, they live their life by the day, and suddenly they are in their 50s or 60s or 50s, and they figure out, oh, there's not much money left in the kitty, so there's need for financial planning. So we put together something for our customers here, where we say that you can do financial planning, and you can do goal-based investing, and then you can come here. You can say you want to plan your retirement. In the retirement, supposing someone says, I want to say have 5 crore rupees at retirement and say 2050, our system will instantly tell you through a tool that you really need 28 crores then, assuming inflation of 7% during this period, to actually have the value of 5 crores today, which is not a calculation customers normally have. And then we say, okay, what do you do with this money? So you say, get me investment options. In that, again, it's a choice customers are making. And then you say, okay, I confirm this plan. And then on 10th of every month, the bank will debit a bank account and move it in the fund chosen by you. Here is an OTP. Here you verify. And then your plan for that amount starts. Similarly, you can plan for retirement, home, car, etc. So the point is that and if you want to say invest in a fixed deposit or so on and so forth, the point, therefore, just to sum it up, is that if you saw the numbers of the last 10 years, I showed you everything is up 2.5 to 3x, whether it is gold or whether it is deposits or credit or any of them. In the next 10 years, with the amount of reforms India is doing, with the amount of investment infrastructure India is doing, with the amount of ease of business, doing business focus, with the focus on digitization, with the creation of this entire ecosystem, one thing is certain, that the Indian ecosystem is set for creating more wealth in the next 10 years, maybe by an order of magnitude between, let me call it 2.5 to 3x, if you were to go by the nominal GDP and you were to multiply it and compound it by maybe 11 or 12% for 10 years. Through these, we will be in a position to take this to let me say, middle class or even bottom of the pyramid, for whom even 10, 20,000 rupees is wealth. And we should realize that what is wealth for us, maybe 20, 30, 50 lakhs, is for the common people, even 10,000 rupees is wealth for that person. And our ability to take it there is going to really define the more inclusive wealth creation and using digitization to make wealth management accessible for all. So this is all I have to share with all of you. Thank you, ladies and gentlemen. And hopefully these numbers are going to help us in the course of the discussion. Thank you.
Well, thank you for that, Mr. Vaidyanathan. Let's move on now. And for the next session and for our next guest, let me invite back on stage Nalin Mehta from Moneycontrol.
Thanks very much, Sonal. Ladies and gentlemen, it is my great honor and pleasure to welcome to the Moneycontrol Global Wealth Summit the Chairman of the Securities and Exchange Board of India, Mr. Tuhin Kanta Pandey. It's just been a week since Mr. Pandey has taken office as the 11th Chairman of SEBI. And we are deeply honored, sir, that the Moneycontrol Global Wealth Summit is the first major event that you are gracing since taking charge of the markets regulator. Mr. Pandey has a distinguished record as a public servant, most recently as Union Finance Secretary in the central government. He's a 1987 batch IS officer from the Odisha cadre. Mr. Pandey has also served as the Secretary in the Department of Disinvestment and Public Asset Management in the Ministry of Finance, as Union Civil Aviation Secretary, and he's also held key positions in the Odisha government. Mr. Pandey has a Master's in Economics from the Punjab University and an MBA from the University of Birmingham. Ladies and gentlemen, I'm sure you're all very keen to listen to Mr. Pandey. So without further ado, please join me in giving a big hand to the man who now heads India's capital markets regulator, Tuhin Kanta Pandey, the chairman of SEBI, for his keynote speech on India's growth story.
Good morning, ladies and gentlemen. I am delighted to be here today amongst this august gathering to share my views in this Global Wealth Summit organized by Moneycontrol and CNBC. Our aspiration for a Viksit Bharat, a developed India by the year 2047, inspires us to march forward resolutely, propelled by 3 Ds: democracy, demography, and demand. India has exhibited resilience as well as strong growth momentum over the years as we face global headwinds in terms of geo-economic fragmentation, tariff issues, and elevated uncertainties. We need to build upon our resilience and strength to sustain our growth. A high level of sustained growth, low current account deficit, low external public debt, healthy bank balance sheets, fiscal consolidation roadmap, continuing government push on government capex and infrastructure, and forex reserve buffer are some key pillars of support for India's resilience against exogenous shocks. As per IMF estimates, overall economic growth in emerging markets and developing economies is projected at 4.2% in 2025, while India is estimated to grow at 6.5% in FY 24-25, indicating a strong growth outlook for the country among the peers. Indeed, many forecasts envisage that India will have a sustained growth of 6.5% over at least till the end of the decade, although we would like to accelerate it much faster in order to achieve the Viksit Bharat goal. In her budget speech on 1st of February 2025, Honorable Finance Minister has outlined government's vision, strategy and action plan, focusing on 4 engines: agriculture, MSME, investment and exports. She also underlined major reforms in 6 domains: taxation, power sector, urban development, mining, financial sector, and regulatory reforms. Let me just now come to the role of the security markets in economic growth, we are all aware over the years, Indian securities market has played a crucial role in channelizing savings into the productive investments, thereby fueling economic growth. Indeed, raising the savings and investment ratio has been one of the very important goals in the economic planning that we have. It's always provided a platform for businesses to raise capital efficiently through equity and debt markets, reducing pressure on traditional banking channels. And it has facilitated corporate expansion, promoted entrepreneurship, and contributed to overall economic development in the country. And let's see some data points. As of March 2020, there were 49 million unique investors in the SEBI ecosystem, which is now 136 million. Investors in mutual funds have risen 2.4 times in 5 years to 53 million from 22 million. Inflows into risk-oriented mutual funds during current year, which is April-March, till January, are of the order of 5.3 trillion rupees. Over the last 10 years, Indian companies have raised, on an average, 2.2 trillion rupees per year through equity issuance in the securities market. The current fiscal year so far, April-Jan, has seen a record equity issuance of 4 trillion rupees, twice the capital raising of 2 trillion rupees witnessed in the entire previous year, FY 23-24. These are some of the key points. I think there are many. This access to funding through the capital market drives expansion, enhances productivity, fosters innovation, all of which contributed to economic growth. We need long-term capital through both equity and debt issuances as a source of stable funding, fostering sustainable economic growth. And new products like REITs, InvITs, and municipal bonds have huge potential to boost infrastructure development in the country. These products not only provide a diversified source of funding, but also reduce reliance on traditional sources of capital. Let me just come to some of the roles that SEBI is playing. Of course, in case of regulations, SEBI has provided the regulatory structure for REITs, InvITs, and municipal bonds, some of the new innovations. Over the years, SEBI has taken measures to promote developments of securities market, which is actually as one of our mandates. Reduce risk in the system through effective regulation and protect the interest of the investors, and underline protecting the interest of the investors. Broadly, the reforms are aimed at enhancing efficiency, transparency, and robustness of the security markets, and we have used technology in a big way. Entire marketing infrastructure, securities market infrastructure, we have been bringing in technology and to facilitate things which we earlier couldn't even imagine. Old reforms need not be big bang. Many a time, small reforms cumulatively are more effective. Going forward, SEBI will use a right mix to both to achieve the objective. Indian capital market has witnessed a surge in individual and domestic institutional investor participation. Ease of investing through digital platforms have significantly boosted retail investor engagement. You saw one live demonstration by Mr. Vaidyanathan. I think there is enormous work which has been done by the industry in bringing in, these apps which can facilitate so easily making of investments. But then I think it also adds a lot of responsibility on us as well as the market players. Now, increasing participation by domestic institutional investors, including mutual funds and pension funds, has resulted in greater domestic ownership and made Indian markets more resilient. You may have noticed, there has been FPIs have there, because FPIs may react to global events and come in and out. Nevertheless, I think domestic institutional investors have stably filled up the gap in many ways. Not to say that FPIs are not important, and I'll come to a little later of what we need to do with respect of FPI flows. To foster financial inclusion and provide access to security market products and services to wider sections of the society, we are committed to facilitate market innovations and development of new products and processes, low-value mutual fund SIP, small and medium REITs, which we call SM REITs, and specialized investment funds, SIFs, are testimony to the same. As we intend to grow in the speed that we are aspiring, we need to have both domestic and foreign capital to support the growth momentum. With strong economic fundamentals and favorable demographics, India is a bright spot for long-term investments. The country has attracted global investments across equities, debt, and private equity spaces over the years. The presence of such long-term foreign capital would further support infrastructure growth, innovation, and entrepreneurship in India. We at SEBI are conscious about the need to create conducive environment to attract foreign capital. We will be happy to engage with FPI and AIF industry participants to address their difficulties and further rationalize regulations to promote ease of operation. Trust and transparency are the pillars of a healthy capital market. For sustainable capital market growth, maintaining trust and transparency in the financial ecosystem is paramount. A well-regulated market instills confidence among investors, ensuring fair and efficient capital allocation. Regulatory bodies, market participants, and corporates must uphold the highest standards of governance, disclosures, and ethical practices. Enhanced transparency in regulatory action, corporate reporting, and market operations will further strengthen the trust of both domestic and global investors in India's financial markets. And I think the trust and transparency extends to SEBI itself. We need to not only create trust of all stakeholders in us, but we also need to maintain that trust. And to that extent, I think we need to be more transparent, including on various other measures, including, for example, on the conflict of interest of the board and so on. And we will be coming forward with our own plan to further transparently, reveal these conflict of interest, etc., to the public. Ease of doing business in capital market is applicable in all the three touch points: point of entry, point of transacting, and point of exit. Capital market is a dynamic space, so change is imminent, but we will certainly not be looking for maximum regulation, but for optimum regulation. If some statutes are redundant and outdated over the years and not serving any purpose, we are happy to review the same and change them. We are open to ideas on this. Laws and regulations are better enforced through voluntary compliance. I am looking forward to engage with all stakeholders to discuss what more measures need to be taken to encourage voluntary compliance. I mentioned when I joined 4 T's: trust and transparency, teamwork and technology. And when I say teamwork includes the teamwork within SEBI. It also includes teamwork with various participants, investor bodies, the market participants, the market infrastructure institutions. And together we can actually create a further conducive ecosystem. We have come this far. We have to think of next 25 years. We have to think of how 2047 will look like, how we can move together. We have to bring in technology. As I said, technology is always a changing thing. Use the technology to do things better to more transparent, and give the integrity to the market institution of an order which we should be all proud. But for that, we need teamwork. We need, everyone to come together to do that. So teamwork is more than what is inside. It's also outside. SEBI plus others. Same is true with technology. The market is not a straight path. In order to ensure that investors are not lost in labyrinth, investor awareness and education is very crucial. An informed investor is self-protected. SEBI's effort in the days ahead is to create awareness among both existing and prospective investors. The question is, how do we create awareness? And that is where we need to explore different models of creating awareness across this big country. As said, we may have 400 million PAN-linked Aadhaar accounts. We're still there talking about 135 million of accounts who are trading. We have very slowly, we will ramp up to that number. And accordingly, we must also plan that how, the people are also aware of the risks, how the people are able to do the wealth management in a manner which suits them, how they allocate their own capital portfolio, which also de-risk them when they have to, and take whatever necessary in terms of allocation between the debt and the equity in a manner which suits them. As Charles Dickens said in A Tale of Two Cities, it was the best of the times and it was the worst of the times. There will be difficulties, ups and downs, but India's economic and capital market growth is a strong trajectory backed by policy support, structural reforms, and rising investor participation. With a thriving securities market playing a pivotal role in economic acceleration, India is well positioned to remain a global investment hub and a key driver of the 21st century economy. Thank you for your attention. Jai Hind.
Thanks for that, Mr. Pandey. Now, amid rising geopolitical tensions and growing concerns over the strength of the dollar, gold is experiencing a dramatic resurgence. As India's second most owned asset class, gold has delivered a significant wealth effect for Indians. But how sustainable is this rise? Let's find out with Manisha Gupta from CNBC TV 18 and requesting David Tate, CEO, World Gold Council, to join us on stage, please.
Thank you, Sonal, for that. Well, all that glitters absolutely is gold. If you look at the last 6 months, we've seen gold prices make string of all-time highs. In this year, until now, we're up by 11%. Last year was 28% of gains. If you look at last 12 months, we're up by 35 to 40%, depending on what currency you're looking at. David, I do understand that World Gold Council does not give out price views, but are you as bullish as so many banks and brokerages, because they're putting out much higher levels for this year and the next as well?
I know you would expect me to say yes, given my role, but yes, and the reasons are frankly not very obvious to many people, but becoming more and more apparent. I think pretty much every indicator of where gold should go is pointing upwards at the moment, but probably the most important thing is the burgeoning debt throughout the world. I think the global long-term sovereign debt has reached, I think, around about $76 trillion now, and is going to be added to by a further $13 trillion. And whichever way you look at it, we seem to be approaching, shall we say, through tariffs and inflationary push, which is going to steepen yield curves, in my opinion, which is going to make the reality of financing that debt very, very relevant to people. And I think the one asset class that always steps into that gap at that time, rightfully so, is gold. And I can't see an alternative to going higher.
You know, David, for the longest time, a lot of people, financial advisors for that matter, kept saying that gold is an idle investment, doesn't give you dividends. Look at some of the equity stocks or indexes for that matter, and they have given strong returns. But then look at last 3 months, and if you did not have gold in your portfolio, then you perhaps weren't recently leveraging it. Near term, yes, we've seen the gold prices gain up, but with the kind of scenario that we are in right now, macros, geopolitical tensions, tariffs for that matter, do you see gold prices holding these kind of return on investment for a longer term?
Yes, I do. I think it's an important thing to have as part of a portfolio, and very few people, and we are trying to change that phenomenon, truly understand that. To have gold, as you heard a speaker earlier, Mark, mention, to have gold as part of a portfolio and raise it and lower it depending on your view of the world is critically important. If you do not have gold as part of a portfolio, you're very likely to fall foul of the geopolitical, geoeconomic problems that we're seeing at the moment. For instance, even if you were predisposed to hold Bitcoin as part of your portfolio, which I'm not, but if you were, it's even more important that you have gold as part of your portfolio going forward. In fact, even the central banking community views gold as part of their overall portfolio, as importantly as individual investors should.
David, you don't have to sell gold to Indians. I mean, we buy it when a baby is born, to marriages, to anniversaries, and then occasions and festivals, and then we found reasons with...
Your microphone.
So as I was saying, India doesn't need a reason to buy, but the whole financialization of it and the way it is now included in portfolios in sense of ETFs and digital gold and sovereign gold bonds were a huge success as well. Do you see that change coming, and do you see that staying?
Yes, I think the sovereign gold bond was very, very successful for investors, perhaps less so for the government, but nonetheless, I do think that as your generations become more financially literate, you've got a swathe of young people out there looking for a way of investing in the financial markets, not least gold. I think that the instrument that will take the place of sovereign gold bonds is going to be gold ETFs. A little known fact to many people, ironically, ironic to me, I should say, is the fact that ETFs are gold-backed, 100%. They're listed, they're regulated, they are a very safe way of investing in gold. And as you've seen from the previous 2 to 3 presentations, the amount of money that is in this country and growing exponentially that is available to invest is an enormous opportunity for the ETF market. I fully expect to see that skyrocket, I really do, as people perhaps shift, and I say perhaps, shift from the physical gold investments into a more digital gold investment.
And as we see more financialization of gold, are you looking at a more wider, diverse pool of investors coming in for this?
Absolutely. When I first joined the World Gold Council, the industry as a whole in India, and perhaps even the World Gold Council, was very focused on jewelry, rightfully so, and that is an enormous market. I don't need to tell you that. But what I think is an enormous opportunity, not just in India, but perhaps in China and also in Japan, 3 major pools of capital, is the growth of the ETF industry. And I think that can bring many institutions, many asset managers, many mutual funds, many pools of capital out there that have hitherto not looked at gold to the market. So when you combine the geopolitical, the geoeconomic, the simple maths that we have become so accustomed to with gold, you combine it with those 3 enormous pools of capital just coming online, you can see what the potential for gold could be as a financial asset.
The other thing about India really is that we have, hallmarking clearly given a lot of confidence where people were buying physical gold. But the other thing that the World Gold Council also is talking about, traceability of gold, that really takes it further notches higher.
Absolutely. This is, you've heard traceability on the previous speaker with transparency, trust, traceability, all these things. These are absolute cornerstone of what we're trying to do at the World Gold Council. We have, in conjunction with the LBMA, the London Bullion Markets Association, in 2022, set up a database for all responsibly sourced gold. It is a database because when I came into this market, I, for one, was somewhat surprised that I couldn't check the provenance of an investment bar and coin. Simple. So we've set this database up with the hope that it will grow exponentially. For instance, it has all newly produced gold going into it. For instance, all my large-scale miners. It has the LBMA has adopted it. All refiners will be going on to this. And we hope many other people in due course. And the hope of this database is at some point, perhaps not too distant future, it will become unthinkable for anybody to buy an investment bar and coin without having first checked that the gold's veracity, provenance, integrity before buying it. My hope then is that the gold that sits outside the database, perhaps being used for nefarious practice, tax avoidance, etc., shrinks over time. It won't be an overnight phenomenon, but we are incredibly focused on that.
David, I want to come yet again on prices, really. And we've seen, when you look at other asset classes, and if you look at last 5 years and 10 years and 15 years, and people go around saying, when I was married, gold was there, and this is where it is right now. The way gold has performed and sometimes outperformed various other asset classes, and the way we are right now at all-time highs, are we at uncharted territories? Where are we going, and where will gold take cues from?
I think, are we uncharted? Almost. We're on the brink of 3,000. Do I see it going higher? Personally, absolutely. Where the main push is going to come? I think there's an enormous older generation in Japan. And to my surprise, they keep roughly 60% of their money quite literally under the bed. That generation are passing on their wealth to a much younger generation who are very financially literate and have the iPhones, and the penetration of the iPhone has made an enormous difference to them. I think in China, you may have recently heard that the insurance industry, only in the last few weeks, has opened up their insurance industry to the possibility to invest in gold. Just 1% now, but it's a $4.8 trillion market. If they invested just 5%, they're more likely to invest 10 to 15% in gold. Any one of you can do the mathematics. And of course, in India here, you have an enormous younger generation, as I've already mentioned. But the added push is going to come from two things. One, continued central bank buying, predominantly central banks who are, shall we say, developing central banks, who still have a relatively low exposure to gold. And the reasons why they would think that are, I think, obvious to everybody here. You can see world events, you can see economic uncertainty, and they manage their reserves very much like you do yourself. And so I think they will continue to accumulate. And the last thing is, and I must mention it, is the fact that over the course of the last 5 years, we have been working furiously with a huge group of banks and regulators in London to move and to digitalize the London, in fact, the global OTC markets. This is moving the market very much from a 1985 copper wire feel to very much a 2025 feel. And I think that will open the market to an enormous number of financial investors. And you noticed that Mark had never traded gold. No surprise. It will open that market to an enormous number of asset managers who have hitherto haven't even thought of trading gold.
David, I also want your reaction to a recent happening where US brought in a lot of physical gold and silver. Even when we look at COMEX right now, the net long positions are near record highs. Silver net long positions on COMEX are at an all-time high. So the kind of buying that, or rather the holding that gold is doing right now, and this is perhaps because of tariffs, ahead of tariffs, how do you look at this phenomena? Until now, we were looking at London for gold prices. Are we looking at huge premiums and discounts, and are we looking at prices changing in sense of reference on what the world has been looking at?
Yeah, I for one, come from a fixed income and FX background, principally. And when I came into this market, I was bemused, to say the very least, at this simple phenomenon that everybody's got a different shape and size of gold, and in order to settle contracts at the CME, London has to fly them across the Atlantic in planes. I didn't know what was going on. I had to try and unpick why people didn't invest in the gold market, and that was just one of 1,000 things we tried to solve. I think, firstly, that phenomenon of different shapes and sizes is going to be solved by the digitalization of the asset class that I mentioned. Going back to the reason why we've recently had this, some say, hoarding of gold in the United States and silver as a precursor to perhaps having tariffs imposed. My view on this was that we as a group, the WGC, could not really fathom a reason why gold would be picked out in isolation. It might get caught up in other things. For instance, I've noticed it's included slightly in cross-border Mexico-US. To me that people will commit their personal wealth to a string of digital code with no explanation whatsoever. And I sometimes wonder whether we try too hard to try and explain the value of gold to people. That being said, it's easy to say it's here forever, but it's also, we all know deep down inside, it's possible for it to go to zero. So I'm not going to be one of these people that say that it's bound to collapse. It might perpetuate, but I do look upon it as a speculative tool only. I would not be a store of value for me. It would be, it's going to move fast, therefore I want to be in, I want to get out, I'll invest what I can afford to lose. Gold, on the other hand, is something that you hold for a lifetime. It should always form part of a portfolio. And if you don't, you are putting your portfolio and its returns at risk.
My last question then, David, and what would you advise investors on what part of their portfolio or percentage of their portfolio should be gold?
I would say between 10 and 15%. The World Gold Council's view, official view, is 7 to 8%, but I would say 10 to 15%. I think that suits the current economic environment. I'm a relatively conservative investor. I always have been. My career is 35 years of trading and investment banking, but nonetheless, I was not one of the people who blew the doors off with trades. I was more a consistent trader over many, many years. And in that context, I see it as almost an act of self-harm to not have gold as part of a portfolio in whatever form you see fit.
Thank you so much, David Tate, for joining us here. Really appreciate your time. Thank you, gentlemen, so much.
India stands at the cusp of an unprecedented leap today, a $10 trillion stock market, but achieving this milestone requires more than just momentum. It demands sustained 9% GDP growth and strong valuations. Can public investment boost growth while maintaining fiscal discipline? Will job creation ignite domestic consumption? How can exports expand amid protectionist trends? Do Indian corporates have the capacity to raise, absorb, and deploy capital efficiently? The stakes are high and the opportunities are immense. To lead this critical discussion, I'd like to invite on stage Bodhisattva Ganguly Group Consulting Editor, Network 18. And to dive into this very interesting discussion, may I please also welcome on stage Anish Shah, Group CEO and MD Mahindra Group, and Neelkant Mishra, UIDEI Chief and Member PM, Economic Advisory Council, Chief Economist, Axis Bank, and the Head of Global Research, Axis Capital.
Thank you, Sonal. Thank you, Anish. Thank you, Neelkant, for making it here. I must say, when we conceptualized this program about 2 months back, 3 months back, we had not anticipated the extent of the fall in the market. So please treat the 10 trillion market cap figure as aspirational. This is both for the panelists and as well as for the audience. I'm sure we'll get there, but maybe not in a hurry. Let me, with those words of caution, as it were, let me first start off with Anish. Under his leadership, the M&M group and M&M as a company has achieved tremendous. Their market cap has grown dramatically over the last 4.5 years, maybe a fall in recent times. But given the extent of gains in market cap, given how the share price is done, particularly of the flagship, it's going to get harder from now on, isn't it?
Bodhi, in many ways, I'd say if the foundation is strong, then future growth becomes easier. And we've had a very strong foundation. In fact, I often remind folks that M&M was the best performing stock in the Nifty from 2002 to 2018. And after that, we've grown significantly since then as well. So I think we should, in some ways, we feel very confident about the DNA of our group, the ability for us to be able to deliver growth. And as we've always said, our results will speak for themselves.
But what are the strategic initiatives that you have in mind in terms of driving growth, which eventually, hopefully, will show up in a higher stock price over the medium term?
I think that's a fundamental question, Bodhi, and we start with the fact that we want each of our businesses to operate at a very high level. We use the term operational excellence internally a lot. What that means is that we are delivering the best products to our customers. We are delivering that in a manner that creates the best customer experience, in a manner that has the highest level of productivity. And that enables us to grow market share, that enables us to have better margins and create leadership in multiple industries that we are in. And that is what has driven our growth. And each business has a set of strategic initiatives, which I won't go into right now, just in the interest of time.
Neelkant, if I can bring you in. The economic survey, I think it was not this one, the 2024 economic survey, expressed some concern over financialization of the economy. You also have some views about what is a healthy market cap to GDP ratio. Why don't you talk us as to, are we now at a healthy level given the fall? What is a healthy market cap to GDP ratio?
I don't think there is a healthy market cap to GDP ratio that you can prescribe at all times. Markets are going to be trading in ranges. As you think about the market cap to GDP ratio, divided into two parts. What is the corporate profit to GDP ratio? And then what multiple you want to apply to that. For a long time, I would say from between 2010-12 to 2021-22, the profit share of GDP was falling. So, and therefore, Nifty earnings were growing at 4%, actually till 2019, and then GDP was growing, of course, at 11-12%. So, I don't think in the next 5-6 years, profits will grow slower than nominal GDP. So that should be supportive of a higher market cap to GDP. This is one of the reasons why even in the US, the market cap to GDP ratio is very high. In China, it's very low because corporate profitability or the corporate profit share of GDP is low. Then it comes to the multiples. Now, the multiples, by definition, will be volatile. So you will see them getting affected by cost of capital, what is the risk-free rate, what are the alternatives available, and general euphoria and pessimism. And I think we are coming off of a very high level. We were at a record high. We've never seen those levels. The range that, if you plot 2004 to maybe 2020 or so, was 60 to 80%. We were at 120. So we are now maybe down to about 100%. Can it fall another 10% from here? Perhaps yes. Will that happen because nominal GDP grows and market cap stays the same? I think that's the most likely scenario.
I just wanted to take up one of the themes, and that also leads us into questions on consumption. But again, the last economic survey, and I think the one before that also, has criticized the corporate sector because what it's saying is that the rate of growth in profit, I'll ask Anish to weigh in on this, but first you go. The rate in their profitability has grown quite fast, but they're not paying enough by way of wages. The wage growth is slow. What are your thoughts on that? And is that leading to a weakness in consumption?
I think the observation is right. I'm not sure.
I've never counted the hours, but I would always spend weekends with family. But that's my balance, right? I think each person should set their own balance and should do what is right for them at that point in time. So there should not be a definition, the output, the quality of the output. It's about the balance that each person wants. And organizations must support that. And that's what we need a friendly culture, a friendly organization to do, is to be able to say that we recognize the balance each person wants. There are times when there are needs of individuals that require even further balance. And that's what an organization should be able to support at a time of need for each of their associates. That's one thing at the Mahindra Group we are driving in a significant way in an overall initiative that has been there as part of our culture for years, which is around We Care. A specific maternity program that we have is a 5-year maternity program in terms of significant, not just benefits, but in terms of how we provide the time that each person needs when they go through maternity. And not just that, but across many different things. So for me, it's more around, can an organization support the needs of each person, and can each person ensure that they have the right balance that is appropriate for them?
So the question is for both of you. So, obviously economic growth since COVID has largely been driven by government capex. And I think in the communication after the budget, the finance minister and including the former finance secretary, now the SEBI chief, they've all said that the government capex obviously can't keep growing at 20% plus indefinitely. So the private sector needs to step up. When will that happen? Anish, why don't you go first, and then I'll come to Neelkant.
Well, that Bodhi, first I would give a lot of credit to the government for staying consistent on capex, because the multiplier effect is far greater. Having various SOPs can increase demand in the short run, but that's not the right approach for the economy, so I would give a lot of credit there. From a private sector standpoint, again, back in a capitalist society, it is going to depend on capacity utilization. Our auto business has almost quadrupled capacity now in the last 4 years, because we've seen that level of demand. The industry overall has not grown at that rate. Many other industries are starting to get to 75-80% capacity utilization. That's when we're going to see greater capacity come in. So I feel that private sector capex will follow. Overall, we are very optimistic on the Indian economy. And it is just a matter of time that will happen, but that is part of driving greater demand, and which will then result in higher capacity utilization and therefore private sector capex.
Neelkant?
Yeah, so I think we have to view the problem a bit differently. We are getting caught into that classic psychological trap that something that you see very often you think is very important. Just to give you perspective, if India's investment to GDP ratio is 32%, central government capex as a percentage of GDP is 3.2%. So it's only 1/10 of the total capex that we are doing currently. So to ascribe all of investment in India to just what the government is going to do in the next 3 months is, I think, being very myopic. So I would break this down into two parts. The first is, why did the investment to GDP ratio fall in the first place? So of the 7% fall from 34 to 27 between 2012 and 21, was because on how fast approval should come through and all that. Once that starts reviving, I think the economy will be fine.
Okay, two quick questions. First, I'll go with Neelkant. Is there any, the government has also been concerned about the fact that the economic growth is close to 6%. It should at least be closer to 7%. I mean, there's been some concern on that fact. Are there any, is this a cyclical kind of a slowdown, or are there structural elements?
It is absolutely a cyclical slowdown. It is a self-inflicted slowdown. There were three factors: fiscal, monetary, and regulatory. So the fiscal was because of elections, the government spending took a few months longer than it should have. So the first half of the fiscal year was unduly slow. Regulatory, I think our regulators had become too risk averse. And as the governor very rightly said, that we need to balance safety and efficiency. That's happening in other regulators as well. So at least some of the regulatory tightening is being reversed. On the monetary side, I think we have been unduly tight. There used to be this FRA-OIS spread, which is the actual cost of fund versus the announced cost of funds, like the Fed funds rate and what's actually the LIBOR rate, which we used to track, with which we used to track the stress in the financial system in the financial crisis. In India, the 12-month CD rate is still 760. It is not anywhere close to 625 or 610, which is the 12-month OIS. The 3-month CD rate has actually gone up by 15 basis points in the last couple of months. So the cost of liquidity is very high, and therefore liquidity easing is a very important thing. The RBI is working on it. You must have seen they've done first 1 trillion of OMO, then $10 billion of buy-sell swaps, another $1 trillion rupees of OMO. I think another 2-3 trillion is needed. And then I think the growth rates can rebound to 6.5-7%.
Anish, M&M Group is present across a wide range of businesses and sectors. Do you see any slowdown in consumption?
We have not seen a slowdown, again, a function of the products we've had. Our auto business, our SUVs will grow 20% year over year. Our farm business is growing well. In the fourth quarter, we're expecting a 15% growth year over year. And that's very significant from a rural standpoint. Hospitality, our resorts are at 84-85% capacity. So as we look across businesses, we've seen a lot of positivity, actually. I think Neelkant explained it really well in terms of the short-term impact and what drove that. A lot of those factors have reversed now. So with that, we would expect growth to increase. And if I were to just take a step back, over the last 30 years, India has grown at 6.5% on average. If we look at some of the factors that will change the growth rate that are in play already, the digital stack that drives productivity, GST, which makes it much easier to transport goods across states, a number of other actions taken to drive ease of business, we would expect an 8% plus growth rate over the next decade. That is the goal that India should have. And that is something that's eminently feasible given what we have today. Another factor that will drive that is Make in India for the world. And today we are much better placed to be able to talk about products that we have in India that are of a very high quality, that often are of a higher quality than products made by others in the world, across industries. And that is something that's going to give a much greater fillip to manufacturing in India, which will continue to drive that growth rate up.
Thanks. One last question. Does anyone can go first? Does India need its own version of Doge? Doge, the Elon Musk's. I think he's going to toss it to you.
I do think so. I think that, an economy 7 times our size, like the US, has 16 departments. In India, I think there are some 85 departments in 53 ministries. I mean, we have a Ministry of Power, Ministry of Coal, Ministry of Oil and Gas, Ministry of New and Renewable Energy, and the batteries are done by the Ministry of Chemicals and Fertilizers. If you think about electric vehicles, electronics done by Ministry of Electronics, cars done by Ministry of Heavy Industries, batteries done by Ministry of Chemicals and Fertilizers. Clearly, as the world moves towards more industrial policy, I think we need a much better aligned government structure. So I'm not so sure about the whittling down of the government size. Our government is already too small, but it needs to definitely bulk up in some essential sectors, in healthcare and education, for example. But there definitely needs to be a lot of restructuring of the government for us to be more competitive.
Anish, you want to take a shot at that?
I think the key factor is efficiency. Think about how we would think about it in the private sector. Are we running something efficiently? Are we enabling each function in the business to operate at a level where it achieves its objective of serving the customer well? And similarly, that's the same question from a government standpoint. And what we see actually over the last few years is a much greater level of efficiency, because we have seen a focus on driving ease of doing business. We've seen our ministers and secretaries working extremely hard. I've personally seen that in my years through FICCI last year. And I think we're seeing a significant increase in that. What we also have to remember in a democracy, there are multiple stakeholders, and there are certain objectives. So the goal of improving efficiency should always be there. That does not go away. But we've got to do that in a way where we do not end up breaking glass in some form.
Anish, Neelkant, thank you so much.
Thank you.
Thank you, gentlemen, for that. Now, as we move on, let's talk a little bit more about the markets. India stands apart from other emerging economies, boasting unparalleled diversity in its business. There are more than 500 listed billion-dollar firms. And as we gaze into the future of a $10 trillion market, where will be the next stock market titans emerging from? How do we maneuver current valuation dynamics to uncover the next big compounders? To unpack this, Prashant Nair, CNBC TV 18, will elicit news and the views of our esteemed panelists. Let me bring them up on stage, please. Sunil Singhania, founder of Bacchus Asset Manager, Utpal Seth, founder and mentor Trust Group, Rashi Talwar Bhatia, partner and portfolio manager, Ashmore Investment Management India, and Prashant Jain, founder and CIO, 3P Investment Managers.
Sonal, thanks very much for that. I'm extremely pleased to be here to be able to conduct this panel discussion. I think we've got market wisdom of about at least, 150 years? Touching
Not that old, not
closer
that
to 200 years on this panel here, so it's going to be an interesting one. So the idea, of course, we have 30 minutes, so let's make the most of it. The idea, of course, is finding the next sort of big money-making, wealth-generating stock, in that sense of where the stock will come from, which sectors, etc. But I think, before you thrive, you have to survive. And I think in the recent last 60 days or so, the markets have had a, can I call it a mini heart attack? So let me just start with that question, whether we are out of the woods already, and I think the audience here would like to know that, whether the our panelists with their accumulated wisdom think that we are out of the woods in terms of what we've seen. Also, before I get into it, really, I want to wish the First Lady on the panel here, I think the First Lady on the panel since the morning, a very happy Women's Day. Rashi?
Thank you.
Well, lovely to have you.
Lovely to be here.
Sunil, start with that first. Are we out of the woods with this phase of correction, this sharp sell-off that we've seen in the recent last 2 months?
Thank you for having me, Prashant. I think it's always a $1 million question, but again, equity markets, this is not the first time we have seen a big move up and then corrections, and I think this is not going to be the last time. Obviously, things are different. This time, we are seeing this period after 3-4 years of, I would say, really a good sort of a move. Stocks had become very, very expensive, and I would say this correction, it needed reasons, and the reasons have been multiple. I think we saw GDP growth numbers disappointing, corporate profit numbers still disappointing, and on top of it, we have had this now whole uncertainty about dollar movements, Trump, and so on and so forth. The only good thing is that, every time we have a euphoria or excesses, you need a cleanup, and after the cleanup, normally what follows is very healthy. So I shave off my head, a lot of unwanted hair got shaved off. And I'm very sure that now the growth will be healthier and more. And I think that is exactly what the market also leads to. You have to shave off the excesses. And when, again, it revives, I think it is much more healthier. So I don't know whether we are behind it. I personally believe it is going to be a W-shaped sort of a recovery rather than V-shaped because stocks are still expensive. But I think a lot of technical factors have led to us to believe that maybe, the bottom is somewhere near.
So the W is, we've got a big down, then there's a small up, then it's a small down, and then it's a big up. So we're in the second leg.
I think W will be up and down, but with an upward sloping bias.
I see. Many Ws, not one W.
Yeah, it is going to be multiple Ws.
But it's time to be constructive now, Sunil, would you say?
Broadly? I think it's time to be always constructive. I think what we are $3 trillion, $3.5 trillion. I'm very sure Neelkant has more numbers, but if you see the world, US is 4% of the world's population, 70% of the world's market cap, and 50% of the world's debt. I think somewhere down the line, even if 3-4% moves from these kind of countries to others, it's a $3-4 trillion movement. And even if India gets 5% of that, we have $150-200 billion coming in. So this $20 billion of flows every year, which we make a lot of hue and cry about, I think it will look really chiller in front of it. So I think the only focus we should have is whether this economy is back on track to grow 6.5-7%. If that be the case, profit growth will be at least 11-12%. And your return expectations are, if they are in the low teens or, lower double digits, I'm very sure you'll not be disappointed. So you have to be always constructive in a growing economy.
And you have been, Rashi, that same question, are we out of the woods? Quick answer, and then we'll dive into sectors. And I know you have very specific, interesting ideas there. Go on.
So I think that in the large cap space, we are reaching a point where you're starting to see interesting prices or interesting valuations where things are starting to make sense to maybe start nibbling and getting into it. In the small and the mid cap space, we've corrected from being 2 standard deviations above, 10-year history, but we're still a standard deviation above. And I think there have been sharp drawdowns, yes. But, things went up 5 times. So you see a 30% drawdown, you're still in a pretty expensive territory. So I think, to what Sunil said, there has to be some rationalization to what you're paying. I believe in the India story and I believe in the consistent upward trend. But things cannot get out of whack, so to speak. And I think we may be close to having that done in the large cap space. In the small and mid, I'm still a little skeptical about having reached there already.
Okay. Prashant, what about you? What do you think?
No, I would largely agree with what Rashi said. I think the large caps are looking a lot more reasonable, 16 times calendar 26. I think we are broadly there. Small mid caps, I would still be quite cautious. I think the supply of stocks from IPOs should go down 60, 70, 80%. And at some point, even the FI selling should abate. I mean, we don't know when, but at some point it should. I think the local flows should be quite sustained and they should go towards secondary markets and most of it through large caps. So I would say large caps appear to be reasonably valued. One final thing, I think this is a compounding market. I would not, India growth does not mean to my mind that you can earn meaningfully different from 10-12% long-term CAGR because I think profit growth, profit margins, I don't think have room for increase and profit growth should be around 10-12%. That's what I feel.
And that's an interesting point that you make, Prashant, because 2019 to about 2024 high, September 2024 high, that compounding had gone out of whack. We were running 25-26%, but that's now reverted back to mean in that sense. So eventually, it is that same 12-14%, which you should expect, and that's reasonable to do. But is the froth in mid and small cap still there, Prashant?
I think that high compounding was only because of the low base set during COVID and not because of any other reason. I think the big froth is gone, but I would still not feel comfortable with small mid caps, though I think the vertical fall that you have seen, maybe it's behind us and we should see slower underperformance, but maybe for extended periods.
Utpal, what is your sense?
Thank you, Prashant. First of all, I would say it was not that we had a mini heart attack. I would say it was a stress test. Second, I would say that let's step back a little. The quantum of change and the pace of change that is now taking place at a global level is really unprecedented.
Utpal, can you hold your mic a little closer, please?
Okay,
Yeah,
is this better?
please.
Yeah. The quantum of change and the pace of change that we are seeing at a global level is really unprecedented. This will have impact on growth, on risk, and on profitability. It will play out over a period of time. Therefore, I mean, factors like deglobalization or AI disruptions, and there are just too many factors. As an investor, should one be afraid of that, or should one see the opportunity behind that? In the past, whenever such a change to the global world order have taken place, whether it was the Bretton Woods or any such other major change, then those changes have resulted in phenomenal opportunities. I think it is wise to be able to look for those opportunities in the times ahead.
I think you've taken I wanted to just do one round on this as well. Are we, because the change is phenomenal, right? I mean, the significant amount of news flow, how much is noise, how much is signal, we don't know. How much should we read into it to really make investment decisions? Does it affect investment decisions? Who will be the winners? Who will be the losers, etc.? So I don't know if any of you feel strongly about this. Sunil, if you want to take that. Will it really, the changes we are seeing, I mean, you said, right? I mean, US is so much capital and some may come here, but they want it all, it looks like.
So I'll just start by, just sharing something which was there on the WhatsApp. So on Monday, you said there will be tariffs. On Tuesday, you said there will be no tariffs. On Wednesday, again tariffs. Thursday, again no tariffs. Friday, again tariffs. And Saturday, Sunday, play golf. So I think the relevance is slowly getting lost, because if every day you come and arm twist, at some point of time the guy is going to say, I don't care. And I think that is what is happening. China has already said that you can't threaten us, you can't arm twist us. Canada has also put retaliatory tariff, and I think the same thing will be done by a lot of other things. And if you see the impact, whenever they announced anything, now the impact is reverse. Yesterday the European markets were in fact up. The other thing is, there is this concept called Trump put. Trump doesn't like markets to go down. And at least in his earlier term, this Trump put worked, that he could sell puts and keep, because Trump will ensure that the markets don't go down. And I think this is what is happening. The moment the markets correct, they defer the tariffs or they announce something else. So I think the relevance is being lost, frankly. The other thing is, for how long, you can just keep on bossing around. So I think maybe, I don't know the rationale or whatever it is, but I think the world will adjust to it. And, no one, after a point of time, will take dadagiri, so to say, I think even if you shout at your house help or driver for 2 times, the third day he will not report to work, and these are presidents, you can't ridicule presidents. So I am frankly, not reading too much into it. There will obviously be news flows which will impact market, and that's why this W-shaped, the markets might go up, and then there might be some news flow, something which will cause some concern. World is still not a very stable place economically. So irrespective of Trump, I think what we need to worry about is whether the world is coming back on its feet or not. But I think this Trump thing has gone too far, and we just
although he's not once since taking over this time tweeted about the stock market, and the earlier avatar every day in the morning he would say,
because the stock markets were up since he took over. It's only yesterday that they're now below his price. Now wait for 2-3 days, you'll know.
No, point taken. The other implication, though, I mean, directly, what impact tariffs, etc., is a different thing. But as you said, though, is the world doing better? Many parts of the world are now starting to look like they're doing better. Europe, for example, is a case in point. Germany, after, I think decades, is now starting to say they want to do well. They want to spend on infrastructure, military. China, this deep-seek thing is. I mean, so the last 4-5 years in emerging markets, we used to say, Tina, there is no alternative. That seems to be changing. There are options. Argentina, for God's sake. Japan, I mean, not an emerging market economy, but I don't know if Rashi, Prashant or Utpal, you have any strong views on this? I mean, and then we'll get down to what you like and where to find those ideas. Please.
So, I mean, I think all four of us here are India specialists, so to speak. Yeah, I think you're right. The world's getting to be a slightly better place. And maybe it should be. We've had 4 years of practically there being just US, Japan, and India being the stalwarts standing there for the equity capital markets, and it cannot be this narrow.
Right.
So I think it's healthy for global markets in general to have better alternatives where you have more choices. So.
Any thoughts, Prashant? You want to weigh in? You're a big macro. You do. I know. 20 years we've spoken. You've always said the price of oil is all important. The price of oil is now down. I mean, that is one of the consequences of everything we are seeing out there. Go on, Prashant.
No, I think India's correlation with world GDP growth, I mean, many economists don't agree with that, but what I have seen that India is on its own path. It's growing around 6% plus minus 0.5%. I think that should sustain, and India has delivered that growth in different macro environments, high interest rates, low interest rates. I think that growth is pretty secure to my mind. I think it is just that the expectations from India, what happened last 5 years were being extrapolated, and I think that's where things got overboard. So, I mean, I would expect India to do reasonably well over time what it has done for the last 2 decades. And as Rashi said, I mean, I have nothing meaningful to add on markets beyond India.
Okay, so let's get down to, as you said, as Rashi said, all of you are India specialists. So let's find ideas, right? And I think that's the idea behind this panel discussion. Sunil, you go first. Where is the next billion, trillion, multi-trillion dollar idea going to come from? Which areas are you sort of most hopeful of, constructive on?
So, I think it's frankly very, very tough question because sectors and companies which look good are still not cheap. Obviously there are a lot of headwinds, so if you look at IT, there's a tailwind in terms of currency, but there are headwinds in terms of technology change, maybe some regulation in the interim which Trump might bring in and so on and so forth. So I think it's a little difficult at this point of time. The only thing I'll say is that, we are obsessed into making, multiple returns or multi-bagger returns, and we lose the plot. I don't think we are in a phase of the market where you're going to compound at 20-25%, where you will be able to double your money every 3-4 years. I don't think we are in that kind of market, because growth rates, even if we come back, will be 6.5-7%. I agree with Prashant that the long-term profit growth will be 11-12%. And we are starting with not a very cheap market. We are not starting with an 8-10 PE market where the PE can expand, and therefore you have higher than the corporate profit growth as far as returns are concerned. So I think we are basically looking at somewhere in the region of 10, 12 to 15% returns. I believe that there are pockets which have opened up. Chemicals is one space which also get benefited because Europe was a big sort of destination for India, and Europe was really struggling. One uptick of what Trump has done is that all the other countries have woken up, that we can't depend on US, and now they are trying to chart their own territory. And I think Europe is one where they are saying, okay, let us do a bazooka. China is saying, let us do a bazooka. We want to ensure that our economy, irrespective of what Trump does not get impacted. So I think that would be one. Metals is one space. These are small sectors, but they definitely add alpha. I think financials look pretty decent. Growth rates will be lower. But corporate balance sheets in India have never been as healthy. NPAs are not there. I think the banks have really done quite well. So financials are one space which look good. But I think if you want to create alpha, maybe these 2-3 sectors can add 1% to your returns. But I don't think we are in that phase where you will make 20-25% return every year for the next 3-4-5 years. I don't think we are in that space. So we should not focus on making multi-bagger returns. We should just focus on consistently trying and beating that 10-12% long-term average.
Sunil, with the kind of returns you've given,
yeah,
I don't think your investors are going to accept
12-13%. We will find some stocks, but I'm talking about the portfolio level. You can't have every stock in a portfolio going up 3, 4, 5 times. And that phase was there. And I think it's like, the T20 matches. First 6 overs you have to hit. That has been done. Now you have to protect your wicket. So maybe the next 10, 12 overs, the next 3, 4, 5 years, you just have to take singles, and that is the phase we are in.
Okay, so chemicals, metals, financials, three areas broadly.
Financials in the big sector, but I'm just giving you examples that there are some small pockets which are opening up, which can add a little bit of alpha to your portfolio.
Okay, so financials, of course, is well discussed, but chemicals and metals is largely like a valuation-led argument. Demand is picking up. It's a combination of both.
So again, if you look at Indian metal companies, I think the debt-equity ratio is one of the lowest we have seen. Domestic demand is pretty healthy. There is no challenge. They are dollarized, so the rupee depreciation helps a little bit. We are going to definitely see reconstruction in the world in terms of the war-torn areas. So one thing good about Trump is that at least he will ensure that the conflicts are reduced. There will be reconstruction, whether it is the Gaza Strip, whether it is Ukraine and so on and so forth, there will be demand. China has already started, having a big impetus, plus they are also trying to curtail, production which is not viable. That is also there. And I think as far as India is concerned, the demand of 7-8% even for these metals will go on, and we are one of the lowest cost producers in the world. It's a small sector. I'm not saying that you have to have 15-20% of your portfolio in metals, but even if you have 7, 8, 10, and they end up doing 10% more, you add 1% to the alpha. So that looks good. And I think the same thing is there with chemicals. We have survived the worst. Europe is big. There are a lot of Indian companies which have gone ahead and bought global companies, and when these turn, I think the impact on profitability for some of these companies is going to be huge.
Yeah, absolutely, and I think there are more assets which are coming up in Europe up for sale as well. So maybe we'll see what happens. But you're absolutely right. We've already seen some acquisitions coming through. Rashi, what is your big bet?
So, let's keep valuations aside for the time being. Let's look at where we're going to see better than what earnings we're expecting. And in Sunil's perfect world of the W-shaped kind of recovery that we see, we'll get the opportunity with the valuations. And, in terms of a trend that I'm picking up that is changing, and a shout out to Neelkant on the panel before who mentioned larger participation of women in the workforce. So 2019, there were the participation of females working was 23%. Last year, 2024, that was 37%. This year, we're supposed to get to over 41%. 2020, more women went to high school than men did. And therefore, as more women enter the labor force, consumption patterns are changing, and changing dramatically. More women working, women have always managed household finances, but that's a very different kind of spend versus when they're earning themselves and spending on themselves. So when women earn themselves and what do they spend on, right? It's convenience to make life easier at home, and that could come in the form of, say, quick commerce or e-commerce, gadgets, electronic gadgets at home, because you need to have more time on your hands to be out. It's personal mobility, and we're seeing that probably with scooters, would get to smaller cars, etc. And it's also on the personal well-being. So whether it's fashion, whether it's beauty products, skincare, etc. And fashion and beauty are already a $110 billion market, of which beauty products is only $20 billion, which is expected to get to $90 billion by 2037. And $40 billion of this is supposed to come from the e-commerce platforms, right? So these are very large trends. And we have seen markets like South Korea or the US, what has happened when these trends have taken place, which are now taking force in India. To me, these are large changes, and we will find a lot of winners coming out of this space. Obviously, you have to look at valuations, you have to look at what the status is, what the growth status is. But yes, I think this is one opportunity which I do believe is playing out as we speak.
Specifically, you're saying beauty as a category is something to watch out for, right? Cosmetic
BPC,
products,
because
BPC,
I think it's fairly under-penetrated even today. Fashion, see, if of 110 billion, 90 billion is already fashion.
Yeah.
BPC is to go from 20 billion today in 2025 to 90 billion by 2037. So that's
Are there
compound
enough listed entities? I mean, everybody, all the large guys have it, but I mean, for them, it doesn't move the needle. So you need something concentrated in that sense.
So, absolutely. And I think the large guys are realizing they didn't have exactly what was needed. They were sitting on their own, now are starting to look at more on the private space to acquire. There are obviously some listed brands which do more distribution. There are some that are getting into the manufacturing side of things. And I think we're going to see more and more come out as we go ahead.
And acquisitions in that space as well, right, from the larger guys.
Absolutely.
That we are seeing, and we'll see more, some in the play. Prashant, what would your ideas be? And of course, I mean, with the disclaimer, and I think all of you are saying the mantra is keep expectations low. Don't look for multi-baggers. That it was still, as Sunil said, where do you find the alpha?
So these are compounding markets. I don't think these are markets that offer meaningful number of multi-bagger opportunities. If you look back, multi-baggers have materialized even when a new business model was listed in India, which is not happening anymore because they go to the private equity route more often than not. Or when the markets were in a deep downturn. Or when, let's say, see, consumption is not that cyclical, but capex can be deeply cyclical. So in 2000, when capex was down for 10 years, you could find multi-baggers there. I don't think in this market there are multi-baggers to my mind. This has been a narrative-driven market. If you look at last 5 years, 3 out of 4 investors have joined the markets for the first time. So, and they have been influenced heavily by narratives. So I would rather avoid those narratives because most narratives have been overplayed in terms of valuations. Yet I would say, as Neelkant said in the previous session, I think capex should grow faster in India than GDP. I think consumer discretionary space should also grow faster than GDP, and Rashi also referred to a segment of that. I think, however, I would simply also be careful that top line growth alone need not lead to profit growth. So we have to be careful to buy into categories where there are some entry barriers, some competitive advantages, and but generally I would say these are compounding markets and there are no obvious mega return kind of opportunities in this market tomorrow.
But industrials and capex is the spot where you think maybe market is underpricing. Expectations have dropped off there, especially after the budget, etc. People said, well, maybe the regime is changing, it's more consumption, etc. And after a few years of very strong growth. But you think, as Neelkant also pointed out in the last session, that is not true. So that still remains a spot to look for ideas. Capex and industrials.
So I think, yes, industrial should grow faster than GDP. And only thing is you have to be careful. The margin expansion in some of these companies looks to be unsustainable. So, but still, I would be quite alert to look for companies that have some advantages, because that space should grow meaningfully faster than, so that narrative is right, it just got overvalued. But if it again offers you reasonable valuations, I think there is merit in that space. So I would agree with that.
I would be remiss if I don't ask you about PSUs, Prashant, PSU banks, etc. I mean, stocks have fallen a long way now. What's your sense? How do you think about that?
So I think we should, as I have said multiple times in the past, it's wrong to club all PSUs together. There are PSUs that can compete well in the marketplace, and there are those who are unable to do so. But even the good ones, I don't think there is any meaningful mispricing at this point of time. Please remember, these stocks have gone up 5x to 15x. And so I would say, but there are, in the large cap space, I don't see much excesses also. That's the good thing in this. In the small mid cap, there are still excesses, and most PSUs are large cap. So I don't find the valuations excessive either.
Fair enough. Utpal, where are you looking for ideas? Alpha.
Instead of thinking about sectors, I would say that this is the time to think about superlative management teams who've demonstrated the ability to pivot, the ability to adapt, who are working on expanding their addressable opportunity and elongating their competitive advantage. There are very few of them, and this kind of market volatility actually helps in being able to buy them and I fully agree with what has been discussed earlier, that we are looking for compounders here rather than multi-baggers. But I feel that the compounding longevity will be better with these kind of superlative management teams.
And we had one before, right before this panel, right? Anish was on stage, and fantastic job there. But anything specific, Utpal? I mean, since it's about superlative management teams, I don't know if you want to put a few out there.
So we are looking for management teams who are able to embrace the disruption, who are not dependent on economic growth for their growth. We are looking for management teams which can take out costs, which can think of very different price points compared to what they've been thinking of earlier. I think those would be the characteristics to look for.
Fair enough. I think we are right on time. I think the message from the panel is, if you want to be happy in markets and in life, keep expectations low. I'm summarizing it correctly, Sunil?
I think it's always better to have low expectations because, if it comes better, you're always happy. But we also have to embrace the reality.
Right.
I think to expect CAGR returns which are extraordinary, then, I think it will all boil down to no one will set up industry and no one will work. Everyone will just want to be
Now you're getting into a...
It's a fact, So I think you have to be realistic about it. But see, in the broad scheme of things, we could have said that, things were very expensive last year, but no one came out and said that. Right now, we are all trying to introspect. That's the nature of the market. Things definitely are decent, but at the same time, there are challenges also. I'll just highlight one challenge. A lot of corporates are also taking decision now based on market cap of that particular sector rather than profitability. And we have seen that happen in paints, cables, some other sector will come up. I don't think the size of profit is what is driving those decisions. Maybe the size of market cap is driving those decisions. And that will put pressure on the existing companies. On the other hand, because the markets have not been very, very buoyant, the ability to raise capital either by way of private equity or IPOs will reduce. And that will lead to reduction in competitive intensity for the already existing players. So it's going to be a very interesting next couple of years. And I think that is good because in a market which was like what was last 2-3 years, even your mistakes made money. And now, it's really going to be a good grind. And I think that is what you need if you want to accept the challenge as a portfolio manager.
Intermittent bursts of reality, and we'll continue to lean on all of you as we navigate over the next couple of years. What seems to be slightly different markets is what we've had, go-go markets we've had over the last few years. Sunil, Rashi, Prashant and Utpal, thank you very much for being lovely guests and all those insights, some ideas here for the audience as well. And thank you very much for being a wonderful audience. Thank you very much.
Panelists. Thank you, Prashant. India's IPO pipeline is heating up, with over 5 lakh crore in offerings set to hit markets in the next 3 to 5 years as PE and VC investors seek exits. While listed companies may want to raise more growth capital, promoters of unlisted companies may want to tap the capital markets as well. So can bankers really marry promoter dreams with investor expectations? To take this question forward, I would like to now invite on stage Anuj Singhal, CNBC Avaz, and Ashwin Mohan from Moneycontrol on stage. And to help us decode all of this, our panelists for this section are going to be Rahul Saraf, Head Investment, Bank City, GV Ravishankar, MD, Peak 15, Sarthak Mishra, Partner, SoftBank, and Jimmy Jacob, MD and Head of Equity Capital Markets, Jefferies, India.
Hello. An IPO is like a negotiated transaction. The seller chooses when to become public, and it's unlikely to be a time that is favorable to you. Famous words from none other than the Oracle of Omaha, Warren Buffett. On that cautionary note, let me welcome you all to this very exciting IPO panel at the first edition of the Moneycontrol Global Wealth Summit. I'm Ashwin Mohan, joined by my co-moderator, Anuj Singhal, and over the course of the next half an hour, we will try and dissect the 5 lakh crore IPO opportunity in India. Let's quickly set the stage over here. Last year, there were 337 IPOs in India, both on the mainframe and the other exchange. India rose to the top in IPO volumes for the first time, marching well ahead of the US, 2.5 times that of Europe. $19.9 billion, those are the IPO proceeds, the biggest from India in over 2 decades globally. That's as per the EY Global IPO report. And therefore, Anuj will agree with me, it's no surprise that we are sitting here with this very exciting panel from the advisory world as well as the world of investors. Let's quickly dive in with my first question to Rahul of Citi. Rahul, a very, very exciting pipeline of IPOs ahead of us in this year. We are looking at billion-dollar IPOs across various sectors, whether it's Tata Capital, whether it's Lenskart, whether it's Temasek-led Manipal hospitals. All big deals, but isn't it time for a reality check as well? Because if you look at the data, there are around 26 companies that have got their approval from the market regulator SEBI between April to the end of December to launch their IPOs, but none of them have launched as of March 3rd. So there seems to be a bit of trepidation in the markets. Blame it on tariff wars, blame it on FII sell-offs. So what's your take right now? Because many of us over here have discussed that towards the end of 2024, we all thought that 2025 will be an even bigger year. Do you still subscribe to that view, Rahul?
Well, I'm a banker, eternal optimist. Banker, eternal optimist. I think 2025 could be a bigger year. We have, in the IPO pipeline you talked about, there are about 1.5 lakh crores of pipeline which is already there. Mandated, soft mandated, likely to be mandated in the next 12 months. Question is about market and timing. The good thing is a lot of these IPOs
Rahul, can you please hold the mic closer?
Sorry. Yeah. The good thing is a lot of these IPOs are likely to be offer for sales. So the business doesn't need capital immediately. So the issuers can time the market. And if there's a market which is soft, which is what it is today, people have the luxury and the flexibility to defer it by 3 months or 6 months if they need to.
Okay, at this point, it's also important to point out that while the IPO frenzy looked good, it's now looking quite bad, Ashwin. I was just looking at the data. 70% of the issues of 2024 are below their listing price, and 45% issues are below the IPO price itself.
It's an end to the frothy era.
Absolutely. I have a question for Mr. Ravi Shankar. Since Peak XV has managed to sell a lot of investments at peak, partially exit, a case in point being Mamaearth or Honasa. Do you think we have reached a stage where IPOs, since we say that IPOs are in 4 stages, good IPOs at good price, good IPOs at bad price, and bad IPOs at bad price, and then bad IPOs at bad price. Did we reach a stage where a lot of good IPOs came at bad price, and did that actually hurt the market?
First, thank you for having me here. At Peak 15, we've had the privilege of seeing maybe over 30 IPOs in the last, 19 odd years we've been doing this, and maybe 16 in the last 5. So I can tell you, this is more art than science, unfortunately. I've been in IPO situations where bankers and advisors have pitched a certain price. We all believe that would be fair price, and then 6 months later, as markets correct, you're IPOing at 50% the price and barely making it. I've been in one such IPO, and then to see that same company over the next 2 years double the price. So these are journeys that are very hard to call. But I would say one thing, we all as an industry, as private shareholders, need to appreciate that IPO is not necessarily the end goal. It's a milestone in the journey of a company. And so when you see it that way, then you stop thinking of it as the place you maximize everything. Because there have been situations, and we have been in companies where, we invested, but we were not the primary shareholder. And the IPOs were priced at a price where after 4 years, people have made no money. And it was very, very clear they were priced at the top. And, those decisions actually hurt sentiment of investors, retail shareholders, and others, when they're made like that. But we also need to know that everything is two sides. People are willingly buying. Nobody's thrusting anything. IPOs should fail if the price is wrong. So I do think it's a bit of a sentiment issue. You would not find that happen this year. For example, I don't think there is a way to maximize price in an environment like this. So I think these are cycles, but you're right. I think there are good IPOs at bad prices, and we should be watchful of that. And it's in everybody's interest to educate what the right way to do this is, which is long-term sustainable.
Right. The lens, I think, will definitely be on pricing discipline. I'll quickly get in Gibi over here. Gibi, so you've been part of the syndicate of bankers for IPOs that were launched in varying market conditions, right? So you were part of the syndicate for Vishal Megamart, which launched last year, saw stellar returns for its private equity investors. You are also part of the syndicate for Dr. Agarwal's, which was launched during a rather volatile and choppy market scenario. If you look at the optimism with which 2024 ended, the last 2 months have changed quite a lot. What are some of the big key needle movers on the ground that you are seeing as an iBanker?
Yeah, I think first and foremost, what you have to realize is IPO, kind of feeds on what is happening in the secondary market. It's more of a product that feeds on with the sentiment. While 2024 was great, I think just to give you some examples, from 2019 to 23, India saw around 15 $1 billion deals across IPOs, QIPs, and blocks. 2024 alone, we saw 11 deals, right? So, of course, it was the result of how the market was behaving at that point of time. Right now, I think as we see, where the market is, I think first 3 months, we are around 8 to 9 IPOs on the main board, raising around $1.8 billion. Of course, 24 is a very tall ask of $20-odd billion. Do we see 25 crossing that? Unless the market rebounds very quickly, might be a bit of a tough ask. But I think the encouraging part is in the last, say, 2 months, when the market has been bad, we have seen situations where more than 9+ companies have awarded $1 billion+ IPOs, right? So the issuers are not slowing down. We do expect that we are maybe, if just kind of touch the bottom or nearing bottom, things will quickly revive from here on.
Okay, coming to Sarthak now, and you've been a pioneer in terms of startup IPOs, a lot of them. The word doing the round right now is that at the start, the startup promoters have a vision and investors have the money. By the end of the cycle, it's the other way around. Going by the recent price fall that we've seen, of course, we're all talking about the current market in which the market's not been charitable to anyone. But what's your sense about the startups coming for IPOs? This year we'll perhaps have Zepto as well come into the market after seeing the success of Zomato and Swiggy. Your thoughts?
So look, I think I don't maybe have as much experience as these gentlemen, but I started my career around the summer where Facebook went public. And this was the summer of 2012, and I was a early banker in Silicon Valley, and Facebook went public at 100 billion and then quickly collapsed to half from there. There were companies like Groupon and Zynga, where some people may not have heard in the audience, that had market caps of 15-odd billion. And that summer, no IPO happened. There were 15 or 18 companies that were supposed to go public that summer, and they didn't go public. That memory is quite fresh for me, and so I wouldn't be surprised if we have something similar for a period, and I think that's totally fine. I think if you had taken that basket of companies and invested in that basket of companies, I think you'd be very happy with how that has played out today, 10, 12, 15 years later. So I think we all look for the excitement, hope for the excitement that things will happen in a quarter, 2 quarters, but like GV was saying, this is a very, very long journey.
Right. So Peak 15, GV, you guys have been around for a long time, for almost 2 decades, backed about 30 IPOs and around 15 or 16 of them in the last 5 years. So very active player in the VC ecosystem. My question to you is, how has the game plan changed when it comes to valuing new age companies? That's something that the audience would like to know. Also because I keep hearing this constant refrain that nowadays there are startup founders who are ensuring that we leave something on the table for investors. And correct me if I'm wrong, gone are the days when one would expect an IPO to be priced at a significant multiple over the last funding round. I think that mathematic has gone out of the window. We have seen IPOs which have been launched at flattish valuation, perhaps in some cases even slightly lower than the last round. So valuation of new age businesses, what are some of the challenges that you're facing in this regard?
Yeah, I think in this regard, the private and the public markets work quite differently, right? So, as an early shareholder in a company, most times we enter a company when the economics is not fully proven, the growth rates are very high. So we're not investing for compounding, we are investing for a small probability that this company is a very large company, right? Which is a very different thing when you come to the public markets. When you invest in a company, you're hoping to compound your capital in that journey of a public company. And so the big difference when we think about private and public market valuations is people just look for different things, look for different return profiles. And the margin of error in public markets is much lower compared to how we model our private portfolios, right? So there's a huge difference. And increasingly, as more experience exists in the market of tech companies going public and how they do or don't do, I think founders are starting to understand that, look, the way to do this is not how you do this in the private markets. In the private markets, usually, maximum price is preferred, right? In the public markets, people are starting to think about, look, who will be the shareholders that will not dump my stock right after? How do I find the right long-term shareholder who can be a part of this journey? How do I make sure my IPO is seen as a successful IPO? Because after that, you have to live with the price on an everyday basis. Remember, as a private company, you have these marks once in 18 months, 24 months on what your business is worth. As a public company, you're seeing it every day, right? So very, very different journey. So I do think founders are starting to understand and accept that it is not about maximizing the price, and which is why I go back to saying it is a milestone, it's not a destination. And that milestone should go well, part of which is when you list, there should be a nice pop, and people should feel happy that the IPO did well.
Okay. And Rahul, I want to come in on this to Rahul. Then what's the role of the merchant banker in terms of choosing the anchor investors, or in terms of choosing the secondary investors? Because nowadays we see a lot of trepidation in the market when a lock-in is coming near. Everyone is getting afraid that a lock-in is near and these guys will come to sell. So now are you looking at the profile of investors, even if it means you need to tell the promoter that, look, we need to price this issue slightly lower than what you may have thought, but let's focus on the quality of investors more than just, look at the subscriptions or look at the pricing of the issue.
Yeah, so Anuj, that's the most critical thing in IPO. A lot of it is process, a lot of it is administrative piece, a lot of it is legal. But the real value that bankers provide is judgment on valuation, judgment on what's the positioning of the equity story, and choosing the anchor investors. And the anchor investors are extremely critical because they are not just large investors in the anchor book taking a call early, but they're also influencers. And also they are very, very important because they could have an interest in the main book, and they could have an interest in acquiring post-listing as well. So people who are going to be supporters, who are going to be rock steady in the book for a long period of time, longer period of time than most others, very important to have that investor class come in the anchor book. And like you said, allocate more to them, allocate judiciously to them. And even if it means a little bit lower on the price, we actually recommend very highly to actually have the right anchor investors in the book.
Rahul, I'm going to extend that point and also pose the same question to Jibi. Jibi, if you look at FII data, they have taken out more than 1 lakh crore this year in January and February, right? And incidentally, Chris Wood of Jefferies, your firm, he was also surprised at the massive sell-off in Indian equities. But on the other hand, the gap has been filled to a great extent by the DIIs. And that's the point that the SEBI chairperson too, earlier today, in his first public appearance at the Moneycontrol Global Wealth Summit, alluded to. So the DIIs are playing a major role. The question I want to ask you is, and don't give me a diplomatic answer over here, what is the mix right now as far as the anchor book is concerned? FIIs versus the DIIs. Are the mutual funds still playing a very, very critical role?
Yeah, I think very valid question. But I think if you just take a step back in the IPO process, you end up meeting around 200 to 300 odd investors, which is just not foreign investors, but also a good mass of local domestic investors, which is mutual fund insurance companies, right? And finally, as job as bankers is to kind of triangulate all the feedback and come to the right price. I think by regulation, 33% of what you allocate in an anchor book is reserved for mutual funds, right? So you can understand 1/3 of the book has to be minimum given to mutual funds. So that input on value is very crucial. So I would say it's a triangulation of all the feedback, not only of domestic investors, but also of foreign investors. On the FIs, selling on the secondary side, but if you just look at their primary investment, there is a bit of a rotation that has happened. Majority of them has kind of diluted their stake in listed entities and kind of come in to that same extent or close to that same extent in the primary markets. So what we are seeing is that FIs are equally important as domestic investors, but since there is 1/3 reservation, there is a lot of sanity in pricing. I don't agree with the comment that IPOs are getting priced wrongly. If you look at the top 20 IPOs, the median returns has been around 25-28%, which if you're getting the pricing wrong, it should be more to the negative, or if you're getting the pricing wrong on the other side, it should be popping like 50, 60, or maybe 100%, right? So I think the pricing is in our view, very reasonable. What is also happening is...
Jimmy, I want to come in on this. The problem is that, most of these IPOs are getting subscribed 100x or 200x. So, while you're comparing from the issue price, we should also be looking at from the returns from the listing price. I agree with your point that, most of the IPOs might be up from the issue price, but it may not mean a lot for secondary market investors who are trusting their money in a lot of these good quality IPOs. And over there, you'll find that a lot of issues are actually below issue price. Sorry to interrupt, but just wanted to make that.
I think, Anuj, you make a very valid point, right? So there are two price points. One is the IPO price, which is what I think as sellers and bankers we determine, and how it lists and who buys at that. You can't really control the return profile from there on. But if you just take a step back from the highs of the market on the secondary side, right, you saw market at around 5.5 trillion, and today it's 3.7 trillion, right? You saw a 30% destruction in value. So as the tide goes down, whether an IPO company or secondary listed, everything will come down. So I think singling out IPO alone as a big cause of value destruction is not right, is what I'm trying to say.
I think, just to add to that, Anuj, the primary markets or the IPO markets, the fundamental analysis is much more compared to liquidity flows and behavioral analysis. In secondary markets,
Rahul, you are very soft-spoken. You need to just keep the mic closer.
Yeah. I was saying that in the primary markets, the fundamental analysis that investors do is much higher as against the flows and liquidity driven price impact. And in the secondary markets, that liquidity driven price impact is much more. The behavioral piece is very, very active as well, which is the phenomenon across the world, but the secondary market is more active. And that has an impact in the secondary markets. Over a longer period of time, we think all of it evens out. So depending on what price points that you look at, what time frame that you look at, you'll find different answers.
Okay, Ashwin, I just have one follow-up here, because a distinction between primary and secondary market has been made. Sarthak, there was a lot of noise around the Paytm IPO, the Zomato IPO, and we had a lot of them come on air and say that we could have priced it higher, but we priced it actually lower. And after that, we saw the destruction in the secondary market. And after that, we have seen the promoters actually maybe take a lesson that secondary market works differently. And all of them are now talking about profitability, path to profitability. Do you think that has been a major shift in the last 2 or 3 years?
Look, I think absolutely cost of capital went up around the world, so that there was no other option but to say, look, capital has gotten expensive for me, so I have to make the most and take my existing capital as far as possible. And so the time from when some of these companies went public, capital was, the 10-year was at basically 0 or 1%. And today the 10-year is, let's say, at 4.5%, which has made the capital very, very expensive. And so I think all entrepreneurs around the market took a call to say, okay, look, how do we make our money work longer? And I think that's absolutely the prudent thing to do. I think tomorrow, if you took the cost of capital down further, like maybe there are in some pockets of AI where cost of capital today is very, very low, I think there you are seeing extreme willingness to invest for the long term, even today in a high capital cost market. So I think these are smart entrepreneurs who are looking to do the best allocation of capital, which is in some way a big part of their role as CEOs. And they are playing the game on the field, frankly. So I have a little bit more empathy for their situations, maybe, but that's how I see it.
Well, it's clearly a tough market out there, On that note, GV, let me rope you in. Over and above Mama Earth, you also floated Ixigo, Office. That was an IP which was a category creator of sorts. Taking off from what Anuj and the other panelists have spoken about, Give us a sense of what are some of the lessons that you've learned on the ground as a VC. And when I say lessons, I mean perhaps you could also allude to some of the mistakes that have perhaps been made, because those are the insights that the crowd would really like to sort of look at. And the second question would be, we spoke about the DII versus FII perspective. Has it now become almost mandatory for there to be a DII/mutual fund heavy anchor book to ensure a pop on the day one of listing? Or would that be an exaggeration?
No, our experience, and maybe I'll start with the second one first, is, look, DIIs have just become so much more important in the scheme of things. And honestly, they, in some sense, and maybe this is unpopular to say this, they control pricing to an extent because of this. You know you have to fill up a book. And there are now very, very large DIIs. And they can write a $100, $200, $300 million check in a single IPO to make it happen. And so they are kind of pushing very hard for a more attractive price and so on. So I do think, they've become very important in the scheme of things. And it's a good balance. It's not to say that is right or wrong. It's just a good balance.
Sorry to interrupt, but are you perhaps alluding that the DIIs are maybe in certain cases also, tightening the entire valuation expectations that perhaps the team would have originally started off with?
Yeah, I'm sure. Look, everybody wants, like, as a buyer, you want the lowest price, as a seller, you want the highest price. So everybody has to do their job well, and so they do a really good job. So they do a good job for all the, retail investors that they manage, right? So I again, no complaints about that. I do think they bring stability. They have a lot of liquidity now, and they are important stakeholders, right? So, by the way, that has been one of the learnings, that you have to have the right DIIs, participate in your story. And they also have much better, eyes on the ground, knowledge of what's going on, and it's
any mistakes from the Peak 15 experience that perhaps you'd like to share?
I mean, it's always
any learnings or challenges?
Always learning lots of mistakes. We've had companies that go public very early when, at a time we thought, okay, this size is enough. A company that's 500 crores, 1,000 crores revenue and somewhat profitable, and you take it out assuming that it's going to be a compounding journey for many years, only to realize that it prices at 2 or 3 or 4,000 crores and there's just no liquidity in the market. So when I say, milestone versus a destination, we've made the mistake of thinking this is a destination, when it goes public, we'll sell and go and so on, because we've served our time, only to realize that most things don't have liquidity at those prices. So what we've learned is, unless you can have companies that are valued maybe 2.5 billion, something in that range, there is not a lot of liquidity in these stocks. They are public companies, but like private companies just listed, not really traded that much, right? So that's a mistake. So.
Okay, Rahul, one question to you now. We have stopped discussing the government IPOs, the PSU IPOs, which was big in the last bull market. Now, of course, we have the new SEBI chief who's spent time at Deepam. Do you expect over the next 2 years, and the government has been lagging behind in its targets.
Disinvestment targets.
Disinvestment targets.
Yes.
Do you see some blockbuster government IPOs which could generate a lot of interest from the public?
The fees may not be that handsome.
Yeah, fees will not be anything. But
on a lighter vein.
No, I think what is most important is capital formation, ability for public investors to participate in good companies. A lot of the Maharatnas and Navratnas are already listed in the country. And government has actually had a program to sell down in those companies over a period of time, which we believe would continue to be the plan for the government. There are not too many large private companies, privately held companies by the government, which are not listed at this point. But from a government perspective, whether they have the resolve to continue to focus on further sell downs and own less of the PSUs, the answer is yes.
Anuj, let me rope in Jibi over here. Yeah. Rohit, Rahul, point taken. Jibi, last year there was a time, and this is during the IPO fervor, when, there were many M&A advisors and they were getting frustrated because many of their M&A mandates were being converted into IPOs. Yeah. Because the promoter said, hey, listen, I'm getting better valuations over there, so let's not go through the strategic process, let's hit the markets. In today's environment, Jibi, where a lot, like we all have discussed, has changed in the last 2 months, is there a reverse scenario going on? Are you seeing that? IPO aspirants perhaps looking at the M&A option? That's the first question. And very quickly, if you would like to weigh in on the entire tech IPO debate, what is the most important checklist factor when it comes to, say, a VC and a startup saying, right, guys, we are mature enough, let's go ahead and do this?
Yeah, maybe I'll take the second question first. I think what we are seeing as a fundamental shift is, earlier, maybe in 21, 22, we had companies which were talking about profitability in 3 to 5 years, wanting to do IPO. I think that narrative has changed. People are approaching or discussing IPOs when they are just about breaking even or turning profitable in 18 odd months. So I think profitability, as Anuj was also asking, is become the key monitorable. So that's been a big fundamental shift. We do believe that 25 and 26, you will see far more companies coming out from the new age bracket, approaching the public market, right? Really sizable ones. Couple of them has been already reported talking about IPOs. So that's a shift on the IPO part. Coming back to your first question, Ashwin, if I got the question right, you were talking about
I was talking about
M&A.
Yes.
Yeah.
Yes.
So yeah, I think as sellers, you keep all the optionality open. There are situations which turn from M&A to IPO and vice versa as well. I think since you have a very sophisticated set of investors or sellers there, they do recognize that markets moves in cycles. If you just take a quick snapshot of the overall IPOs, let's say 1,000 crores plus IPOs, you will see 78% of the IPOs had a private equity investor there, right? So these are companies very mature in their thinking.
Right.
And if I look at 2022, because that was one year which was difficult as 2025 started off to be, you had just 3 months which accounted for 60% of the entire IPO volume in India. All right, and still we saw close to $8 to $9 billion getting raised, 35 odd companies going public. So timing is everything. Is that what we're advising clients? And people, though they would be going ahead to file their DRHPs, don't take off the M&A options, depending on how the capital cap table is there.
Right. Anuj, one very quick point, and this is something from a retail investor's point of view. He spoke about the fact that a majority of the IPOs are PE-driven. There's also a concern that many of these issues are pure OFS.
I was about to come to
exactly.
that.
There's no growth capital.
The question I had in mind, and it's
Absolutely.
an open question.
Yes.
Any one of you can answer.
Yes.
I had an interview about 9 months back with Ramesh Damani. 9 months back or 7 or 8 months back.
Right.
He made a point that, he's afraid of the K-top. He said the Korean IPOs is coming into the market, and Hyundai came into the market not because they needed money, because it was an opportunity. A lot of this was opportunity capital. It was available for you. You just came into the market, you saw it, and you took it, and you took it home. Is that a fair criticism? Rahul, you want to answer that?
Yeah.
Given that a lot of them have been OFSs.
Rahul and team worked on the Hyundai IPO, so he's definitely going to take that one.
I think it's an extremely important point. While a lot of OFS is there, a lot of secondary sell down is there, but it's only because the company at that point in time doesn't need the money. But the purpose of the IPO is not to take some chips off the table because the valuations are rich. It's not because of opportunistic only. It is also because as a listed company, the company then gets the ability to think about investments, whether it's organic or inorganic, with the revised multiple or the traded multiple. In the home country, if you're trading at, let's say in an MNC IPO, home country you're trading at 5x, India you're trading at 15x or 20x, then your decisions in India will be based on, if you're listed, based on the 20x multiple, if it's organic capex or inorganic. That is very, very important for a strategic call to be taken by a multinational. And same for different conglomerates or other companies as well. Access to capital is very important.
You're defending Hyundai, that it was right in terms of its IPO.
But even for other companies, once you're listed, the access to capital at any point in time, with the traded multiple at that point, will allow you to make organic or inorganic decisions. And that flexibility is where the IPO comes in, not just taking some money off the table through OFS.
Right, guys, it's time now to wrap up. Very quickly, Sarthak, we haven't looked at the sectors. In your perspective, from the SoftBank lens, which are some of the hotter sectors where you foresee that there will be IPOs being launched in the tech space? Very quickly.
I think we've got a large set of consumer tech companies that are likely to come. I know we've got stockbroking companies that are coming, and I think big winners for GV and Peak here. We've got few in our portfolio as well. So I think it's a question, just a matter of time as pricing couple of quarters that we should see.
So consumer tech, GB, your list, top sectors to watch out for?
Yeah, I would say from an IPO perspective, new age and financials. You'll be surprised by, that you will see a uptick in financial IPOs in 25.
Right. GV, very quickly, your top picks?
Fintech.
Sorry?
Fintech.
Fintech. So fintech, consumer tech, financial services. With that, gentlemen and ladies, it's time to wrap up this very exciting panel. You've been a wonderful audience. I must thank my co-anchor, Anuj as well, and all the rest of the speakers from the advisory and the investing world Thank you so much.
Thank you.
Thank you.
All right, gentlemen, thank you so much for that. And all of you sitting in the audience right now, if you think you know markets, money and investments, you can put your knowledge to test now at the Moneycontrol Pro quiz. And you can also stand a chance to win exciting hampers. You can visit the Moneycontrol Pro booth now. With that, ladies and gentlemen, we will now take a break for lunch. Please join us for a delightful networking over lunch and recharge your sessions and insightful lineup after that. Also, we will resume after the break. Enjoy your meal. everyone. We hope you had a refreshing break. And as we dive back into the world of wealth creation and market opportunities, our next panel will explore how India's family offices are mastering the balance between capital safety and superior returns. Leading the next chat will be Chandra Arshikant from Moneycontrol. And let me bring in the panelists now. Rahul Goswami, co-founder and managing partner at Greenstone. Abhishek Lakshminarayan, strategic advisor, Sharp Ventures. Give them a hand of applause, please.
Good afternoon, everyone. Thank you, Sonal, for that. We've had such a news-packed day today, and what a morning it's been. SEBI chairman's first ever media appearance after taking charge, and he's made so many news points, and our post-lunch sessions will be as newsy, that much we can promise you, and we kick it off with family offices, which have been making news for all kinds of reasons in the last few weeks. But before that, I just want to, set some context here on the role of family offices in India. So, Abhishek and Rahul, I was going through a few data points, and Indian family offices today manage $30 billion in AUM across 300 family offices. That's a whopping number. And this is expected to reach $45 billion over the next 3 years. And, this is interesting as well. In 2024 alone, family offices contributed $9.6 billion to venture capital investments in Indian startups. For the longest time, the likes of Tiger Global and Alpha Wave, I think we were at the mercy of some of these hedge funds and foreign investors. But it's heartening to see so much of Indian money, rupee money, making its way back into the private and public markets. So I just want to get opening remarks from both of you, Rahul and Abhishek. You've worked with family offices for a very long time, on the role that they play today and how important they've become in terms of scale and scope. Rahul, you want to start?
Sure, thank you. So very interesting question. I guess I will touch on the point about the venture capital investments that have taken place. So I think this touches on a few different themes. The first is that clearly, the support that the family offices are providing in this ecosystem is beneficial for entrepreneurs, for startups, and allowing, emerging businesses to be able to access another pool of capital is obviously very encouraging. But I think another theme of this relates to the broader investment capability of the individuals who are making these investment decisions in family offices. So different family offices, at least from what I've observed, are at various points of their evolution. There are some that are extremely mature, who have been making investments, who have been building systems and processes, hiring professionals for a long period of time. And then there are some who have only recently...
Rahul, if you can hold the mic closer. Yeah.
Okay, thank you. And there are some who have only recently created, their wealth and their corpus. And I think that, there have been a lot of investments which have made maybe with less discipline. And, over the last few years, many of the venture capital funds have not returned capital. Many of these private startup investments have not been able to show the returns that maybe people anticipated. So while it's great, I think, for, the segment as a whole, I do think that there is an increasing amount of questioning that is happening internally within a lot of these family offices about that skill set and about ultimately what are the returns that are being generated through these investments.
Right. I'm going to come to the returns in a bit. But Abhishek, in the last decade, you've had the opportunity to work with multiple family offices, be it Catamaran, which is N.R. Narayan Murthy's family office. You're currently an advisor for Sharp, which is Harsh Mariwala's family office. And you also work with the Cipla family. So, between all these family offices, again, is there a uniform way in which they go about investing? How does the risk-return framework work for some of these family offices? How is it different from how a VC or a PE fund would operate?
Thank you, Chandra. So, yeah, they're very different. So one of the first things I say is every family office is different. Very idiosyncratic in the way we think of risk, we think of return. I mean, risk means so many things to different people, right? Risk for some people might mean permanent loss of capital. For some people, it might mean volatility. For others, it might mean reputational risk. So you actually really need to determine what risk means to a certain family to then discuss return in that context. And I've seen it in my own life, right? When I was at Catamaran, we had a certain notion of risk. When I came to Sharp, we have a very different notion of risk. So I think it's very, very important when you think of the family office landscape to think of what risk means in that context before you start thinking about return. I mean, I have multiple family offices looking at, small cap and mid cap managers and looking at their returns and saying, why can't we be that? But that's a very different risk profile that you're willing to take. So I think every return should be in the context of risk. Every family office is very idiosyncratic in that approach. So I think it's very, very important for entrepreneurs and sort of partners of family offices to understand where family offices are coming from. And also within the family office to have that conversation, because notions of risk, even within generations, are different, Chandra. The younger generation, the older generation, they view risk differently. So aligning that notion of risk and then discussing return in that context is very important.
Right. I want to touch upon what Rahul mentioned in terms of the returns that family offices have seen. How has it been for you, and how has it been for the landscape in general?
Well, I've had the privilege of working with family offices that have had wonderful returns. We've been in top decile in the various asset classes we've operated in. But I think this also comes with a degree of maturity that Rahul mentioned. It's about understanding that returns go through cycles. A lot of family offices today, unfortunately, haven't seen the bear cycle. So I'm a little bit concerned when they look at their returns over the last 4 or 5 years, they're going to get an awakening of sorts, right, as we go through the next cycle of returns.
I think everyone is getting an awakening of sorts in the current market.
But I think the family offices have great advantages, right? They have the ability to have long-term horizons. They have the ability to bring operational insight to investing. They have the ability to sort of leverage the synergies of the operating companies. And I think that has actually contributed to outsized returns in some cases. Like at Sharp, for example, we've had an incredibly successful direct-to-consumer portfolio. And I think part of that has come from discipline to sticking to our knitting, to sticking to something we really understand, and that we can have synergies from the Marico company. And I think it's really important if their family offices find what their differentiation is, you'll see outsized returns over time.
Right. Rahul?
Yeah, I guess I would just touch on a few points. The first is, I think what Abhishek also mentioned, which is when we say family, a family is not typically just one person. It's multiple people. And those people can be all from different, they're probably going to be different ages. And, the first point I would mention is that, at least in the DSP family office, there is a different mindset between, let's say, what my father-in-law's perspective is on, let's say, risk, which is highly calibrated towards capital preservation versus maybe what the younger generation is looking for, which is, long-term growth and more exposure to, let's say, equity. So the first is when we say family office, it's about, we think about it as one entity, but it's comprised of people. And these people have, different ages, and they might have different risk tolerances and different mindsets. So I think, there is an evolution that has to happen where the families themselves need to become, more sophisticated and mature and have an alignment on how they're going to approach, just something as simple as asset allocation. So I think that's just one theme that I would also highlight.
Right. And, again, how does one maintain discipline in making some of these decisions? You're not answerable to, external LPs. It's your wealth. So in that sense, you have more freedom. But again, what kind of discipline does it take? Are you roping in more professionals from the VC industry, PE industry? Structurally, how are things evolving as far as family offices are concerned?
So first comment is that this would differ depending on the family office. I think, Abhishek, to your point, every family office is different, and every family office might be at a different stage of their journey. Some are far more professional, and some are just becoming professional. I think when it comes to this particular point about discipline, at least from my observation, this is one of the critical risk areas that any family office should be aware about, and especially when it comes to family members making investment decisions. There's a certain skill set that was required to build the wealth in the first place, and there's a certain set of individuals or individual who was the primary driver of that wealth creation. But that skill set may or may not be transferable into how to manage wealth and investment allocation. And it is easy for family members to have that discretion and have that power to be able to drive decision making. And if you don't have the right accountability or the right discipline, then it won't, it is possible that mistakes can be made, and sometimes those mistakes may not be realized for many, many years. So I think that this point is something for all family offices to keep in mind and to think about how they're mitigating that risk. Just one comment I would make also about how I've thought about this is that, I come from a background which is focused on the clean energy space and sustainability. And I wanted to start using some of the family office capital to make investments in the space. But rather than doing it specifically through the family office only, we are doing it now through a private equity fund where we are also managing third-party capital. And as a result, it brings a certain degree of discipline because we are now accountable to those other investors as well. So I think there's different approaches that families can take, whether it's internal or working with other families. But this entire point of capability and accountability, I think, is very important to think about.
Right. So if I could just come in, I'm very grateful that family offices are professionalizing. People like me have jobs. And I think that's actually one of the hidden areas of risk, not being clear about where the circle of competence ends for a family office. And I think just bringing in professionals is actually a very, very important part of professionalizing, getting the family office right. Because you're really moving out of the echo chamber. Operating and investing are two different worlds. And I think family offices who recognize that are the ones that actually flourish.
Right. In the current market environment, what kind of opportunities are you looking at in the public markets and the private markets? Because, public markets have sort of taken a hit in the last few weeks, and there is still a lot of uncertainty because of the way the world is, and we don't know how the tariff wars are going to pan out. And, that usually also has a knock-on effect on private market valuations. People are already talking about new age companies deferring IPOs. In these circumstances, what are you all doing differently? Are you holding back from making commitments? Are you investing, more in safer instruments? How has your own investment strategy evolved because of the current market?
Right. I think part of the advantage we have is a real long-term horizon. So I think the short cycles of correction are actually opportunities for us to get more aggressive. So in some sense, when we see valuations correcting, we're kind of leaning into...
So this would be aggression in public or private market?
In both.
In both.
In both. Actually, we don't differentiate.
Because you have a 40% exposure to private
Yes,
market.
we're one of the more aggressive ones. We're actually, first of all, 100% equity. We're 60% public and 40% private. And when I say 40% to counterparts, they say 40%, that's a lot of risk. I think of it differently. That 40% is something we know really, really well. So I think the notion of if you know something really well, you're actually taking risk off the table is something that we believe. So we're leaning in. When you think of decadal opportunities, India's just getting started. So we're kind of putting more capital behind entrepreneurs that we believe have the stamina to stay. And I think for us, that's the most important aspect. Now, as we look through this correction, we lean into opportunities where we believe the entrepreneurs have the stamina to withstand the cycle. And they have the stamina to run these companies for 10 to 20 years, which is slightly different from 2-3 years ago. Where you said, okay, these guys are going to get here and maybe then that's a chance for an exit. But I think our horizon has changed. We're leaning in. And even on the public side, I think there are managers in our ecosystem who've done exceptionally well through multiple cycles, Chandra. So for us, it's about discovering and partnering with those managers who've seen the cycles of the market, who have still delivered alpha over multiple cycles, and partnering with them for the next phase of growth.
Right. Rahul?
So I think, what comes to mind is two themes. Circle of competence, which you mentioned, and long-term time horizon. So at least in the DSB family office, I think the focus has been on trying to identify and understand investment ideas and opportunities which are close to the circle of competence. And that might be, within the business itself, or it could also be relationships, integrity, trust, people that you know for a long period of time, founders that you believe in and have known for a long period of time, who you can back for a long-term time horizon. So again, circle of competence. And then secondly is that long-term time horizon piece, which is an advantage that that family offices in many cases should have. And in this case, to the point about, let's say, a market correction, or let's say even whether it's public or private, that is an opportunity to invest even more. And if you really believe in the business and that it'll be here in 10 years, then that's actually probably what the right call should be. And family offices who have that mindset, can then take advantage of those situations. And, because of the access to liquidity, or the requirement not to have liquidity, that can deliver outsized returns. So it just depends on the family office, but I'm only commenting from the DSB family office side, but circle of competence and long-term time horizon are guiding, I think, a lot of the decision-making right now.
Right. In the last couple of weeks, there's been a lot of discussion and conversation and debate about whether young business heirs are choosing investment over hands-on leadership. I think Mr. Uday Kotak spoke about how, the next generation wants to manage money and not create wealth. And I think Harsh Goenka also wrote about it in a column recently about how, they don't want to work in the trenches, get their hands dirty, but they would rather invest in the public and private markets. What's your own take?
So I hope you've also...
Is it an easy thing to do? Is it the easy way out for, India Inc. 2.0?
Definitely not. So I'll say two things. I hope you've read...
But that's because you told me now, only with family offices you have a good, well-paid job.
Apart from that bias, I'll say two things. I hope you've read Mr. Harsh Mariwala's response to the article.
Which
it came
he
on
wrote
Moneycontrol as
on
well.
Moneycontrol, that's right.
So I can promise you that Rishabh Mariwala, who's the principal of Sharp Ventures, does not have his feet up on the table. He works hard. He's a learner. He's constantly looking for ways to improve what he does. And he's constantly looking to be the best investment office in the country. So it's not about managing wealth and doing this easy. It's not an easy job. Delivering alpha over a long period of time, I can promise you, Chandra, is almost as hard, if not harder. I know that's a little bit controversial, to starting a company. So I completely disagree with the view that it's an easy job. It takes a lot of planning. It takes a lot of gumption. It takes a lot of courage. It takes a lot of humility. I've seen that in the families I've worked with. I disagree with that view. And I think it's a wonderful opportunity for operating families to give back to the ecosystem. Family offices also have this additional advantage of supporting first-time entrepreneurs.
Yeah.
And these first-time entrepreneurs, if they didn't have access to stalwarts like Mr. Murthy, like Mr. Harsh Mariwala, they're probably getting a sort of a leg up in their entrepreneurial journey. So I disagree with the view that it's an easy job. I've seen it at close quarters. I've seen it with the families that I work with. It takes a lot of courage. And I hope that India will see a boom of family offices because the next generation brings in a different appetite to risk, brings in a different notion, brings a different aspiration to the future. And I think all that's valuable for our entrepreneurial ecosystem.
And we've had a whole generation of unicorns that are backed by family offices.
Absolutely.
Rahul?
I think it comes down to the individual. I've read those articles and I can kind of see the validity in some of the points in both ways, but it's very hard to generalize about, all people who work in family offices. So, of course, there probably are some individuals who enjoy the lifestyle, maybe don't have the accounting or the discipline, accountability or the discipline, and some of those criticisms may be valid in those cases. But then there's the other side of it, which is, the example that you just mentioned, which is completely the opposite. And also, there are certain elements of managing a family office which are not glamorous, but are extremely valuable. So, interpersonal dynamics. Convincing some of these patriarchs to make an investment decision, to change their allocation strategy when they have so much control is not an easy job. Or figuring out, how you're going to succession plan. Somebody has children, somebody doesn't have children. Somebody's working in the family business, someone is not working in the family business. There's a lot of complexity here. And that does require effort and somebody who you can trust to balance these different considerations. Now, that may not be a public-facing value addition in terms of creating a business or making an investment, but that is a tremendous amount of value addition from a family perspective. So I think it comes down to the individual, and there's probably examples, both sides, but I don't think it's fair to say that anyone who's working in a family office is not
chilling and
value.
playing golf. Yeah. It's a lot of hard work. But on that note, I think we are out of time. So to sum up, 300 family offices in India today. Hopefully that number will keep growing and becoming a very strong engine of domestic capital. But on that note, Abhishek and Rahul, thank you very much for joining us at the Moneycontrol Global Wealth Summit. Thank you.
All right. Indian real estate investment trusts, or REITs as they're called, are emerging as a strong alternative to equities and debt, offering fresh opportunities for retail and institutional investors. With the real estate sector poised for substantial growth, REITs provide high liquidity, diversification, and access to premium commercial assets. And that's what the next panel is going to explore. Let me bring on Debashri Jaki of Moneycontrol to moderate this discussion. And the panelists will be Alok Agarwal, MD and CEO Brookfield Properties, Ritvik Bhattacharjee, CEO Embassy REIT, and Ramesh Nair, CEO Mindspace REIT.
Thank you, all of you, for joining us. It's a pleasure and a privilege, speaking to all, to the three biggest REITs of the country, all on the same platform. Just to set some context here, between the three of you, you have distributed more than 16,000 crore worth of dividends. Since the time you've been around, almost 5 years. So there's a slight, there's a question the market has. Why has the market cap not moved? Is it a lack of understanding for the product, or is there a hidden message? And what can be done to sort of, change that? Maybe I can start with Ramesh, and then both of you can also answer the same question.
Deb, one thing we should remember is the industry went through its worst possible period when everybody was working out of their homes. When vacancies were increasing, there was the SEZ challenge which was there. The SEZ tax holiday was done. But today you look at it, office absorption, which was at 22 million square feet back in 2020, has gone to 50 million square feet of net absorption. Work from office was 10% back then in 2020. Today that's reached 85%. We can see that interest rates, again, the outlook for the future is it's going to come down. We have seen the SEZ vacancy levels, which was a big problem post 2020 after the tax holiday got over. We started seeing that absorption pick up thanks to the government being proactive on the SEZ demarcation laws. So the worst is definitely behind us. Went through a challenging phase in 21, 22, and most of us listed in the 19, 20, 21 period. So that's the key to what went wrong then. And things can only look better going forward.
I wouldn't go to extreme of calling it wrong. I think, the acceptability takes certain amount of time. I think we are reaching that point of inflection. Alokji, you want to add to this answer?
Yeah. No, so I think Ramesh has covered it well, but something which I would like, to see is that if you see from last year, which is 2024, Q1 and Q2, on average, REITs are up by 20-25%. And let's not forget that COVID was once in a lifetime event when occupancies of, large institutional players went down from anything between, 95% plus to, early 80s. So COVID has played an important role, and as Ramesh said, there's a SEG reforms which are pending, interest rates were high. But what is important is to see what has happened from last 9 to 12 months. Occupancies have gone up from almost 80% to, early, maybe last end of 80s, high 80s, or around 90 or early 90s. So that's playing a big role. Leasing movement is back. Almost India is leasing 80 million square feet year on year. So that's back. GCs are doing great job. There are almost 100 GCs we are having. Every year they are opening their offices. SEG reforms have happened. So we only see the way up. and the best of times for REITs are there for, I would say, short, medium, and long term. So REIT story is really unfolding, I would say, in India.
Right. No, so I think with your operating performance, I don't think anybody has a problem. Everybody agrees that, you guys are doing well. Occupancy is going up. You're also innovating. But again, this is the whole question of, I was having a chat with Ritik yesterday. Should you look at REIT as a debt or an equity product? And if it at all, it's an equity product, which we both agree, how does the upside get captured?
Yeah, sure. I think fundamentally, there's always a lot of talk about, is it debt, is it equity? And I think people tend to look at, what an FD pays out and, is this more of a structured product? Just think of it as a high dividend paying stock, right? In real estate, where you get to own a fragment of world-class office space or a retail mall, and the REIT does all the management. It takes care of the properties, and it is bound to pay out distributions, the components of which vary. It can be dividends or whatever, but that's all you should think about. And on the cap table, you sit as equity. The REIT also borrows. The REIT borrows from the market and uses that to fund its operations, obviously leverages the capital markets as well to grow inorganically. You can buy assets, you can sort of recycle capital. But I think, that's the kind of discussion that we as an entire industry organization amongst the REITs are always sort of grappling with. We try and make sure that people have to understand that this is effectively high dividend paying equity. And I think the one thing that has sort of held the structure back a little bit is that while, number one, obviously we went through an existential crisis in the form of COVID. There was obviously the rate reversal that, put a lot of plans. But as Alok and Ramesh have pointed out, I think we're early stage in the commercial cycle right now, but unfortunately the distributions haven't sort of matched that. But right now we're looking at a period of pretty high growth, so that effectively should make the stocks re-rate. But keep it in perspective, right? At the end of the day, this is there are 4 REITs, one just filed today, world-class offices, world-class malls, 93,000 crores of market cap. We've distributed sort of over 20,000 crores through very, very volatile cycle. So there's a lot that this product has done to sort of put Indian commercial real estate on the map. And, I think we sort of tend to sort of downplay it a little bit more than we should.
From a investor's perspective, you have markets like US where I think 98% of the real estate market is REITs owned. India is what, 16 to, I think, less than 20%. So, the big question is, are there enough investable assets in the market? That's number one. And because we've seen with some of the big players, it's largely recycling of capital in many cases. Are there enough assets? If yes, the competition is only expected to grow among all of you, So how do you get control? That's one question. And are you also open to creating more greenfield assets? Because it also has a larger multiplier effect on the economy. Maybe Alokji can answer, and then Ramesh can also join.
Yeah. So I would. So good question. Today we have 3 office REITs and 1 retail REIT. Now, while, in terms of percentage, we are saying 75% is office, but office will continue to dominate because among 3 office REITs, we have 100 million square feet, and the retail REIT, we have about 10 to 12 million square feet. So when you talk about assets, I think we have, more office REITs are going to come. Retail REITs are also going to come. Both are getting more popular. We are going to have data center REITs. We can have hospital REITs. And if India, which is very, very early days, if we can have residential REITs, I think that can really add to the pool. But what I would like to say here is, see, now in India, we have 10% of real estate is in REITs, about 10 to 12%. If in US, it's about 98%. In Europe, it's about 50%. Now, in next 20 years, Indian economy is going to be about 20 to 25 trillion. And the real estate could be about 4 to 5 trillion, which is the present size of economy. So the real estate would grow, and the 10% which is in part of REITs could go up to 50%. So the REIT AUM can almost become more than 50 to 20 times, or even more in next 15 to 20 years. So that's a kind of a growth. I'm talking about macro level, but that's a kind of a growth we can expect. And of course, new assets will come up, new sectors will open. And REIT has very, very strong potential to grow over the next 15 to 20 years.
So Ramesh, what are the new drivers of growth for you, and where do you see the yields sort of eventually reaching if all these levels that Alokji spoke about, they want to start kind of showing effect?
So like Alok said, between the three of us, we are just around 100 million square feet. The total market already has a stock of around 830 million square feet. Close to 450 million square feet of that is single landlord, institutional owned, REIT owned kind of space. Every year the market is adding 50 million square feet. India today has become the office of the world. Office of the world, very important statement, like China is the factory of the world. Every year, like Alok said, there are hundreds of new global capability centers coming up. Even today, the last statistic I heard is out of the Forbes 2000 companies, only around 700 of them have a presence in India. All these 700 are growing today. Look at these large banks, HSBC or JP Morgan.
Yeah.
We're talking of huge numbers in terms of 30,000, 50,000, 60,000 people. Companies like Accenture have 300,000 employees in India.
No, I meant the office story is quite well known, right? Everybody understands that office is obviously here to stay. What are the new areas that you think is going to sort of, Ritik, if you can answer?
Yeah, I think to your question, for the structure to thrive, you need to have rent-generating assets, right? And the rent-generating assets have to be, in effect, long-dated assets that people are willing to pay the amount of rent that sustains distributions and distribution growth, right? And you think about the longest dated of these are effectively, if you take infrastructure, and that obviously has InVITs, office is the one that has thrived because you've got, to Ramesh's point, you've got GCCs and companies that find India to still be an incredibly attractive cost proposition from a rental perspective. If you're paying $1 per square foot on average in India versus call it 8 to 9 in Singapore, Manhattan, Hong Kong, and any other global cities, that's still very attractive. Now we can still use that at our cost of financing, be able to grow dividends. Now that's office, right? Then you have to look at other sectors. Could that happen in data centers where companies are with this evolution of AI, everything else, and obviously with quantum computing and just the entire tech stack expanding? That's obviously a natural sort of area but you've got to develop the scale. Where I think you will probably see a little bit more time for the sector to develop is things like warehousing, because again, rents are cheap. Now, if rents are really low, it's hard to sort of sit there and then sustain distributions in a manner that, allows a REIT to kind of flourish and make sure that you have sort of the growth that investors want. So, and particularly where you get into trouble, and I think where it'll take a longer time, is anytime there's a market cycle where your rents are at risk. And we did face that in the middle of COVID, but given the quality of the portfolio, because the rents were palatable for international companies, you survive. But any sector that's massively cyclical is going to have a tough time giving distributions, and that threatens the structure. So, but I think data centers, down the road, logistics, higher end value-added services will be sort of next to follow after office.
To be fair, it hasn't really fallen. I mean, it's been where it has been.
Yeah.
But Alokji, can you give us a sense of your conversations with investors? What kind of questions they're asking, especially as you look to raise more capital to grow, especially in a market like this, where there are so many external factors. What are the few fundamental questions that they're asking you?
So, of course, we have seen a sea change since last, I would say, 18 to 24 months. And while it took a lot of efforts to convince investors, and they had many questions, but today I think investors have realized that the story which is in making is panning out well. They have seen that, and let's appreciate. Then people thought that offices are dead. People are going to continue to work from home. Investors have realized that there's no substitute for offices, and we see panning out again and again. So today investors don't have a nervousness or kind of a uncertainty about the office viability or even the retail viability. Of course, new sectors will come up. So what they're understanding is how fast our occupancies can ramp up. That's something they want to understand. How fast the rentals can ramp up. What is the stickiness, or what is the kind of a long-term stay in terms of tenants? That's something they want to understand. They also want to understand, of course, they also focus on ESG. How the institutional players are going to implement the ESG norms. what's their long-term plans for achieving net zero, how they're going to be top of the game. So these are the questions they're asking, and they also want to understand. So they're convinced about they're all convinced about the growth, convinced about the story, how fast it can ramp up, how sustainable it is at peak. So today we are at, let's say, 89, 90%. Can we go 95%? Can we go 98%? Can our rentals keep going up? Can we keep inviting new and new tenants globally to India? So these are the questions they're asking nowadays.
Let me ask you a very basic question, Ramesh. Can we plan our retirement basis investment in REIT? You know, the whole dividend part of it, obviously, and at some point you would like to flip it. You know, I mean, like as it is with any real estate investment. You feel the yields are going to be only going up from here? What is the sense that you're getting?
So last year, January, if you had invested in our REIT, by end of the year, in spite of the world being in so much of turmoil and such a volatile market, you would have made close to 21-22% total returns. 5-6% as dividend distribution and around 15% price appreciation. I think REIT needs to be looked at as a long-term product. We are not going to give you 30%, 40% kind of returns. Neither will we give you 2%, 5% kind of returns. So if you're comfortable with a 10 to 14% total returns, I think plus the tax benefits, plus the diversification benefits which you get today, people like us, we have ventured into data centers. We're doing 5 data centers. We're doing 3 hotels, making it more mixed-use campuses. The management teams, the kind of management teams companies like Embassy, Brookfield, us have, like Alok spoke about, access to commercial real estate, all the headaches of commercial real estate being managed by solid top-class management teams. So there is so much of benefits one gets out of it. And you said this, Dave, today it's 2% of the market. And that can only kind of go up, right? Even from the listed space point of view, you're talking of just 10% of the real estate listing compared to a 98% in many Western countries, including US. So I think people need to take a long-term view, not get in for a 6-month speculation. There is not too much of trading.
It's not a short-term trade.
It's not a short-term
It's not a short-term trade. Among the 3 of you, Ritik can answer this. Which one should I invest? Please tell me, how are you differentiating?
Well, I'll put it this way, right? I think we all serve different geographies, and that's also one of the reasons why I think you should look at a basket, right? Of, Mindspace. First of all, let's just start with Embassy REIT, right? We were the first REIT to list, and we were the first REIT to list because we sort of had a dominant hold on India's biggest office market, which is Bangalore. And I think the quality of the assets obviously set the foundation, and we're blessed to have partners and, competitors like Brookfield and Mindspace and, in the market as well, all serving different geographies, all serving sort of different markets. So I think, it's really, and I'll put it this way, we have a share, and I think we should have sort of covered this, that the investor base is a mix of blue chip investors, global household names on the FII side, global household names on the domestic side, mutual funds, and the life insurers, and we've got sort of, between us have 2 lakh investors who hold multiple REITs. So my answer to that is you have to have a balanced portfolio that covers Indian commercial real estate pan-India.
Alokji, your answer?
So, okay, my answer is very, very simple. REITs is a great way to create passive income, and the question is not whether people should invest in REITs or they should invest equities like gold, like real estate. REIT is an integral part of a portfolio, and you can, all 4 REITs are great. You can invest in maybe mix of them. You can do in part of them. That doesn't matter. All are going to do phenomenally well, managed by, great developers, great asset managers. So that's not a question. You can decide in which to invest, but you have to invest in REITs. That's my...
No, I completely agree. I think there has been a huge trust deficit with the sector, and with the advent of players like yourself, I think that deficit has been addressed, So, I was just asking that question in jest, but I think all are equally good. Ramesh, what is your take? How do you differentiate it?
I would, if I had 100 rupees, I'll put 25 with the 3 of us and 25 each with the three of us, and the other 25 with the newly announced Blackstone Satwa REIT. I think everybody has their strengths. Like Ritik said, there is geography spreads, there is different types of asset classes, some people who play CBD, business parks, all that. So I would look at it from a mix of everybody. And they've just 2-3 points here. It's an extremely well regulated, tightly regulated, strictly regulated part of the industry, especially when you said people used to look at real estate with a lot of doubt. This is something which has come up extremely very high on reporting, very high on controls, very high on compliance, very high on governance, independent boards, reporting. We just can't make any mistake from a regulatory point of view. We're being watched very closely. So I think that should give comfort to the investors sitting here.
Thank you very much. I think we are almost out of time. Just closing remarks, anything that you would like to add, and then we'll quickly wrap this up.
Yeah, I'll be brief. Look, when we took this, we listed the first REIT in 2019, and I think it's completely changed the shape of commercial real estate in this country. I think we went around the planet, 4 times trying to convince people about why commercial real estate in India is unlike sort of the previous chapters of real estate. And I think we were able to do that. And I think we've opened up the asset class. I think it should be a part of every investor's portfolio. It's a long-term investment. It's not speculation. And I think it's here to stay and here to grow.
Absolutely. I think portfolio diversification is something that, need not be emphasized more. On that note, thank you very much, all of you, for joining us. We'll keep this conversation going on Moneycontrol. Thank you once again. Thanks a lot.
Thank you.
Debt, equity, we did gold and real estate. Now is it time to do crypto then? What does Donald Trump's second term mean for the crypto market's future? The Trump trade, as they were, has already sparked a surge in the crypto prices. But the burning question remains, does it have legs to become a mainstay asset class, or will it be relegated to a speculative bubble? Guiding this exciting discussion on how Indian investors should approach cryptos, let me have Chandra back on stage, please. And talking about it will be Sumit Gupta, co-founder and CEO of CoinDCX, Edul Patel, co-founder and CEO Mutrex, and Vikram Suburaj, CEO and co-founder of Coptis.
Good afternoon, everyone. It's, the interesting thing is all of us live in Bangalore, and I had to force the 3 of them to fly all the way down to Mumbai for this exciting discussion. And it's such a great day to get 3 of the biggest, founders of 3 of the biggest crypto exchanges in India. Because just this morning, there was news from the US that Donald Trump has signed an executive order to create a Bitcoin reserve and a strategic digital pile reserve for the US. He's also said that, the United States will become the crypto capital of the world. What does this mean for 3 entrepreneurs running a cryptocurrency exchange in India, where there is so much of volatility, there is so much of taxation, there is so much of uncertainty in terms of how you are perceived? Sumit, as the largest exchange, you might want to start.
Yeah, sure. I think obviously we are looking at it very positively. I'm very happy that all of these things are happening. I think the way I am looking at it, I think it directly signals a very clear shift in terms of thinking of the largest nation towards a very pro-crypto stance. So much so that people call Trump as the crypto president. Yeah, a lot of people call him that. And it's not just that. It's not like one incident, but I think even before the election, there were a lot of promises that were made, and people could question those promises, whether they'll be fulfilled or not. But since January of this year, we have seen many of them actually coming to life. And there are a lot of things that are promised, and I feel that they are going to create a ripple effect in many other countries globally, and the talk around regulations on crypto will be more common, similarly like how stock market was like 30 years back, and then regulations had to come in, and then we have seen one of the biggest rallies in the last few decades, right, in Indian stock market. I think crypto, the challenge is right now regulations. There's not enough clarity there, and I think this discussion will trigger a lot of other countries to also move towards giving regulatory clarity to its citizens. So I think I see this as a positive, and more importantly, a healthier step to build a healthier ecosystem.
Right. Edil, has this had a knock-on effect, in terms of the interest shown by investors in India? Are more people keen to learn about crypto, explore crypto? Because Donald Trump is talking about it, Elon Musk is talking about it, there have been, meme coins all over the place. How has that changed things here?
Well, of course. So I think, the crypto president has helped create lots of excitement, and more so from the perspective of acceptance, right? Like this thought process earlier was, okay, crypto might not be accepted by the US, so will it actually get accepted anywhere? But now that lens has changed completely. As a result, people's understanding has changed completely, and the thought process of how do I make it now a part of my portfolio, because now it's almost certain that it's never going to go anywhere. What has also happened is there is a more nuanced conversation that's happening, that Bitcoin has escaped most other crypto and it's become slightly separate. Stable coins have moved away from crypto and have become more around payments, and most other cryptocurrencies are still in this bucket as to figure out whether it's an asset, it's a security. But now those deeper conversations are happening, those nuanced conversations are happening. And we always said that crypto is neither an asset nor a currency nor a security, yet somehow all of this together. And now we can start seeing some of that breakage happen, different regulatory stances coming up across the board for them. And that's created a lot of excitement in individuals. So curiosity has grown. We've started to see more people come to our products like Learn with Mudrex, where people have started to get more information about crypto, get more nuanced understanding, and then go ahead from there.
Right. Vikram?
So definitely yes. At a point in time when they're searching for gold in Fort Knox, you're finding Bitcoin sitting there in their reserve. So it is great. Definitely a lot of people have started looking into the crypto ecosystem again. There was a lot of interest earlier as well, but there was a period in between because there was a bear market, prices were also being very volatile. A lot of people had put a pause on their crypto investment, but we're seeing a lot of interest coming back. Now, the other interesting factors during a point in time when other markets are worried about Donald Trump's tariffs and his actions, what he's going to do, we are the only ecosystem who is very happy with every single action he's doing. So as a matter of fact, there is a crypto summit that is going to happen tonight maybe.
Are any of you guys going for it?
We wish, but we had to attend yours,
This
session.
is more interesting.
Yeah, that's why we are here, So this has definitely, made a lot of heads turn. Not just retail, we are seeing also a lot of interest that are coming in from family offices who are trying to see if they can take an exposure in crypto as well. But yes, in India still, they are worried a bit about the regulatory front. But definitely a lot of people have started inquiring back again.
Right, that's an interesting point. Tell us more about this. So a lot of family offices in India are investing or are building a crypto portfolio abroad.
See, abroad, yes, it was already happening, especially when ETFs came in. A lot of family offices found it as a very good option to have an exposure to Bitcoin. Now, within India, though family offices have not invested in larger amounts, they're understanding the fact that this is an alternative asset. They should have some part of their portfolio. And it's not a bigger portfolio. They have not built it yet. But they started experimenting is what I've noticed.
Right. Let's, do a show of hands. How many of you have invested in crypto here? You can just raise your hands. Okay. How many of you would like to explore it as an asset class? Okay, still few. You guys have a lot of work to do. How many of you will never invest in crypto? Okay, not that many skeptics.
I think you should follow up with one question. How many of you think crypto is illegal in India?
How many of you think crypto is illegal in India? Wow, that's quite a sizable number, but it's
We're
actually
all mafias
not.
sitting here trying to
You
sell.
have a lot of work to do. But, following up on...
Just before you move ahead, guys, whoever thinks it's illegal, it's not. You can buy, sell, hold, trade crypto in India.
Okay. Maybe you can catch them offline for more details. But see, Sumit, this notion that it is illegal, it is frowned upon, also comes from what we've seen happen in India in the last couple of years, right? If you look at it from a taxation point of view, 30% plus 1% TDS. I mean, the government is not a fan of crypto, neither is the RBI. And you also had this whole WazirX hack in the last year, due to which many people lost money. So how does one really rebuild trust? You're talking about making this a mainstream investment, but how does one really rebuild trust for people to even look at crypto?
Yeah, I think that's a very important point and an issue that needs to be addressed. And I can very well imagine why, I was sensing the room, almost 1/3 of the people have invested, 1/3 have not, and 1/3 are not even planning to.
And 1/3 also think it's illegal.
Yeah, 1/3 also thinks it's illegal. So I think there is a lot of misconceptions around it, obviously. And in my opinion, the biggest, the most, the only way I've figured out so far, and that's something that I think about it day in and day out, right, is just awareness and education. When I talk to people on the ground, like 7 years back, there were discussions where people were like, oh, if I have crypto in my wallet, I'll be put behind bars, right? There were also discussions like that, but the world is moving very fast. One thing that...
But did you see this income tax notification or that circular a few days ago? That they are now going to scan your WhatsApp chats and emails for illegal
So
crypto.
pay tax, there's no problem. If you are paying 1% TDS, 30% tax, then what is the problem in buying Bitcoin, right? So at least there is no confusion now. So 3-4 years back, if you ask someone, there was no clarity in terms of like, how do I pay taxes on crypto? Just because it is not clearly explicitly mentioned, that doesn't mean there's no tax on crypto. But now at least there is. There is mention of crypto in you can declare that in your income tax returns. All of this is there. So it gives, there's enough and a lot of certainty out there. If someone is an investor in crypto, I agree the taxation is high, right? But the industry is also new, right? I hope that it will sort of get more rationalized in the coming future. But see, I have studied this industry for almost 8 years now. And I feel, and the more I read it, I was skeptical at once. There was, the so-called crypto president was skeptical in 2019. If you see, the technology is moving really fast. One thing that we cannot deny that the world 10 years back and the world now is very different. Things are moving digital. It's a digital asset class. And any investor should look at least having some understanding, like if not investment, understanding of how it works, why people value it. And then if it makes sense, have a small portfolio exposure to Bitcoin, if not all the 100 crypto, because not all of them are good, by the way. It's like, there are some blue chip stocks, similarly there are some blue chip cryptos, and I think it makes sense. I think taxation, all of that matters when you start thinking of it as like, I'll put like 50% of my investment there. I think 0.5%, 1% doesn't make a difference, but this thing is getting real. It was a fringe experiment 5 years back, 10 years back, done by a few tech geeks and hobbies, but now it's getting real. It's getting treated as a serious asset class, and that's the reason why we are all invited here.
just one thing, if the income tax starts scanning the WhatsApp, I think crypto is the last thing we'll have to be worried about, right?
Okay. Edil, in terms of the regulatory environment in India, has it improved? Is it the same? Is it going to become even more challenging? I mean, I have never seen any industry getting this excited about being taxed. But it's only the crypto guys who say, thank God we are taxed. That means, we are recognized in some form, we are in the tax net.
Yeah, I think Sumit touched upon this. 7 years ago, when at least we were starting this off, there was this notification that banned crypto for 4 years in India. And then that ban was overturned. And then it's almost like the asset class was formalized with a formal tax structure that gave this clarity, okay, this is how you treat gains. Post that, we had the FIU body coming up with creating a formalization of what policies, how do you track, what kind of onboarding processes should you have on your platform so that you can get the right kind of customers in. And effectively what I'm seeing is it's just progression from one to the other of improving clarity and improving understanding of what this industry is all about, who is supposed to participate, what are they supposed to do. And all of this has happened in 7 years. I think that's record time for any kind of regulatory movement, and I think a lot of that is purely driven from the fact that crypto is a global asset and it's not something that any one country can do in silos, right? Like we are seeing a very deep, detailed regulation and legislation come in force in Europe. We are seeing the US talk about clear stablecoin regulation now, as well as figuring out how crypto needs to be treated. And all of these have cascading effects all over. Because crypto is one of the only unique global asset classes out there, and any one country treating it in one different siloed way will not work. You have to have global consensus, and that's exactly what India also pushed for in the G20 summit, right? Like a year and a half ago, that there needs to be global consensus towards regulations, and I think the world is moving very fast towards it. So we are very excited with the progress that's happened. Progress is important. Not having progress, having uncertainty is bad. What we have now is more certainty. There is a clear understanding, and that is what is important. That's why I think all of us are cheering for that. There should be just more and more and more certainty.
Right. Vikram, if there were one or two factors that will help make cryptos go mainstream, apart from the overall perception that, US is going very aggressive, so it must be a good thing, a legal thing. What will it take for this industry to go from, 30 to 35 million users to maybe 50 million, 100 million, and so on?
Obviously, from a regulatory front, most of the people here who might think that, okay, is it a good asset to invest or not, the biggest topper has been, what is the regulatory recourse if something wrong happens?
Yeah.
What about consumer protection in this space? If consumer protection laws are being acted upon for crypto, that will be a first big mover that can happen. Frankly,
so who should be doing this? Should it come under SEBI? What should this
be? We are at this point like that kid that the parents are trying to choose whose favorite kid it is, right? In our sense, we are still finding out who our parent is here. It's pretty bad to say, but still. From the fact of investment right now, it's less than 2 to 3% of the crowd who might be invested now. Maybe when these regulations slowly start coming in, there could be 10 to 15% of the crowd who will be invested in. Now, we all came in maybe when the adoption was at 0.1%, and we all did well in starting companies in this space. From a consumer's point of view, it is more about at what adoption you want to get it. At the price range, is it like 50,000, 20,000? I think I came in when it was $100,000 or something. Now, that is from a consumer's point of view, at what point you want to enter and what comfort from a regulatory front it gives. For me, consumer protection is critical. Either it is from SEBI, RBI, or a third body, because it doesn't have a characteristic completely of a currency nor of a security. Right. So is it going to be either of them or a third body? It's still under debate, right? And it is not an easy problem. We also understand that it's not so easy to just go give it in the hands of SEBI and say, no, please take care of us. It's not really easy. The existing laws are not enough. We need new laws that have to be formed for us. Now, it is good to see a large country like US looks like they'll be taking a lead in this. That will become a good playground for us to see how it works out, how stablecoin regulations come out, so that we can enact it out here.
Right. So with the competitive landscape is also changing. So recently, Binance paid a fee to, FIU, and they are going to re-enter India. Coinbase is also going to come back. How is CoinDCX going to navigate this competitive environment, or for that matter, MudraX, Geotis, when you have global heavyweights like Binance and Coinbase, looking to take a slice of the India market? Because if you look at some of the big techs, it's the American companies that have kind of dominated that space. So do you think you can survive when there is a Binance and a Coinbase in the mix?
Yeah, we will not survive, we will win. And let them create the market, let them set the field. But eventually, Indian domestic players, 5-10 years down the line, will will have a dominant role to play in the system. And I'll tell you why. One, it's a very heavily, I believe it is going to, and I'll cover some of the points that Vikram also mentioned. I do believe there's going to be a heavily regulated industry, right? Eventually.
Yeah.
And when regulations are there, then it's not easy to operate. Only the long-term, seriously committed players essentially win the market. That's number one. Number two, if you look at the financial sector, which is the company in India, a foreign player, name 3 foreign players in India who have been able to have a significant market presence. None. None of the banks, foreign banks, have survived in India. None of the fintech players like Revolut have been able to gain a significant presence in India. The only exception is a company like Google Pay, who has some presence, and that too because of a lot of India angle. But otherwise, like if you look at the financial sector, it's very rare that global financial companies come to India and then get a number one position or a top dominant position. I believe that a lot of these players coming into India is good. I get excited that they will simplify life for us because they have 100 times more capital. They will fight on the regulation side. Otherwise, you will see like few of us fighting for regulations, requesting for regulations. That's good for the country. That's good for customers. But now we'll have more friends to be part of that journey. And I think that will set a nice playground, a healthier ecosystem for everyone. And then when things get tough, people who are committed will continue to build. People who are looking at India as just one of the many markets, they will eventually sort of not have that competitive advantage.
So
Between the two, who are you more worried about, Binance or Coinbase?
Who am I more worried about? If you ask me honestly, Binance. And not because they are large player. I think that's because, see, we want to play keeping the laws of the land in mind. And we want to be super compliant. We don't want to take any risk because this industry is going to build over next 10, 20, 30 years. From my experience of looking at some of these companies over last 7-8 years, I don't see Binance with that approach. And we have seen what happened in US and other countries. And that's something that I don't think are the right ways to build business, especially in something like crypto. We know what happened with WazirX, Binance and all of those things. So that's basically what worries me at times. But I think Coinbase, great player, compliant, if they are operating in a country, I'm sure they will respect the laws of the nation. They'll respect the laws, taxation and all of that. And I think they will invest more in the growth of the sector and not just about trading and buying and selling. Because I think a lot of people understand and misunderstand crypto with just as a investment. Just something that I will invest X rupees and then I'll increase it to Y rupees. And trading, I think that's a very small part of it. That's a very myopic view of looking at the industry. I think it's a large disruptive technology which should be looked at in a various dimensions and not just only buying and selling. So I feel that those companies like Coinbase are doing a lot more work in terms of the technology and not just about trading.
Right.
Yeah. So just to...
Quick 20 seconds and then we'll take...
Yeah, so I just wanted to add to both the questions that you said are actually fairly interconnected. What it takes to go from a small market to becoming a very large market is more players coming in. And more large players come in when there is more clarity, and that's exactly what we are seeing. The clarity is improving, which is prompting more and more larger global players to come in a market like India, which is already known to be a very large market, and then spend time, money, and people in educating the market and helping them understand what this asset class is about, and not only what it is from a perspective of investment, but also from the wider perspective that Sumit was talking about. I think the three questions that you said are very interrelated with each other.
Right. Last 25 seconds. I'm going to end by asking the three of you, what is your crypto portfolio? What do you have?
What's that?
What's there in your crypto portfolio?
I just do SIPs in Bitcoin. That's it. Like, I am a very straightforward Bitcoin
so
believer.
safe. SIPs in Bitcoins. Huh?
I'm all in on crypto. I don't have an equity portfolio or any other portfolio. So
all in on crypto?
Yeah. It's all in on crypto and my company Geotis.
Not hedging at all?
I hedge to a level that Bitcoin, Ethereum have split, but all in.
All in on crypto. Sumit?
Yeah, mine is like, I started like in terms of absolute dollar value, I've invested 10-20% in that range in crypto. Now it has gotten to 70-80%. And within that, in terms of overall liquid portfolio, and within that, I think 80% of that is in Bitcoin and Ethereum. And remaining 20% is in new dApps, new apps that are coming up, new protocols. And it's like investing, startup investing. So, I just play around with that 20%. But 80% is long-term stored in wallets, which I don't touch. I don't look at it. It's like a real estate investment that I will look at when my, after 5-10 years.
I can see everyone staring at us like crazy guys. What are they doing?
Great, but on that note, Sumit, Edil and Vikram, thank you very much for talking to us, and hopefully this will raise more awareness about crypto and also tell people that it's actually not illegal in India at this point. Tomorrow what will happen we do not know. But on that note, here's wishing you the best for your crypto ventures going forward. And thank you very much.
Thank you.
India's equity markets are at a critical juncture. Now, while systematic investment plans, SIPs, have fostered a disciplined long-term investing culture, the surge in derivatives trading raises concerns about speculation and risk. Now, how do we balance wealth creation with investor protection? The next panel will explore the evolving trends in equity participation and the role of FNOs and what it will take to deepen India's equity culture for sustainable long-term growth. Let me bring back on stage to moderate the session Mahalakshmi, and also requesting our panelists to join up now. Ashish Chauhan, MD and CEO NSE, Anant Narayan, whole-time member SEBI, Harsh Jain, co-founder and COO Grow, and DP Singh, the MD and joint CEO SBI Mutual Funds, to all be on stage, please.
Thank you so much. And I mean, this is the best panel on the equity market, stock market ecosystem in India that we could have ever imagined. The largest country, the largest broker who has the largest, retail accounts in the country, the largest mutual fund in the country, along with the regulator. So a big round of applause for people who really define the ecosystem in India. Thank you so much, gentlemen, for joining me on this very important panel. As we talk about various aspects of stock markets and wealth creation, I think the most important and the central piece is really how do we create this ecosystem, nurture it, take it forward in a way that we don't have accidents like we had in the past. Every time we had like 3 or 4 years of bull markets, we sort of retrace back because there was a scam or there was some mishap or the other. How do we ensure that that doesn't happen? Of course, accidents are bound to happen, but systemically, where are we? What are some of the fixes that we need, and what else do we need to make this place a really safe place for people to invest in and a great place for wealth creation? So before we get into that discussion, one thing that is being talked about in the market a lot today, it is in the news, is the latest consultation paper that SEBI has put out. I want to talk to you about that, Mr. Anant Narayanan. But before that, you put out a set of regulations related to index derivatives, the index derivative framework last year. Now you have seen that completely, play out. You have the full impact in the markets getting reflected. What is your take? Are you comfortable about this? And then the second question is, this latest consultation paper, what is the thought process?
No, thanks a lot, Mahalakshmi, and pleasure to be here in this very august panel. Happy Women's Day to you and to everybody here in this audience. As far as derivatives is concerned, look, SEBI's view towards derivatives is very clear. Whether it's derivatives, trading, market making, these are essential for price discovery, for market depth, for risk management, and therefore for capital creation. So make no mistake, we are for derivatives, we are for trading, and we are for depth in the market. What we found, and we did a lot of consultation on this over several months the last year, we had one specific concern about over trading in index options on expiry day, which we found was not really contributing to capital formation. On the contrary, there were serious concerns around investor protection, particularly small investor protection, as well as some issues around systemic stability. So we had to take steps, again with a lot of consultation. We received more than 60,000 responses to our consultation on FNO. And we took a series of 6 steps on October 1st, precisely to target over trading in index options on expiry. Now, as you mentioned, Mahalakshmi, between December, Jan and Feb, some of the impact of that has percolated in fact, into a large measure. Index options trading volumes have indeed come down. In fact, if I look at options volumes across index and single stocks, December, Jan, Feb this year compared to the last year, it's down by about 23%. Having said that, if I compare December, Jan, Feb of this year with 2 years ago, it's actually up by 15%. So it's more like a stabilization and rather than actually a complete steep drop. And the right thing to look at is probably the entire family of derivatives, which is across futures, options, single stocks, and indices. There, December, Jan, Feb, the volumes are down only about 11% year on year. And on 2 years basis, it's actually up by about 35%. Frankly, we are very happy with the outcome. This was on expected lines where trading in index options has come down, but without impacting the overall family of derivatives as a whole. So to that extent, I think we are on the right track and we are in no hurry to take any fresh steps to do anything on this matter at least.
Okay, we'll come back to what is the talk of the town with respect to the consultation paper. But before that, Mr. Chauhan, what is your take? Now you've seen 3 months after the last index derivative framework step was taken. Has the market found a new normal? Has the derivatives market found a new normal? Is this where we stabilize?
No, I think some of the measures are yet to come in play. I think one is coming in April, the peak during the day and all. So it's still not fully played out. And naturally, after April only, probably May, June, July, we'll be able to figure out. In the meantime, new interesting stuff is coming up that many exchanges have expressed their desire to start newer daily expiries. So it is possible that 1 or 2 exchanges are doing. Now you'll have probably 5 exchanges. It's possible that 6 might come up and say that now you need to have a Saturday trading also because they need to have a way, and then Sunday, and probably they might add for a, 8th exchange might ask for one more addition to the week in terms of the number of days. So whatever was the SEBI's perspective of reducing daily expiry, I don't think is going to be met if we continue to have multiple exchanges having expiries on different days. So for me, if you want to really remove that, you need to have one single day, whichever way. And then, but if your purpose is to have multiple, then probably you'll have 15, 20 days also being asked in a week.
Sure. I would like you to respond to that, but before that, let's also hear Harsh. Harsh, what is your take? Have we found a new normal? How much hit have you taken at Grow on trading volumes? What is the general feedback that you get from traders? What is your sense?
See, overall over trading and the people who are not supposed to do and participating is always a concern, and it's been a concern for us, and we work with the regulators and the exchanges to figure out how this should be moderated. And a lot of the consultation we participated and came up with along with the regulators. And we are seeing that there is a volume reduction, but I think if you see it a larger space, and for if you ask for growth specifically, I think out of the 2.5 crore investors, there are less than 1% who are doing only derivative trading. So there will be definitely some change for them, but at a larger, if people are diversifying and they're investing in mutual funds, they're investing in stocks, and they are doing derivatives. And as Sir also said, that there's a healthy role of each instrument in the system, and people are able to pick the instrument, and then they are able to diversify their behavior of investing and trading in that.
And how much trading volume hit have you taken at Grow?
No, so we represent whatever the exchange and the overall industry, we are just a representative. So we'll have the similar numbers on our platform also, what Sir mentioned just now.
Okay. Mr. Anand Narayanan, would you like to respond to what Mr. Chauhan is saying? I mean, this defeats, it seems like it will defeat the purpose that you wanted to achieve.
So very quickly, the regulatory intent, which is co-created with all the participants, including those on the dais here, is very clear. As I said, we did find it necessary to try and reduce the volumes on expiry day index options. By the way, as of January, the WFE data shows that even today, the total number of contracts that are traded in index options on NSE is at least around 40 times higher than the next best reporting exchange on WFE, which is Chicago Board Options Exchange. So which means the volumes are still fairly large in terms of number of contracts. Now, if it means multiple expiries coming in, look, we have said that we don't want multiple expiries, and we'll find a way with the ecosystem to figure out a way to rationalize the number of expiries. For those aspiring to bring out, the derivative contracts, other exchanges, etc., I think one principle we would like to see followed is you first develop a cash market. Make sure you have an underlying cash ecosystem before you come out and bring out derivatives. Derivatives for the sake of derivatives is probably not something which is entirely desirable as well. So I don't want to deal into hypotheticals. We'll see how things work out. We do things in a co-created fashion. And the intent is to ensure that the ecosystem is robust, is trusted, is not open to manipulation, investor protection is assured, and financial stability is assured so that capital formation can ensue.
Sure, please.
So this WFE framework, that is World Federation of Exchange, I sit on the board of that organization. And I'll tell you the issue is that our contract size is very small in derivatives, which is around 1/5 or 1/10 or sometimes 1/100th of what is there in Europe or US and other countries. In equities, we measure on the number of trades, which is again India has a very small per trade value. In derivatives, we are looking at probably less than $100 per trade value in options. So it's like comparing the watermelon with grapes, but how many grapes you counted versus how many watermelons you counted is how the WFE describes, because originally in Chicago, they used to trade on where the derivatives started trading heavily. They used to basically explain on the basis of number of contracts. That's why the measurement is a number of contracts. It's absolutely not even comparable. In terms of value, if you would see, India would be, today India is second largest, especially NSE, is second largest in equity number of trades also. But again, if you take value, we will be nowhere in the picture after, first till last year, China, both exchanges, Shanghai and Shenzhen were higher than NSE. This year, NSE is higher in equities, but number of trades only. Value-wise, again, we are nowhere in the picture. So sometimes people feel elated about having that kind of ranking of number one. Sometimes this, bad information gets into all our minds, but that cannot be decision-making parameters. The other side is also about having, on a single day, risk management concentration will happen. There are ways to manage concentration by having incentives on the early rollover and disincentives on the late rollover. So those are the things which are easy to, but if your purpose is to stop daily expiry, it is easy to do by one single day. And I just wanted everyone to be aware that those rankings, it's nice to feel number one, but it has no relevance in some ways.
Sorry. So, Mr. Narayanan, how do you want to respond to that, first of all? And secondly, you said you are happy to look at rationalizing expiries even further. What do you mean? Will you reduce it further? Will you make it one day for all?
The good news, Mahalakshmi, is the October measures that we took. We started the first consultation, if I remember, sometime in June. For 3-4 months, we were actually doing a lot of consultation. Even this one, the one that we've come out with, the second set of changes that we're proposing, the phase 2, has been done with several weeks and months of consultation. As a regulator, we have the luxury of seeing things how they pan out. As I said, we'll be very watchful of the incoming data. And our regulatory intent is very clear. Now, on the point that Ashish made about WFE, etc., he's absolutely right. But there are plenty of metrics which have shown that the size of our derivative markets, whichever way you measure it, whether through premium, through notional, through whichever way, or number of contracts, in relation to the market cap of our market has been extraordinarily high compared to global standards. That by itself is not good or bad. It's simply a reference point. Again, we go back to the starting point of why we said we have to take steps. In January 2023, we came out with a research which showed that 89% of all small investors actually lose money while trading in F&O. Thereafter, we updated that last year. It's around July, August, September of last year, where we updated and saw for the last 3 fiscal years, 93% of all small traders dealing in derivatives, in F&O particularly in index options, were losing money. Not only that, people who have lost money for 2 years in a row dealing in options continue to deal in the third year as well. As my fellow whole-time member, Mr. Ashwini Bhatia, once mentioned in a public event, options trading, particularly on expiry day, where you're in and out, 3-minute kind of transactions, was becoming a national pastime. And we had to use our time better for more productive purposes than for this. You know, people often tell us, don't throw the baby out with the bathwater when it comes to taking regulations, which is absolutely right. In fact, I have a board in my office which says Hippocratic oath, first do no harm. With the best of intent, we could start intervention and come out with, you know, things which make the patient worse. So we don't like intervening in innovation, etc. But we tried going down the path of disclosures. We tried going down the path of trying to tell people, you know, what the risks are. But when it comes to a level where the investor protection issue becomes very rampant, systemic stability issue becomes very rampant, the size of the open interest was going up right up to 3:15 in the afternoon. And if the first line of defense in terms of the first line regulators are not able to control that, then we have to step in and do our job. And we'll continue to do so. And we'll do it with complete consultation. We are not experts. We will learn from all of the entire ecosystem and take very, very thoughtful steps as we did last time. We proposed 7 steps. We finally took 6 steps. We changed and modified a lot of the steps based on the 60,000 amount of feedback that we got for our consultation paper.
Sure. So we will come back to, again, the talk of the town. But, Mr. Singh, you've been waiting patiently for a long time. I'm really, really sorry. But, you know, while there are all these concerns about derivatives trading, people losing money, etc., I think one absolutely remarkable leap that SBI Mutual Fund has taken is with respect to this Chota SIP, the 250 rupee SIP that you've launched, which is going to be distributed through SBI. And there are some cost concessions you've got from SBI, which has also made this possible. Please tell us what is your vision with respect to, you know, democratizing this SIP culture. Of course, it's as much as it sounds exciting, there are also this is also accompanied by certain risks in terms of, you know, how the product itself is sold. Are the risks told up front? People who are buying these, are they aware of, you know, the accompanying volatility and all of that? Please tell us about your vision and how is this getting percolated down to the customer.
Thank you, Mahalakshmi. Thank you very much. I know, actually, I've learned a lot from the three August panelists about this. And especially when the new asset class is coming, we need to know much more about this in the mutual fund also. So now coming back to your question, I think we are doing it very, very responsibly, and we try to take this capital creation to the bottom of the pyramid and the mid-level with people who have not been able to participate in the capital market. See, this 250 rupees, maybe is 250 rupees is just a symbolic thing. But the thing is, there are huge, when you look at the number of demat accounts and number of mutual fund investors, which is just 5 crores, which can be much, much more, because there's a huge society who has not yet been able to come into the market. And there were a whole lot of problems around, banking costs, and thanks to the regulators who participated in a co-creating manner, they brought down the cost by talking to so many people. And especially to SBI, who said proactively that we will not charge any transaction cost on this, because transaction cost is the biggest cost which is involved. We are very sure that we will be able to make it very, very big. This is just a start. Millions of people can join in, and more than 250 rupees. We are more excited about daily SIP of 250 rupees, because when we look at the budget where 12 lakh rupees is tax-free, a lot number of people in the tier 2, tier 3 towns who are just trading in cash, more number of amounts will be coming into the bank accounts, and with the help of UPI, with the lower cost, I think millions of new investors will come in, and this is all going to be DIY. We don't want to push it through distribution channels because the economics will not work. We want it to DIY mostly, and the people like Harsh and other players who are, especially those who are having the vendors accounts. So I think the daily SIP will become a rage in times to come.
Okay, wonderful. Harsh, you know, there were 3 disruptive changes with respect to the broking industry last year. One was the true to label, second, the index derivatives framework, and the one on referral partners. Now that there is how do you first of all view all of this? Obviously, it is all three of them has hit business, but tell us about how you have coped with that. Secondly, now that there is a change of guard at the top in SEBI, how would you view these? Will you go back to the regulator to reinstate some of these? What is the thought process?
Okay, so second question first. I think that nothing changes for us as a participant in the industry, and our our vision has always been: can we make investing in wealth building for people at large in India easy and in fact transparent? That's what we stand for, and that's what we've been doing. And I don't think anything changes for us the way we work with the regulators. We'll continue participative. We'll continue listening, and also continue abiding by whatever rules we form. I think the general for the general good for the country. So we'll continue doing that. On the three things you mentioned, just a brief history. We started in 2016 with mutual funds. 2020 we launched stocks. 2022 and 3 we launched derivatives on our platform. So I think our 2-3 years of experience with the derivatives is a little less for me to speak about a lot of things, how they've changed. But we don't work with any partners or referral at all. So I don't, unfortunately, have a very strong point of view on that also. And true to label, I think it's a fair change. And a lot of these things, it's not just, you mentioned 3, but I think we have seen a lot more during the last few years, and all of them have been in a way that either we are protecting the customer, investors in this case, or we are just making it more transparent for us to operate. And I'm sure and I'm very hopeful that they'll continue such changes happening, such improvements happening over the next few years also.
All right. Mr. Anant Narayanan, is this referral partner framework under review? This is what we get to hear.
I'm not the right person to answer that question. It doesn't really come under me.
Okay. Mr. Singh, back to you. There is one issue that is come to the fore. It's not that it was a non-issue earlier, but there is this heightened talk about, thematic funds, the proliferation of thematic funds. Once upon a time, the NFO incentives used to be huge. Now they've come down significantly. Even then, for most mutual funds, NFO seemed to be the way to, get a chunk of money or garner a large part of the AUM upfront. And in that interest, now that everybody has the basic menu in order, more and more thematic funds have been launched. Now, there is a risk, obviously, associated with that, because themes, only at mature stages of a theme is there appetite for, those themes, and there is an inherent risk in the sense that over a medium term, you may not be able to get the best returns. You might have suboptimal returns if you launch a fund at the top. How do you deal with it? Because I believe the industry and the regulator have been in conversation on this for quite some time. What is your own view, your house view? How do you deal with thematic funds? What is the industry view? And where are we on discussions with the regulator?
Of course, see, when market, especially when in the bull run and the market caps are going up, there are themes which have a sufficient universe of stocks, and that particular sector or particular theme is working. For example, we talk about the energy opportunities. And within energy opportunities, there are so many other subsectors, like you have this renewable energy, then distribution, then other spaces. And especially when, I'll tell you how we came out of this energy. We had a universe of the company where the market cap of those companies are almost 2,70,000 crores. Okay, and then we thought there can definitely be few good companies where we can create a portfolio of 5,000, 10,000 crores, and we can have, because when the sector is there, it's definitely a responsibility on mutual funds also to come out with a fund where we are investing on behalf of investors in a research-oriented atmosphere. And I think we did our job very, very well, and we were able to do it. But yes, there are few cases where the thematic funds are being launched just for the heck of gathering some AUM. But at least I will say that the responsible players, the credible players, they don't do that. If there's a case where a theme can play out, there can be a critical critical mass can be created, critical level can be created, but we have to limit. It cannot be unlimited. It cannot be 30,000-40,000 crore fund. This is maximum 1 billion fund. That depends upon whether it is 5% of the market cap of that thing or 10% of the market cap of thing. Because otherwise, an individual investor cannot get into this search. So it's a responsible kind of thematic funds.
But
which
there
we
will
have
be no limit on the number of thematic funds that a fund can launch. Is that not something that is being contemplated?
No, that's there. But see, in Bulland it happens. We have seen that some of the themes which were very, very small and the people had to close the funds within 1 month of launching. So that is something which is something which you have to be very, very about. It should not be that there should be, again coming back to it, has to be a critical universe of that, the stocks, critical market cap of that theme which should play out. Only then. This is something which we have to work with. But definitely, coming back to your question, yes, there has been discussion with the regulators and people have taken it very, very healthy. And you have seen, in the last, even before the correction mode happened, the number of thematic funds came down drastically.
What is SEBI's thought process here, Mr. Narayan?
So again, I'm speaking on behalf of Amarjeet Singh, who looks at mutual funds. Look, our broad intent, I think the industry is doing a great job in terms of popularizing investment in a responsible manner. I think the engagement level between SEBI and AMFI and the mutual fund industry is going on well. I think our question, whether it's the broking, true to label, or whether it's things like the mutual fund, what we want is transparency. What we want is efficiency. What we want is that the interests of the client and the investor should be aligned with the interests of the producer, in this case the mutual fund. What we don't want is, mutual funds selling a particular product because they happen to earn through churn or through other means higher fees, which is not necessarily in the best interest of the investor. So as long as there's an alignment and a convergence of the interests of the two, of the buyer and the seller, frankly, we have no real role to play. So our entire theme is about transparency, efficiency, lower risk, suitability, appropriateness, and investor protection. As long as those principles are met, we are very happy with any solution that the industry can come with.
Sure. Ashish, one big change from the regulator side you would expect, which will strengthen markets even further from where we are. I mean, in terms of surveillance, in terms of everything, we are very smooth. Anything that you would expect?
Broadly, there are several types of risks which appear in the market. Some of them are what we call transactional risks, and some of them are long-term risk. And so in transactional risk also, we have centralized risk like clearing houses, and then a peripheral risk, which are individuals over trading and what Mr. Anant was saying, right? So there are each risk we need to measure and figure out, and then naturally the regulator's job is to also assess where the matrix is and how they want to kind of fine-tune the regulations to ensure that the risks don't overwhelm. And there are no dominoes, because sometimes the risk may arise in a corner in one place, and then its impact can be manifold in other corners. And that's where our regulators over 30 years have been very, very alert on a variety of things. And so for me, when things cool down, there are different ways of looking at things. And when things heat up, there are different ways of looking at things. So the arguments may also reverse because of the situation, right? So many of these things will continue to change, continue to evolve. The risks will emerge, which will have to be thought about, and things like that. So I don't see a magic pill which you take and for rest of your life or for next 50 years things will not happen. It will continue to evolve, and whatever SEBI has done over last 30 years or over last 5 years, in a way they may look tough at that point in time when they are imposed, but they actually make markets more safer. People's trust in that market become better, and so more and more people participate. So I recall in 1992, BSE used to trade 10,000 trades a day maximum. Today we trade sometimes 30 crore trades a day, right? So 30 crore is 300 million. And why is because of the tougher and tougher regulation. So I I fully kind of vouch for what has happened in terms of tougher regulations, and naturally the regulations have to be also true to label as much as, so whatever is evolved also has to be sort of ascribed or prescribed into the regulations.
Harsh, tell us one thing that you are doing at Grow to, promote this savings mindset or a longer term savings mindset. Like the mutual fund industry has done a great job with, SIPs. As a broking house, what are you gunning for? What is the messaging? How do you get across to customers?
So we invest a lot in the education, and I think the way, even if you see the mutual fund, right from the last few years, mutual fund Sahi, and then the digital infrastructure that the country saw, and then there's a lot of education, information, knowledge that has been spreading out to understand how the mutual fund industry works, how people can trust it and participate. In the last 5 years, 7 years, we've seen significant participation. So whether it is through the newsletters or through the educational content or through Q&As, question and answers, forums that we organize, we try to touch base with almost all the investors or the potential investors and try to answer their questions, make it easy for them to trust and understand. And especially on the point I think we discussed on the thematic and the risky products. I think if you look at across the data, and I was looking at our data, and there are less than 6% investors who are only invested in thematic. So thematic, yes, definitely it could be risk, but people start with one investment and then they graduate to second and the third, and they overall diversify. So I would say, like with a lot of confidence, that people who are investing right now with more visibility on the platforms or DIY, which is do-it-yourself kind of platform, they're far more aware about what they're investing, what risk they're taking, and they're able to diversify themselves. So that's the change we are trying to build, and we'll continue building on that.
Sure. Mr. Singh, one thing you're doing, of course, you're doing a number of things, including this Chota SIP, to ensure that, accidents are less, there is no mis-selling.
No. So that's as Harsh is saying, more and more education, more and more content on at every platform. And content has to be provided in such a manner that it is available to the last man on the site. It's not that putting on my website and saying I have done my education. That's not the case. The educating in a proper way, and I'm very, very happy to share with you, in spite of all this drawdown, the SIP amount, the number of SIP would have come down because of the small ticket size or the people who did it in DIY small ticket. But the overall amount has not come down, and people are still having faith. And my fund house, if we were writing 3,500 crores every month, today also, in this last month also, we got 3,500 day before. The growth which was there, 3-4% every month, that of course has come down a bit, but there's no this thing, and this is a global success story. And day before there was a Japanese delegation in our office to know about how SIPs are working in India, how they can do it. But the more than mutual fund, the digital infrastructure of the country is to be given heads up. Because of that, all this is happening. So education-wise, we are trying our level best that it reaches out. And by the way, by coming through SIP route, in any case, it's taken care of because of the rupee cost averaging. And I'm very happy that during this drawdown, people have really understood the value of rupee cost averaging. The education happens when it happens to one's portfolio. That is the best educating mode, and that has happened now. So now whatever little mis-selling would have happened will not happen now, because now people have understood that markets will come down also and go up also. People are not having this experience earlier.
Sure. Mr. Anant Narayanan, now you have to talk about something that everybody is anxious about, the latest consultation paper on F&Os that you have come out with. Please explain.
So I don't know, how much time do I have? You're already out of time, right? Yeah. So maybe we can do a separate session on this at some stage, if that helps. Okay. But, just to wind up, I guess, the theme that's being discussed right now, I can tell you what our immediate themes would be in the course of this, capital formation. One is, I think, a common theme which was expressed. I think we all recognize that investor education and investor awareness is going to be a cornerstone going forward. I want to compliment AMFI, I want to compliment the exchanges, the depositories that have done a great job so far of, investor education. But I think there's a lot of work to be done. And frankly, as regulators, we will have to start becoming a lot more active on this as well. One of the things that we're doing in SEBI is we are conducting this nationwide survey on two real objectives. It's a very widespread, several households across the country survey. One is to figure out what does it take to bring more people into the securities market ecosystem. What is holding them back? Is it awareness? Is it risk perception? Is it simply hubris? What is it? And second, most important part, what is the risk awareness of these people? And, what are the gaps as far as their understanding of risks are concerned? What are therefore the messages that need to go to them? And in what form, in what shape, and through what medium, in what language, etc. So both these aspects of getting more people into the fold, but ensuring responsible investing is the cornerstone of this survey, and that will hopefully inform the way in which we progress on investor education. Two other quick things that we're working on. The new chairperson of SEBI was here today on this stage. He mentioned that FPIs, we will look at seeing how much we can make life easier for them in terms of investing. A lot of work has happened. A lot of work can happen. While domestic savings, thanks to Mr. Singh and company, have really picked up, we still have the requirement for foreign savings to come in, and we will do what needs to be done to make the access really easy. The last bit I want to speak about, look, as the world changes with technology, with energy and all of that, I think startups and the value of people who are creating fresh business propositions is going to be super useful and super crucial. Making sure that funding reaches them is going to be essential. And you need people who are risk aware, who are risk responsible, who are risk capable to be able to fund that ecosystem. Which is where this, the chairperson also mentioned the AIF industry and the crucial part of the play to be played there. I'm personally hopeful that the accredited investor model picks up, and that becomes a way to channel funds from people who are risk aware, who are risk capable, into risky propositions and startups, so that we define the future rather than be following the future and reacting to it. I think that's going to be a crucial part of this capital formation story that we have to solve for.
On that note, thank you so much, gentlemen. That's all we have time for. In fact, we've overshot. But thank you so much. It was a very interesting discussion.
All right, India's economic resilience and consistent growth story has set us apart, and yet foreign investments largely flow through emerging market allocation, trying its fate to emerging markets peers like China and Russia, which have fallen off the global investors' radar. Now, given this, can India redefine itself as a standalone asset class, attracting global investors independent of the emerging market tag? I now call upon Surbhi Upadhyay of CNBC TV 18 to moderate and try and bring some answers to that very interesting question. Joining her on stage will be Ankur Gupta, Head Asia Pacific and Middle East, Brookfield Real Estate Group; Vishal Mahadevia, MD, Head of Asia Private Equity and Global Co-Head Financial Services, Warburg Pincus; and Miguelin Stena, Ambassador of Norway of India to India and Sri Lanka; and also Florian Nito, Head Investments Asia, Mandi. Ladies and gentlemen, let's give them a huge round of applause, requesting Surbhi and the rest of the panelists on stage now. Yeah.
Good evening, ladies and gentlemen. A packed audience and some really incredible inputs, insights on markets, on wealth, and of course the opportunity that India presents. Thank you so much for being with us through the course of the day. And now we come to a very, very interesting panel, and I'm extremely happy to host this one because it's that big question, the billion, or should I say billions of dollars of question about what are foreign investors thinking about India. Now, we know they've been leaving our shores, and it's been a very long spell. We're not quite used to it in the listed equity markets for sure. Selling off over $20 billion from September of 24 when the correction began. So what are the issues, and how is the foreign fraternity feeling about India? Listed markets, unlisted markets, real estate, private equity. What is the big global view on our markets here? Well, helping me to understand this, I have, of course, the experts right here with me. We have Ankur Gupta from Brookfields. He heads the Asia Pacific and the Middle East markets. Vishal, who's with us. Florian, who of course brings in the perspective from Amundi. Great to have you. And of course we have Ms. Stenner here, Ambassador Stenner, to tell us about Norway's interest in India as an investment destination. So it's usually ladies first, and also because we're celebrating Women's Day, I'm definitely going to start with the lady on the panel. So Ambassador, please tell us, what do you sort of see in India, and what is the potential that you would hope to explore in our country?
Well, thank you very much. Thank you for letting me speak first, and thank you for inviting me to be here as the only country representative. We are such a small country up in the north, so it's an honor to be here to talk about how we look at India. And of course, we are also asked because we are not only a small country, we are a quite rich country, and we can come back to that. But the big picture is Norway has both FDI and FPI investments in India. And India is a very interesting market for Norway for both types of investments. And there is no sign of capital retreat from any of these. The fund investments from Norway has tripled to India since 2020. Direct investments are also growing, and now particularly after we signed the Trade and Economic Partnership Agreement with the other EFTA countries and India last year. So we have about 130 Norwegian companies in India right now. That's about double of what it was 10 years ago, and it's growing. And trade between India and Norway has also doubled since 2018.
Okay, well, and you see more potential ahead. That's good to hear. Thank you very much for that. Vishal, if I could come to you now. You oversee all the action and so much of the action at Warburg. What's been the problem? Why this disenchantment with India to such an extent that we've got daily selling for the last so many calendar days that I've stopped counting?
So thanks, Surbi, and good to see everyone out here. I'll try to be succinct in my answer. So one, I don't think there's disenchantment towards India. We play primarily in the private markets. If you look at the private capital flowing into India, both private equity, and I'm sure Ankur will talk about real assets, there is huge amount of interest in India. It's not without its challenges, but in my last 20 years of investing in private equity in India, I can't remember a time when there was more interest from our investors to talk about investing in India. How can we do more? What can we do? What are the issues? Why are people taking money out? Why is there an outflow of FIIs primarily as you think about it? Look, you hear a few reasons. Valuation being top of the chart. People are going to book profits. People are going to think about where to go. And two, it's about how much return are you going to make from here, right? It's not what return you just made in the past or India is great and India can do phenomenally as a country. Doesn't mean investments in India will do well. There's a big difference in the two. And so I think as investors are looking at it, they look at it and they have multiple reasons. It could be tax, regulatory, other things that say, hey, the risk reward from this point on, that trade-off, may be more attractive in other places.
And I'm going to come back to each one of those issues and find out which is the one that's really hurting and where perhaps we need some action, maybe even on the regulatory front as well. Let me get to Ankur. Ankur, some perspective from you on how the real estate markets have been looking and whether this cool-off in listed equities, whether that's impacting sentiment on the real estate side.
Yeah, thank you again. Good afternoon to all of you. We just celebrated Brookfield's 15th year in India. And I would say that India is a market which will never have less volatility. But I would completely agree with Vishal that this is probably the best investment environment that we've had in India. Now, some part of it is relative. There is a certain amount of capital flow back to the US. Over the last 5 years, we benefited that capital has tried to form itself in India among the emerging economies that we used to get compared to. You can call it BRICS, you can call it emerging Asia, you can call it global south. But clearly, India is the leader of the global south. Capital needs to find its way into high growth, medium inflation economies like India. And talking about real assets, real estate, we are just in the first innings. As far as the stock market is concerned, people look at short duration. You have to rebalance your portfolio sometimes. Capital has to flow either to fortify your positions, or certain markets look very cheap. And public capital can flow in and out very fast. Private capital, the real capital formation, which forms a bedrock of an economic growth, certainly for a high growth country like India, which needs capital. How will the next $1 trillion come from in annual GDP? It has to come from real assets, from infrastructure, from construction, from real estate, from manufacturing. And that capital formation hasn't stopped in India. So while 20 billion of equities might have traded hands between FIIs or FPIs selling to domestics or somebody else, that's just capital trading hands at some valuation which makes sense for foreigners to sell and domestics to buy. But the capital formation, whether it's private capital, whether it's public equities, whether it's IPOs, I think that's really what we should focus on right now. India will never have less volatility. India should not have less volatility. We have much less than in the past. So in cricket analogy, I would say we are in the middle overs. We have to be okay with some maiden overs. We have to be okay with the singles and doubles. And as we always find that teams that control the middle overs usually are better off long term.
That's a great analogy given the match tomorrow, right? And as long as we get through the middle overs and get the winning runs by the end of it. Florian, now you folks manage over 2 trillion in assets around the world, right? That's a lot of money. So and you look at, of course, the Asia piece. When you look at the market like India, and I'm going to throw in everything, some of the challenges that, that Vishal also mentioned. Valuations, taxation, regulatory issues, registering over here, governance standards. How is India stacking up? And is there a pain point for you?
Yeah, thanks. Thanks for having us. It's a pleasure for Mooney to be here and our partner SBI. In general, what I could say is you have to take a step back. I have been meeting a lot of Indian investors over the last 2 days, and they are very concerned about the foreign flows, especially on the listed equity market, and saying, yeah, money is leaving 20 billion over the last 4 months, which is relatively large, but we have to take into consideration the amazing flows coming in the country over the last 5 years. So if you look into global portfolios, there is a high chance that you have a higher exposure to India, but to other big emerging countries, because it has been perceived as a structural stories. Then when you look into what are the concerns that may have been the reason why some foreign investors have been selling a bit some Indian equities of late. So one, there is a take profit. So why did investors take profit? First, I think there is not always due to India economy or India perspective. There is a global backdrop. We may come back on the US policies and how the geopolitical angle is currently impacting emerging economies and currencies. But if we look into India per se, you have a very strong growth in India. We are coming from an exceptional level of growth in 23 and early 24, and this has been cyclically coming down last year. Partially self-inflicted fiscal consolidation that was necessary, and as well RBI stay a bit on the sideline waiting for inflation to come back lower to make sure that when they become more accommodative, it will be because inflation has been coming back down. So I think the credibility has been enhanced. The fiscal consolidation is perceived as a necessary pain short term to make sure that the growth medium term is, I would say, more resilient. So on the valuation side, yes, India is more expensive than most emerging countries' equities, but this is a price you have to pay for growth. When you look into forward ROE, so return on equity, you have more than 15% in India. This is not something you can see in other big and large economies. So we would say that yes, valuation was a concern, take profit, a cyclical downturn, temporarily. We expect this year 6.5% of GDP growth in India. We do expect this is a new potential growth over the next 5 years, so it's a medium term. So there is a fantastic bright spot within the emerging economies. So we are coming back to India those days more tactically to reweight our overweight positioning in our portfolios.
Okay, I just want to, stress on that point on growth, and we love to be a little hard on ourselves. So when we talk about 6.5%, we don't like it, and slow growth, and there's a slowdown here. But the fact is, yes, earnings numbers kind of have been slowing down. Right now, how concerned about growth are you in India when you're looking at,
Yeah, we have actually no concern. We do believe that there will be reacceleration of the second half of this year. When you look at earnings were really high bar, I would say. So yes, revision has been negative over the last 6 months. 2 quarters of earnings from Indian companies have been a bit disappointing. The latest quarter has been actually showing a lot of bright spots. I think now we are looking at India and you have a more reasonable earning expectation. The consensus view is not far from a Amundi view. We are 13.5% expectation for earnings this year over the next 12 months for Indian economies. So in general, we are not concerned about growth. We do believe that some cyclical adjustments along a structural, very strong growth is necessary. And when you look at it from a global emerging market point of view, 6.5% GDP growth per year is just amazing. So we are very happy to be committed to India and to stay there.
Okay. I do see our good friend and our sort of frequent guest on TV, Samir, in the audience as well. And, tax is an issue that has come back to center stage. And maybe it's because the markets have been correcting. But I want to get this panel's sort of thoughts on the capital gains tax regime here in India. Now, whether it's listed equities, unlisted, whether it's private equity, whether it's real estate assets for that matter, whether this is a concern at all, because we've gone through an overhaul in the last 1 year. Some rates have gone up, some segments have been clubbed. But Vishal, as you look at taxation in India, I mean, are you fairly okay, sanguine, pleased, or is there an issue here that needs to be discussed and debated?
So, look, how do I put it? Investments and global flow of capital around the world has historically been more and more frictionless because you haven't had this concept of let's tax in each country any global capital that comes in. Over time, that has changed. I think the view we have taken, and I've heard many private investors take, is you want consistency of tax policy. Now remember, India is competing for global capital. As I sit outside India and as all of us on this panel sit outside, we have multiple places in the world to invest. And many of them have no tax on global capital when you come in. So when you do come into, it's not whether it's right or wrong. You want it to be consistent. And whatever we do, realize it does disadvantage us, right? Versus other places that don't have that. Having said that, India has to chart its own course. As an investor perspective, as I said, if it's consistent and we know what that is, we price it in. So someone pays the price for that, which is usually the Indian promoter, the Indian company, because we're going to price it in.
So I mean, what are you now implying? That are you, reasonasonably okay with the current status quo?
No, I'm implying that the Indian government and the finance minister has the right to do whatever they want in taxes. And what it does is it means we may be less competitive than other countries, and it gets priced in by investors. And I'm being very clear, I'm not one to tell folks what they should tax, but consistency of tax allows me to price it in my returns.
Do you
and what
find
I do.
that now, at least on the consistency piece, you think
I think it's been relative. I think it's been relatively that is not the reason as you look at it right now. Inconsistency on tax is not what you're seeing to in the last 6 months, in my opinion, because the tax has been relatively consistent. It went from 10 to 12.5%. I think public markets. Okay, that's not, in my opinion, that material.
All right, that's an interesting perspective, because when the markets were falling, there was a clamor saying, if you're making 15%, then the tax rate is 7.5%. Really, is it competitive enough? Is it attractive enough?
I don't want to hog it, but as you look at where the market's going, someone gave me a statistic, and someone may have said this earlier. You guys are all more market watchers than I am. The 3-year Nifty dollar return is what? 1%.
I was going to say single digits, but
1%, apparently. Now, I don't know. This is what someone was telling me. I haven't checked it. In the US, the S&P is going up 25% a year. So now, if you're a global investor, I just add it all together.
Currency, taxes, regulation. But Ambassador, your perspective in this, when we're talking about Norwegian investors, the companies looking to come into India, regulation, taxes, and currency, how do some of these factors sort of add up for Norwegian firms or investors?
Well, thank you so much. I mentioned also in the beginning that we just signed the Trade and Economic Partnership Agreement. These are the 4 EFTA countries. It's Switzerland, Iceland, Norway, and Liechtenstein. It's the first group of European countries to sign a free trade agreement with India. It's going to enter into force later this year. This is a framework for us and for Norwegian companies where we will see tolls going down. For example, on Norwegian salmon, which is now quite highly tolled into India, it will go down to 0 in 5 years. So Norwegian salmon will be cheaper. I hope that's good news for people here. But also, of course, this is good news for Norwegian businesses and those who are looking to India. And this is a framework where we are very happy to work within. I'm not saying there are not problems, and there are problems and challenges with the frameworks, with the bureaucratic processes here in India. But we also had asked Norwegian companies last year, and actually 61% of them are saying business climate here in India is good. 80% are saying it's profitable. 76% are expected to increase their revenue the coming year. 69% are planning to increase investments in the coming year. So it's quite optimistic, and we have seen that also earlier here today. It's a very steep growth curve along all the measures that you are seeing. And I also think I can, talking on behalf of Norway and Norwegian businesses, but also we see this in Europe generally, that we are looking to India. Also, there are, a little bit of a storm now. The EU wants their free trade treaty done. The UK wants it done. And these frameworks that we already have is something that will also create even more interest from Norway, certainly, I can say, but I believe also from the rest of Europe.
Okay, that sounds very promising. That sounds, it's good to hear. But just to complete this point before we move on and talk about other geopolitical and global issues, Ankur, you and then I want to ask Florian the same question, because currency depreciation and tax is going to eat away from your return. Where does India stack up with these two realities now?
Tax is an expense. It's an input cost in doing business. So if India wants to be competitive, there are 2 ways to do it. Either we make our profitability so much better that our revenue line item is much, much stronger, growing very well, terminal value of that growth is maintained and demonstrated, or we make our raw materials cheaper, or there's a competitive advantage. So, it all depends on what the finance minister and the finance ministry wants to ultimately make of the operating environment in the country. Operating environment is going to define the investing environment. It can't be the other way around. We cannot have investment-led growth in the country. We all know that investment-led growth without operating support will be short-lived. That's what creates bubbles. So tax is an expense, just like tariffs are going to be an expense in consumers' balance sheets, not necessarily corporates' balance sheets, which can be offset by higher trade volumes or can be offset by new trade routes. So for me, tax is simply an expense line item. If we are competitive, we don't need to lower taxes. If you're not competitive, tax is one way to lower your expenses as a country in general. It all depends on how the government wants to manage their balance sheets. And for us as investors, what we really want is consistency and not risk. Taxes are not a risk. Inconsistent taxation and policies are a risk. More than a risk, they are an uncertainty. So as long as we can be consistent, people can underwrite through it.
Saying as long as there's consistency, you simply price it in. Florian, what about you?
Yeah, well, I think when you look at bonds, let's move at listed bonds and Indian government bonds. It's interesting to see if you're a pure player, if you're an Asia bond investor, you will open India bonds and you will open your account. It will take time. You will do it. And just for everybody to know, when you have a coupon from an Indian government bond and you're a foreign investor, you have 15%. 1/5 of withholding tax. So it's something you have to take into account because carry of India is elevated compared to other countries, and it's still in the investment grade area. But you have this to take into account. When you're a global investor or when you're investing for a global sovereign fund, let's say you open a mandate and you will have a global asset allocation fund, it's very unusual for you to open a bank account in India bonds, despite the fact that you would like to try it out. Why? Because it will be relatively minimum in your global exposure, and two, because it's time consuming, you have some tax. So we notice that there is a lot of, I would say, inefficiency that are created. Investor or foreign investors are piling into SSA. So supranational, denominated and settled in dollar, that are actually mimicking what the India bond is doing, with one, not a perfect correlation, but the strong appeal is that there is no withholding tax. So I think this is something happening, and you see that those instruments are less liquid than Indian bonds, but at the end of the day, you can win 1 to 1.5% more in terms of coupon and carry on a yearly basis because you don't have tax. So this is something happening, and I think it's preventing foreign flows to come massively to Indian bonds market. So India government bonds, for example, but corporate in rupiah as well. Then if we take a step back, I think...
And equities, sorry, that was an example you gave from the bond market, but what about equities?
On the equity side, you still have it. So I was mentioning about earning growth. You have 13, 14% earning growth in mind. Yes, you have to take into account that you have capital gain tax there. So I think one of the possible solution going forward, the window of opportunity, is to potentially give incentive to committed investor, long-term investor, to have potentially a lower withholding tax as soon as you stay in the country for a long time. So if you are very tactical and you're trading India equity or India bonds, then yeah, you pay the tax and this is fine. Potentially if you're committed, you can pay slightly less. One point on the depreciation of the rupiah, because this is something as well you take into account when you manage a global portfolio. Most of the time it's in US dollar, or let's say it's in dollar or in euro or in developed currencies. So when you allocate capital to Indian assets, you need to take into account you have tax, but as well you have potentially a slight depreciation of the rupiah. On this one, we are a bit seeing this more positively of late, because the credibility of the RBI has been greatly enhanced, and the recent depreciation of the rupiah has been way more minimal than what we've seen in the past. So I think in terms of external vulnerabilities of India compared to, let's say, 5 or 10 years ago, India is in a much better place because the central banks has been increasing a lot the foreign exchange reserve they have. And the rupiah has been more stable as a result. So for us, we don't have a concern on this one. I think we are actually positive on rupiah, and we are overweight on rupiah in our portfolios.
Okay, so currency, not so much a concern. But taxation, that was an interesting thought that you said, that maybe some way of incentivizing longer-term investors into India versus, tactical short-term money that's moving in and out. What would you describe as long-term then? Where those incentives perhaps could be considered?
The thing I'm seeing is that when you are managing global portfolio, you don't ask yourself if you're going to invest in Indonesia bonds or in Malaysian bonds, while you're asking yourself if you will go through the road of India bonds, because you have to open the account, you have to pay the tax. So you have to take this into account, while it's not the case for... We were mentioning about you're in competition with to attract foreign flows. So I think long-term investor, for me, it's a one-year commitment. If you're here for 1 month, then it's fine to have the taxes. It's okay. You have to take this into account. If you're a long-term investor, you're committed to grow, and you're helping the corporates or the sovereign to raise assets, I think, and to raise money, I think it could make sense, but it's just an idea.
Well, we've discussed the issues, some of the outlier problems maybe, or the concerns, but it is what it is right now. This is the framework, right? So now I want to look ahead and talk about, realistically, even what do you see ahead for India? Say, over a year, 2 years, couple of years, or a 3-year perspective, in terms of attracting that foreign money, given the current framework and the global backdrop. There are tariff wars, there is who knows what's happening, which tariffs are breaking down, which are doubling. There is a lot of movement in the currency markets, a lot of different central bank moves. Japan is hiking, the Fed may cut. Given all of that, I want to ask this panel, what's the bottom line? Are we getting more foreign money or not? That's my simple question. And I don't know, anyone wants to start off with that? Okay.
I'm happy to start off again. Thank you so much. Let me just come back to where I started. Norway is a very small country, but we are a rich country. We are a rich country because we found...
Sovereign Wealth Fund of Norway, over $300 billion in assets.
We have the biggest sovereign wealth fund in the world. And this is because of these are the revenues from our oil and gas in the North Sea, and we decided that we wanted to spend this to safeguard wealth for the future generations. And then basically, what are the principles of this fund? It's to get the highest possible return for the future with an acceptable risk. It's a very conservative fund. I am not deciding anything. The Norwegian government is not. They are quite independent and independently run. But we can see what they are doing, and then they are quite conservative. But I already mentioned they have tripled their investments in India in the last 5 years, and I also think that that will continue with the growth rates that we have seen. And also, India is a democracy. It's a country that we as Norway talk very well with. We have very good relations. There is no prospects of any trade wars. We have the free trade agreement, as I mentioned. So that's why I think it will grow. It will grow on the foreign portfolio investments that the Sovereign Wealth Fund is looking at, although not decided. But I'm talking a lot also to Norwegian businesses on FDI. It's my task also as a Norwegian government representative, according to the free trade agreement, to promote investments into India. And they are saying that they are looking to India as a very interesting market now. And so that's why I believe it will grow.
Okay, again, fantastic news. And actually, the Indian government is also, in the Indian regulator, is very welcoming of sovereign wealth funds in general. I mean, a lot of our regulations are perhaps stricter for other categories of FPIs, but sovereign wealth funds, I mean, they're more than welcome in this country. So thank you for that perspective.
May I just say one more thing, and that is we also have another fund, government fund called Norfund. And we decided to have a climate investment part of it just 3 years ago. And about just more than half of that climate investment is being done in India. And why is that? It's because there are very high ambitions here from the government on green growth. And at the same time as there is a good climate, this is compared to other developing countries. And that's why they can invest in solar, wind, the grid, the green grid, and yeah.
Vishal, now we have to fight with US tech, and now we have to fight with Chinese tech. There's US exceptionalism. There's Japan. Now Germany is rearming, and maybe the economy starts, looking better. So we have to compete with a lot of people out there. How are we stacking up? How much money can we expect?
So look, I'll be very brief and quick, but I'll break it up into two parts. India should attract a ton of foreign global capital. There's just no question. Ask yourself, which economy in the world has the chance to be the next $10 trillion economy? Which economy? There's only one. Sorry, I'm not being biased. Really, if you ask anyone, it's really India. But because India can become a $10 trillion economy doesn't mean it will. And sitting outside India and looking at opportunities to invest across in different places now, despite my having spent so much time in India and my love for India, I have to say, there are other places to invest. So the opportunity doesn't mean it's destiny. And therefore, we have to be on our toes. I don't know whether it's tax, I don't know whether it's regulation, but I think if we are welcoming and realize, let's put out the red carpet because everyone else is. In an uncertain time, everybody wants global capital to flow in. And if we do that, I think there's just no question because everyone's looking to India. They just want to sign. They want to say, we are welcome, we feel welcome, we want to be there.
We've discussed tax and currency a fair bit. Regulation you mentioned, is there something outlined? Though, I mean, the regulators tell us that a lot has happened, easier KYC norms, etc., easier disclosure norms. But is there still something that needs to be addressed and resolved?
Look, I think we need to constantly get better. Our companies need to constantly get better. We at Warburg Pincus need to constantly get better because it's not a static world, right? So yes, we've done a great job, government, regulators, everything. Everyone can complain about small things, but everyone else is doing the same. So we got to keep on our toes is all I'm saying, because everyone's interested in India. There's great reasons to be interested in India, but we have to just keep staying ahead of the game to attract that capital.
Okay. Florian, so when you go back to office on Monday, how many $1 billion are you sending here?
No, I don't know yet. I need to think of the weekend. No, I think a good window of opportunity for India to attract even more capital is when you look at India from an external point of view, and potentially with the new geopolitical landscape, is that you have the China plus one policy. China plus one policy, India has been receiving a lot of flows, a lot of investment from companies, and new companies settled down here, but at the same time it's coming a lot from developed countries, less so from ASEAN, from China. What's potentially missing here? Well, you're going to India when you want to have service sector. On the service sector, the expansion in India has been massive. Now, when you look at manufacturing capabilities, labor-intensive manufacturing capabilities, I think India can do better. We have been seeing FDI coming in, but FDI can be higher as well. And I think the piece that can be enhanced is the manufacturing capabilities for India to have a larger percentage of the global supply chain. You have a lot of labor market here. You have a demographic dividend. A lot is informal still, so there is progress to be made over the next decades. But I think this is an area where India can position itself on the China plus one policy and reap a lot of FDI and investment from other companies.
On China, just a follow-up question over here, because we've seen so many stop and start sort of, tactical trades, if I could call it that, over the last 1 year or so, right? I mean, I think 3 last count. We seem to be in the midst of one as we speak. What is the view in terms of how real this is, and whether China will then therefore just naturally pull away perhaps a lot of capital that would have otherwise come to India?
On China, in China you need to remain invested or you will miss the rally, because the rally is happening in 2 weeks and then you're sleeping for 10 months. So in general, what we are seeing in China, and while we are getting more positive on China structurally, for now it's a tactical trade, it can become a sustainable rally in our view. One, I think everything is down to the earnings. Why US tech has been performing that much, maybe too much, while China tech has not been performing so far that fast. It's the case since the beginning of the year, but we don't have to forget the last 4 years. It's because of earnings delivery, guidance, capex investment. What we have been seeing of late and over the last 2-3 weeks is that Chinese companies are getting, from a top-down authorities point of view, a bit more message saying private markets is necessary. The crackdown is a bit behind us. When we are seeing some platform companies quoted in Hong Kong investing more than $50 billion in capex in cloud services over the next 3 years, we see that this is ambitious. And we have not seen that for a long time. Valuation point of view, even if China has been performing plus 25% year to date, still cheap. We are coming back to 10-year average. So you don't have a concern about re-ratings that is not coming from earnings at all. I think now earnings should deliver. NPC is this week. On the NPC, you have to expectation was relatively low. We got the message we want to hear, and I think the market has been reacting relatively positively. 5% around growth, inflation revised a bit down because we have issues on inflation in China currently. Fiscal deficit, if you look compared to last year, 2% increase of fiscal deficit if you incorporate bonds as well and special bonds. It's good. It's good, but it's not why you will invest more money to China. What we've seen from global investors so far is hedge fund has been coming back to take some tactical trades there, but global investors sitting in US or sitting in Europe have not been yet coming back to China.
Not yet.
The big flows we've seen is from mainland Chinese investors through southbound flows. If I give you just a number, southbound flows over the first 2 months of the year compared to the first 2 months of 24, 400% more flows coming from mainland investors in China investing in Chinese company quoted in Hong Kong. So the Chinese mainland investors are convinced that this is not a tactical trade, it's a more structural one. It's yet to be convinced on the global side, and I do believe that earnings is eventually at the bottom what will lead global investors to come back.
The optics have been very good this year, including that meeting with Chinese entrepreneurs. A lot of tech names also showed up, so that kind of builds some confidence for sure. Ankur, your thoughts? Real assets, hard assets here in India, whether it's real estate, infrastructure, what is the kind of interest they'll continue to perhaps generate in terms of foreign capital?
A lot of my fellow panelists talk about the large macro, whether it's China competing, China plus one, giving India the advantage. I think as I always say, we look at the macro, but what really matters for an investor is the micro, whether it's a particular company that has a specific growth plan, whether it's a sector that we like, whether it's a particular theme in the context of so many things, so many variables that make up our country. And I think we have to be very conscious of what is behind the 6.5% or 7% growth. What is behind the 4 to 5% inflation? these are macro trends over a population of 1.4 billion, over an economy that's $4 trillion, and at some point, hopefully soon, we'll be $10 trillion. So I think micro matters a lot more, which is where I think capital formation. Tomorrow stock markets can go very high, but if you see no IPOs, no QIPs, no new companies getting formed, then that would mean that there is a bubble, because then there is no underlying capital that's supporting that growth. So I think that particular aspect of real asset investing comes in. I'll give some context. The ratio to commercial real estate in the US to GDP is almost 1:1, which means investable commercial real estate in the US is about $20 trillion. In India, that number is less than $1 trillion, maybe, if I'm being generous, $500 billion. So if Vishal is right and we become a 10 trillion economy, then we'll have to go 20x. So 2x in our economy, or 2.5x in our economy, means that commercial real estate, which is offices, hotels, malls, all of the good stuff, and infrastructure, which will move from hopefully public hands to private hands, these will be 20x. So 2.5x in macro could result in a 20x change in the way micro investing in real assets itself could work. I think that is the real question. How will our savings move into investable classes of earning slightly better? Norway is investing in India because they want to earn a little bit more than more mature economies can offer to them. Investing in China could come back, but it will be a very long time before investor confidence in the macro comes back. So I'm linking it back to the micro and the macro. We can do a lot of missteps in macro. That can have a micro impact, but investor will always look at that particular situation, that particular company, maybe that particular sector. And that is very important for us.
This panel has been a great confidence booster, as we can hear all the panelists here. Every one of them has expressed the confidence that foreign interest is here to stay in India. I want to wrap up with a one-line answer from all the panelists before the applause starts. One line and no more. If your best friend calls you and says, hey, I think I want to invest in India, what would your answer be? Would it be yes, no? And where would you advise him or her or them to go out and invest? One line. Your best friend's calling you. Vishal?
Absolutely invest in India and invest in the Indian banks, because if India does well, its banks will do well.
Okay. Ambassador, any advice for your friend who wants to look at India?
Yes, of course. I would also say yes. I would say invest in the green energy sector, or maybe in the green maritime sector.
Okay. Ankur?
Invest in the real economy in India.
Okay. And Florian?
Yeah, I think I would say if you invest for the medium term, definitely go to India because growth is there. I think you should invest potentially in equity market. For now, large cap, I would say.
Now we can get the applause from the audience. Thank you so much, all of you, for your thoughts and inputs. Thank you.
Thank you to our panelists. Thank you, Surbhi. Now, moving on. Does India reward long-only investors, or is it the real money made by those who time trade in and out? Now, two of India's best market minds, Sameer Arora and Shankar Sharma, go head-to-head on the best way to play Indian equities. Drawing from their decades of market experience, the two investing veterans break down real-world payoffs of both strategies. I now request Mahalakshmi to come back on stage for this very fascinating chat that we hope to have. Sameer Arora and Shankar Sharma also on stage. Sameer Arora, founder, group CIO and fund manager, Helios Capital, and Shankar Sharma, founder, G Quant Investec.
Wow. This is going to be quite some panel. But before we start, Shankar, I was sitting next to Sameer, and since you didn't turn up, you just came about 30 seconds ago. He was saying, Darya aane nahi wala hai.
Oh, Sameer told me it's going to be a walkover. इतनी आसानी से थोड़े हार जाएंगे यार. पीछे देखो, कभी हारता नहीं है. फाइट मारता है.
तो अभी शुरुआत
I thought
he's
that
here.
I thought I got a walkover, but आ गया तो let's see now what happens.
नहीं वो डरा हुआ है.
But we may agree on many things now.
Yeah, when we thought about this this session, not bull versus bear, but is the bear market upon us or the bull market is alive? They were more divided than they perhaps are today. Is that true?
What is the question? That?
When we thought about this topic about bull versus bear, you
we
were
didn't,
perhaps
we didn't think about the topic. You thought about this topic.
okay. When I proposed the topic.
So the point is that first of all, how do I know his view?
Exactly.
So I don't know, but I believe broadly that he's bearish, but this is at a good time when the markets in US have already fallen a little bit and India has sort of not doing so badly. So maybe he agrees with me now more than I would have to agree with him.
नहीं तो before this we had a little chat and it is going to be like a WWE fight. सब fixed है.
Why
Fully
did you
fixed
reveal that
fight.
now?
It's a fixed
अभी तो
fight.
कोई सुनने नहीं वाला है.
सुनेंगे ना यार. We still go and watch WWE or not?
Okay. Tell me your bearish argument.
There is no bearish argument. I take strong exception to this. I have been bullish.
You wrote about it. You're
Correct. I'm coming to that. So I have been a table-thumping bull on small caps. If anybody has seen TV or read in the print in the last 4.5 years, very early in the trade, and it has worked out fantastically well. But I'm allowed to change my view, right?
Of course.
Right. So I changed my view sometime in the middle of last year when I realized that the bull market is now in the 5th year, and typically Indian bull markets have shelf life of around 5 years. वो हमारे इंडियन बुल है, वो अमेरिकन बुल 10 साल दौड़ता है, इंडियन बुल 5 साल दौड़ता है, give or take a few months here or there. And prior to that, if the bull has run very fast, as our small cap bull had run, which was 48% CAGR from the COVID time, so that bull is a tired bull. And a tired bull will fall at the slightest of hints of a trouble, while a young bull will jump over the trouble. That's why we say a bull market crosses the wall of worry. A tired bull, usko kuch bhi hoga, so it tends to then buckle. So my take was, I've been bullish 4.5 years, but I always believe markets are cyclical. The data proves it, and I still have investments in India, by the way, because they're unexitable, okay? That's the beauty of small caps that I've always...
Unexitable, so you're stuck.
It's not possible to exit ना. वो क्या T2T, GSM, ASM, ये MOM तो वो तो possible ही नहीं है. I'm hoping for the 2030 bull market resumption to be able to exit my stuck position. So whatever was saleable, I sold. Whatever is non-saleable has become private equity investment.
When did you sell? Whatever was saleable.
Between July and September, more or less, everything was that I could sell got sold. And that was it. But whatever is non-saleable, I'm still stuck with it. So I'm hoping that, Samir is right. The bull market starts from Monday.
I didn't say that. I'm not saying that. Okay, so my point against...
Tell me, first of all, about this, American bull versus Indian bull.
So I'm no longer bullish on US. We have a global fund in which till Jan and we were 99% invested. And now we have 73% cash. And that is because in middle of Feb, I've sold nearly everything, including all these Google, Amazon types also. Basically because I think US cannot handle so many things together, which is have tariffs, even if in the end he backs off on a few things, have Doge, have the removal or sending back immigrant labor or whatever, and also firing of government employees. And so there's too much confusion, but more than that, very high uncertainty. But my point just quickly against Mr. Shankar Sharma's convenient choosing of last 5 years is that if I make it 7 years instead of 5, it should not make a big difference. But you see the small cap return for 7 years will be below 10%. And even mid caps and large caps will be in the 13-12% type range, primarily because 18 and 19 were super bad. So if 2 years are very bad and then you have a bull run, then you can say that this is not a new bull run. Some of it is compensation for the previous problems. For example, in 2009, if the market goes up 70%, it is not because you are very bullish. It is because maybe the fall in 2008 was unjustified and therefore I never believe that markets predict the future. They are also compensating for the past. So other than 5 year, if you do 1 year, 3 year mid cap will look a little high. 7 year, 9 year, 11 year, 13 year, 15 year, 20 year, 25, they all look the same. But separately, I agree that you can't have a bull run. So my definition of bull run is twofold. One is I should do better than what other asset classes are doing, which means debt primarily. And second is broadly we should do plus minus better than other countries are doing. From that angle, it is still a bull run.
That is not exactly a bull run. A bull run essentially is that.
यार महालक्ष्मी अब करे क्या बेचारे दिल के खुश रखने में गाली भी है ख्याल अच्छा है
अगर कोई और चॉइस ही नहीं है
that's not a bull run.
किसी ब्राह्मण ने कहा है कि ये साल अच्छा है बस ये बोलते रहो यार
बुल रन का मतलब है कि what else could you have done with that
बुल
money?
रन बोल रहे हैं भाई साहब सुनिए लिक्विड फंड से %.5% ऊपर देंगे हम मोटा मोटी यही मेरे को समझ में आ रही है
वो भी पता नहीं
You should not regret कि I could have done something else. The domestic investor relative to his choices and the foreign investor relative to his choices. After that is all free money. All you want is कि nobody should have regret.
सर मैंने इतना कंफ्यूज आर्ग्यूमेंट बुल का आज तक नहीं सुना एटलीस्ट राकेश झुनझुन वाला ही वॉज अ बुल मीनिंग वो बुल ही था उसको और कुछ समझ में नहीं आती थी बात
बिग बुल था मैं बुल हूं
very convoluted bullish logic. At least I'm not able to get it, to be honest.
I'm also not able to get it, Samir. So this is how can that be a bull run if you get 0.5% more than
I didn't say
liquid or
0.5%
debt?
more.
You said slightly more.
No. I'm saying after obviously whatever rally. Now, as long as you don't feel that you should reduce equity in favor of something else, because broadly it has corrected or that relatively a 5-year number looks out of place, and his lake theory where you say water is filled.
Yeah, I'm coming to that.
I disagree with that because what if the first part of the water goes below the ground and into the ground and therefore doesn't fill the lake?
पाताल से ऊपर आ सकता है.
No, because वो इतना dry हो गया था 18-19 में.
Correct.
That the first round of water is only to compensate for the lost groundwater.
Yeah. So quickly in 2 minutes, please explain the lake return theory. You've written about it very beautifully in detail in Moneycontrol, but still for the benefit of some people who might not have read it, in 2 minutes.
Yeah. Okay. So in 2 minutes, basically that every asset class, whether it's traded, non-traded, has a finite amount of reserves in terms of returns. Correct. Like a lake. It's not a river or a sea, which is like fairly infinite. So, agar lake ki capacity is limited, and you know the data which tells you what this lake can deliver, the Indian lake has delivered 14-15% over a 25, 30, 40 year period. But that lake, by the way, has become in terms of the reservoir capacity less. It is now 10-11% because of a lowering of nominal GDP growth. So, apni lake ki capacity is about 10-12%, mota. That capacity is low when obviously we have a bear market, like we have 2018, 19, 20. In fact, 2015 to 20 was only 1% CAGR. By the way, it was a pretty barren patch, which means lake levels were low. COVID came, lake levels have shot up. Now that lake has given you water beyond its capacity, which was 48% CAGR. So now, wo bandh jo hai, dam hai, that was going to burst. I kind of figured that out in the middle of last year, ki bahut ho gaya. Considering 5 years of lake filling hua hai, time to at least lighten up. I lightened up, and you can see ki ab baadh aa gaya. It's a devastation, pralay hai. That is what an overflowing of the lake looks like, basically. Now this lake will dry up. Now it can dry up in 1 year, it can dry up in 5 years. Looking at the huge overcapacity of the water, I don't think it's going to getting over in 3 months.
Okay, so first of all,
You're raring to go, but I have a question just for understanding. What is the starting point for this lake return? What is the starting point? How do you say 5 years? Why not 7 years? Why not 9 years? Why not 10 years?
तो वो मैं फ्री में तो बताता नहीं हूँ. आपको सारी चीजें अब चाहिए कि मैं आऊं 15 मिनट में आपको सारा ज्ञान जो मेरे को लगे 30 साल.
This is a debate. You have to. ये नहीं बोल सकते कि भाई ये.
I'm not debating. You don't understand. It's not a debate.
No, you have to. You have to clarify
unlike my
what
dear
are you
friend
saying.
Samir, I'm not managing public money, so I don't have to debate this point of view with anybody. This is my point of view.
Explain.
Yeah, what I'm saying is that if you look at the history of bull markets in India, typically it's 4 to 6 year kind of duration. The only real exception I saw was in the early 80s, which was very infancy. बाकी छोड़ो तो मोटा मोटी 4-5 साल में ही अपना बुल बेचारा थक के गिर जाता है. अगर आप उसमें देखें तो you have to see that period where the maximum return of the market happened, 2003 to 2007. then 2009 to 2015, and then 15 to 20 was a very low period, then 2020 till 2025. So you know the basic length of the Indian bull market. This is data over 40 years, give or take a year. Once you see that, and in that period you've had huge supernormal returns, that means the capacity has been now reached beyond it's able to deliver that. I saw exactly that in 2007 December. I was on CNBC in January 2008 when I told Udayan that, look, this market is going to fall from 18,000 Sensex to 4 figures. Why? Not because of some brainwave. This is it. उस वक्त भी 50% CAGR था for those 4 years prior to the 2000 crisis. Now, why it will fall? You can manufacture any reason why it will fall. You see the point? Events will follow the overflow and justify the overflow. इस बार overvaluation. दुनिया में कहीं bear market नहीं. US is only down some 6-7%. The real bear market is only in India. It's not a globalized bear market. China is doing well. Obviously, Europe is doing phenomenally well. तो इंडिया में ही है. तो इंडिया में क्यों है? Because Indian returns, the lake of returns was so full beyond capacity, it had to give way. The reservoir has broken. It will take time to fill up.
Now you can counter, Samir. What were you about to say?
I was saying, first of all, that if you look at the last, 15, 20, 25 years, India has beaten even US and Mr. Buffett. But that is with what return? It is with a return in rupee terms of 15% type number. So when you say, and we are very proud of that in 15% rupee returns and maybe 11-12% dollar returns, we are the #1 performing market. Therefore, in general, what you expect from the market, based on earnings also and whatever, is in this range only. It is not supposed to be that 30%.
So when you exceed the range by 4x, there will be a period of normalization.
So that increasing of excess was in small caps and mid caps. But we are talking about the market. So the market is the 500 index. So the 500 index, otherwise you can say US market is this thing, but if you remove these 7 stocks, then it is something else.
I think 67% of the market right now is large cap.
So the big picture is,
which is why they have relatively fallen less, because unka leka, that level was not reached. They have compounded only some 25% or so. They are only 2x of the trend, or maybe 1.8x. This one was 18% ke samne mein. The small caps have returned like 48%.
So you're saying the bear market is in the small caps?
It is obviously where the maximum lake has been filled. That is where the bear market is.
So you're clarifying. So
I'm clarifying. No, let me finish. But you cannot remove one from the other.
वो कैसे? वो तो 32% है, ये 67%.
बुलाए हो तो ना कभी तुमने समोसे भी नहीं खिलाए बाहर में, तो मतलब
अभी डिनर भी खिलाएंगे.
तो see, there is a generalized bear market of which the accentuated part in the small cap, but doesn't mean small cap will keep falling and large cap will keep rising. That is not going to happen. The moves are going to be directionally the same. Small caps, because they have run up a lot more, they are and they are going to fall a lot more, and I am a sufferer of that. What is the big deal in that?
So may I say one thing, that if 5-year numbers, the lake is full and all this storytelling you're doing, but last 3-year numbers are normal, that means this should have been done 3 years ago. Because last 3-year numbers are
very bad. Sir, वही तो secret sauce है, sir. Why last year change your mind? क्यों नहीं change हुआ 2023 में?
But by the way, he obviously comes in unprepared, I come in totally prepared. So I did a Google search on him, and then I did a YouTube search on him. And 4 months ago, he said bear market is dead.
No, I said a global bear market is dead.
At the Outlook conference.
No. I said a generalized global meltdown is dead. Global कहाँ bear market है? यही तो मैं कह रहा हूँ. खाली इंडिया में bear market है. कहीं नहीं हुआ bear market.
Achha, anyway, technically I have won this round because...
No, who declares it?
Because he said... No, 1 minute. Because he said the bear market is only in small caps, and small caps are only, I think, 10% of the market. That means 90% he can. So basically I have won.
Yeah, of course. That's what you have won, because you are saying you will beat the liquid fund.
No, I did not say liquid fund. I said alternatives that either the foreigner can go into some
यार
other
आपने
market.
हर्डल ही रख दिया साला 4% का, वो भी नहीं
मैंने लिक्विड बोला ही नहीं, मैंने कहा alternatives.
2% फी लेके चले जाता हूँ.
Alternatives.
अच्छा कैसा चल रहा है WWE? ठीक चल रहा है?
फिलहाल ठीक चल रहा है. आप बताओ. अच्छा बताओ. So on a serious note, so you are bearish only on the small cap segment.
Which he can't sell.
So the
Only
bear
those
market
ones.
is only on small caps.
No.
And
Let me make it very
this
clear.
lake return theory, if you compare the large cap returns versus small cap returns.
But
The
large caps are
lake is
also-
very different. The lake return is very different.
Let me finish, yeah. Abhi, lake is different, but it is not empty in large cap and super full in the small cap. Large caps have done 27 or 28%.
तो वो 50 तक जा सकता है.
Nahin, it will, in my view, large caps don't fall 50%. They slow down the pace of fall and they grind it out. Small caps will adjust like in 3 months or 5 months or 6 months, as they are doing right now. So the fall duration is going to be different. The grind is going to be different. Large caps will drift down and correct this overvaluation, or let's say the overflow through time. Small caps are correcting it through price action. There's a differential way for the lake to dry up in both, but both lakes will run dry.
What do you think, Samir?
First of all, I would like to check, what did he say, that the large caps are up 27% per annum for 5 years? Is it what you are trying to say? 28%. Safeed, just check करके बताना.
Sir, checked है, sir.
No chance of
check 100%. Nifty.
Zero chance.
Check, sir.
5 year.
5 year period.
You must be taking
COVID
from March 2020.
हाँ, obviously
तो
COVID.
base आपने उतना
अरे bull
नीचे
market
ले लिया.
started from March of 2020 ना.
But check करके बताते हैं.
Sir, 100%.
Anyway, bottom line.
Sir, that is 28 and this is 48.
What I was saying separately is that these falls in the market are also more or less over a 8-9 month kind period. So instead of looking at how much it will fall, I think we should look at time. And I think this time will coincide in the next 3-4 months with a number of things. First, this sharp fall period would be 9 months in May, let's say. Also, that would coincide with, say, the clarification or whatever, or what happens with Trump. It will also be what happens to our earnings. It may also be that the base year, that is previous year's first quarter, second quarter will be the base. And then you can move on in life. But I also do not expect a V-shaped recovery, because a V-shaped recovery needs government. Mostly in the past, if it has been a US fall, it is money and interest rate cuts, and in India, there's nothing obvious that somebody can do. So if you can get back after May what you lost this year in terms of the market in another 9-12 months, that is a bull run. Because that will be 15-18%.
Highly qualified bull run I have never heard in my life.
If you think
that I will beat liquid funds, so I am bullish.
Bhai, listen, the guy who's saying,
I think he has lost it completely on the fight front. Not mentally, but I mean he has lost him. Sir,
one second.
Sir, you are down one round now.
1 second. The guy just admitted that he can't sell his small caps, and he's calling that if I make 15%, it's bad.
I cannot. Sir,
I'm being for his recovery.
Sir, I'm being honest. They are non-saleable. What to do?
Acha, Shankar, so for the year, for Nifty, what is your prognosis?
No, I don't think you're going to see the highs this year. If that is what you're...
Let me finish. You're bearish. You're bearish. So you can't say not highs.
Can I finish? What I'm saying is very simple. It's very, very straightforward. You will see next to zero returns from the highs of September 2024 till for the next 4 or 5 years. That is my view. Now, what was the...
5 years, 2025.
Let me finish now, Baba. Let me finish. What happens in the interim period is not that the market doesn't do anything. It is very possible that from the current Sensex of 73, it can fall to 60,000. If GDP numbers come bad or some stuff happens. Then it can rally back to 75. So it will keep you interested for 5 years. Just like what happened after the Harshad Mehta bear market. Every year, so market fell from 4,600 Sensex to 2,800 Sensex. It rallied back in the middle to, I think, 4,000 in 95. It kept us interested enough to not retire from the business. That is exactly what you're going to see, sharp bear market rallies. It is inevitable part of a bear market. But on a point-to-point basis, on a 5-year basis, I do not expect positive returns. In fact, in rupee terms, you will see negative. In dollar terms, you're going to see negative returns.
For this year, 2025.
2025, I mean, you might play a bear market rally, but again, I don't see a major, I mean, okay, again, please understand, as we have discussed also in the past with you and others, India is a bottom-up market in this kind of market. In a top-down market, big bull market, buy anything, everything goes up. This market has changed. Let's accept it. From a trading market, from a trending market, it's now a trading market. You can trade the rallies if you're very smart, or you get good stocks which are 5, 20, 50 stocks. In India, you will always get it. Like in the 90s, the Dr. Reddy's, HDFC banks, and the Infosys we got, even though the macro was terrible, cement was going nowhere. Tata Motors was close to being basically bust. Even despite that, you found enough bottom-up stock picks. You will get that. I'm talking a macro top-down. This year, you're going to be highly problematic. You might see a few rallies. If you're smart enough, please play that.
You know, I'm just reminded of this beautiful interview of Daniel Kahneman and Nassim Nicholas Taleb I saw on New York Public Library. It's on YouTube. And it was on Taleb's book launch, I think Black Swan or something, where Kahneman tells him that, you know, Nassim, you pretty much make the same points as most economists do, but you just make it a little controversial.
Wrong.
So if you ask any fund manager, they'll say, you know, last 4 years we've had fantastic run. Now it's going to be a stock-specific market. How different is what you're saying?
I don't think they said that the market is going to tank between the large cap and the small cap 10 or 20%. I don't think anybody said that. If anybody said that, hats off. Okay, yeah, Siddharth Bhaiya was or Naren kind of hinted at that. And I salute them because in India, biggest problem is there is a unified perspective you're supposed to have. And if you don't have it, then they put up your picture on this board like this. No, like the US, I love it because, not because it's a great country. I like the diversity of opinion. There are always, opposing points of views on a debate, or people writing bearish things about America. कोई उनको anti-national or anti-Hindu, anti-ये नहीं वो anti-वो नहीं बोलता. Why is it that here bullish हो तो आप देशभक्त हो, bearish हो के तो नहीं जी आप तो अपना चले जाओ कहीं पर neighboring country में.
True that.
This is where our biggest fault lies as a market which is not mature enough, or the investor community to accept that a market is going to be cyclical. It is cyclical. Who says markets are not cyclical? When I say that the cycle has peaked and is probably heading down, so you're a bad boy. That is where I have a problem with. I don't have a problem in saying what I'm saying. All I'm saying is the acceptance of a different perspective is what we should encourage. I love what Naren said. It's fantastic. We need more voices like that.
Right. Samir?
Okay, so you're absolutely right. He's saying making controversy for the sake of
and the allegation
but
against you is, you know, that Pepsi ad.
What is controversy if I turn bearish? But for the record,
but wrap it up, please.
It's not a matter of bearish because we have many people here also bearish. Anyway, on this mid-cap, small-cap, I had made many presentations, but that is not the takeaway. Takeaway is he's saying that in 5 years, the Nifty level will be giving zero return.
Yes.
Now, the good thing is that if in 3 years we make money, or in 2 years, he is going to say, but I gave a 5-year target. And by 5 years, he may and I may have all become much older. So, you know, in the olden days, when we used to say in the mutual fund business and any fund management business, that equities beat debt. So they would say, if you are giving a 5-year, 10-year number, it's because the fund manager or the investor expects to retire before that. So don't give 5-year numbers right away. First give broadly 1-year numbers so that we can track it along the way. Otherwise, for 4 years, we can't catch you saying, no, abhi 5th year is not over.
Sir, but I'm tracking your, but I'm going to track your liquid funds, sir.
Shankar, we have to wrap this up in 30 seconds. Samir, 2025 prediction. For this year, where are we?
2025, from in the next 1 or 2 months, the market will bottom out and maybe go up 5-7% or 8-10% after that. But you will be lower than what you started with.
So it's a minus year.
See, we are ending with a draw, okay?
That is this year. And then you move along with life, because this idea that there was a lake with artificially chosen dates, that I don't buy.
I know the insurance also told me the same
More
thing.
discussion later, but for now, this match seems to have been fixed. But thank you so much, gentlemen. Anyway, it was a lively discussion.
Thank you. Thank you.
All right, that was a fiery one, right? All right. Joining us next, our guest is a journalist and an author of not 1 or 2, but 7 New York Times bestsellers. He began his career as a Yale Law School graduate, working in politics for the US government. He was a speechwriter for Al Gore and also wrote his experience in his first book, The Free Agent Nation. And since then, our next guest has written 6 more bestsellers. You must have heard of them: Drive, To Sell is Human, The Whole New Mind. He's one of the world's most in-demand speakers, with more than 1,200 lectures in 6 continents. And with his latest book, The Power of Regret, he's here to reveal why most successful people don't live with regret. Welcome to the Moneycontrol Global Wealth Summit. This is Daniel Pink.
Hello. Good evening, good morning. It's 5:30 in the morning where I am in Minneapolis, Minnesota.
All right, thank you so much, Daniel, for joining us bright and early over there. Now, you know, your book on regret has very different meanings for everybody. But here, every leader, every investor, every entrepreneur sitting in this audience has faced regret. You know, things like they must be feeling right now about regret would be, oh, I did not bet on Nvidia. Oh, I sold an ITC stock really early. Oh, I didn't cash in on that Bitcoin rally. So how do these people, the wealth creators of India, how do they not see regret as a failure? And what I'm really trying to ask you and to translate in their language would be, if regret were a stock, why are you betting on it?
Oh, because if regret were a stock, I would bet on it because its long-term returns, when invested in properly, are massive. And this is a great way to look at it, Sonal. Let's stick with your metaphor here for a moment, okay? So regret is that feeling that we have when we look backward and wish we had done something or wish we hadn't done something. It's a painful emotion. And our goal, what we might think, is that we want to avoid regret at all costs, and that if we feel regret, we should just ignore it because we don't want to wallow in it. And that's not quite right. What we should think of is that regret is an emotion that is functional. It's adaptive. It has a purpose. And if we think about all of our emotions, here's where I'm going to stick with your metaphor. Let's think about all of the emotions that we have as human beings as a portfolio. And in your portfolio of emotions, you want to have a lot of positive emotions. You want to have more positive emotions than negative emotions. If you're interested in long-term growth, you have more equity than debt in your portfolio. But you don't want to have only positive emotions. That's not diversified enough. And you want to have some negative emotions because negative emotions are functional. So would you want to if I offered anybody in this audience an operation and said, I will eliminate fear, you will no longer experience fear, which is a negative emotion. Don't take that offer because fear is functional. You want to get out of a burning building. Think about something like grief. Grief is functional. It reminds us why we love. And so the most prominent negative emotion we have is regret. And the reason that we have it is because it can help us make better decisions in the future.
I see. Interesting. But, you know, financial loss is more than just regret, right? It's a direct, immediate hit on the pocket. Unlike, say, an emotional regret, a friend you don't speak to or a father you don't call very often, financial regrets aren't like an egg you can unscramble. So currently, when the markets are so volatile right now in India, what's your advice on coping with financial regret?
Well, I think you have to think about, I think what we need to do as healthy human beings, whether we're investing or whether we're parents or anything, is regretting the right thing. And what we should be regretting are a lot of times we regret the outcome. Okay? So let's take an example here. Right? If I want to go out for a run outside and it is raining and I can't go out for a run, I can't regret that. That's not regret. That is disappointment. That's something that I have control over. And so you can only regret things that you have control over. And as you know, as you were talking about a moment ago, this market is volatile. The idea that you have control over the outcomes of all of your investments is a fool's game. What you want to do is you want to make smart decisions over a large portfolio in a long period of time, and over time, that's going to work out for you. But if you regret every outcome, then you end up making worse decisions. You want to focus on evaluating the decision rather than the outcome. That is absolutely the key, because there are stocks that go up, there are stocks that go down, but you want to make sure if you didn't invest in Nvidia and you had a good reason for doing it, then interrogate that decision, see what you can learn if that was truly a mistake. But you know what? Sometimes things are random. I mean, we know that very well from the stock market, and that's one reason that we diversify.
That's fascinating. But in your book, you know, Daniel, you've surveyed people, you've spoken to them. There are lots of patterns that have emerged. Could you point out for us if you've noticed any regional differences, for example, in how business leaders, investors show regret or face regret, say Silicon Valley versus India? Is there a difference in pattern?
Yeah. There actually are so I collected regrets from over 26,000 people in 134 countries. And in part to answer that question exactly. We had the survey in multiple languages. And what I found, to my surprise, is that there were not that many regional differences. Very, very few. And when you look at business leaders around the world, what you see is their biggest regret is not being bold enough. Not being bold enough. Especially when you look at people's... So one is not being bold enough for business leaders, not being bold enough. I wanted to take this chance, but I was too scared to do it, and now I regret it. You have some people who act boldly and it doesn't work out for them, and they regret that. But for every person who acts boldly and it doesn't work out, there are probably 40 or 50 who say, I wish I had acted more boldly. The other thing that you see sometimes with business leaders is some moral regrets. I was at a juncture in my career, and I could have done the right thing or the wrong thing. I could have taken the high road morally or the low road morally, and most people, including most business leaders, regret over time not acting morally. So be bold and be good is really the lesson that comes from that.
That's interesting. But, another emotion you often see in the markets, on the lines of regret at least, is FOMO. Isn't fear of missing out also sort of regret in real time? How can decision makers avoid being paralyzed by what could have been and focus more on what can be? How do you deal with that?
Well, what you do is when you have a regret, so this is important, when you have a regret, what you should do is that you should not ignore it. That's a bad idea. And a lot of times, especially in America, we're told, don't worry about your regret, always be positive, never be negative. That's a bad idea. But what you also shouldn't do, to your point, Sonal, is get paralyzed by it, by stewing it, wallowing it. What you should be doing, and I think the investors in the audience can be very good at this, is look at your regret as data, as information. All right? What is this regret telling me? What it is telling. So let's say that I didn't invest in NVIDIA, 5 years ago, and I regret doing that. Okay, what did I miss? What did I miss? I missed that artificial intelligence was going to be a big deal, and you needed some company to supply the chips to do that. All right, great. So that's data. That's what I learned from it. Now I'm going to extract a lesson from that. What's the lesson? The lesson is that I should be paying more attention to macro trends in the economy in the future. That's my lesson. My lesson isn't let's go chase the next AI stock. The lesson is what I missed was that I wasn't looking at large secular macro trends, and those were powering certain kinds of companies. So now what I should be doing is looking at the current, what is currently the large secular macro trends. What, for instance, are going to be the effect of especially in places like the United States, Western Europe, and Japan, of an aging population and not enough replacement there. That's a big, massive secular trend. What can I do to take advantage of that?
All right. So, Daniel, in your research, there are lots of important points and lots of patterns that have emerged which are very curious to understand. And I just want to sort of turn one leaf on that. In business, in love, in life, what do people regret more? Is it not doing things or doing things? What is a larger form of regret that really crops up?
Okay, this is both a profound question. It's a profound question that you asked, and it's actually an easy question to answer, because this one is not even close. Around the world, people regret inactions more than actions, and it's not even close. And here, now I mentioned that there weren't a lot of national differences. I did some work, quantitative work in the U.S. looking at demographic differences in the U.S. on gender, on race, and things like that. There were very few there too. But the one big demographic difference was age. And what you saw is that people in their 20s, this is American data, but I think it applies to the rest of the world. People in their 20s had about equal numbers of regrets of action and inaction. People in their 20s. People in their 30s had more inaction regrets than action regrets. By the time you get to your 40s, 50s, 60s, it's not even close. It's so not even close. It is 3 to 1, 4-to-1 inaction regrets over action regrets. What people regret over time is what they didn't do. This is so clear in all the literature on regret. I didn't tell my partner that I loved her. I didn't reach out to a friend. I didn't speak up at work for something that matters. I didn't take a big shot in my business. I wasn't entrepreneurial enough. Those are the things that people regret over time.
Right. It's interesting you bring in age, but I often think that regret is something that creeps in only later in life. Because early on, you're too sort of curious, restless to try things on, and that zeal sort of fades away. Is that true?
Yes and no. There's the other reason so first of all, older people, they do have regrets, but a lot of their action regrets, a lot of the regrets of action, what they did, many of those actually fade away. People make peace with it. They put it into context. What sticks with people over time are those things that they didn't do. Because if I do, let's say I hurt somebody and I regret doing that, I can make amends. I can go back and cure that. But with an inaction regret, I can't do anything about it. I think the big reason that younger people might have fewer regrets, logical reason is that their past is shorter. So they have less to, regret is you're looking back into your past. And when you're 20, your past is this long. When you're my age, your past is this long.
Okay, interesting. So, there are a lot of entrepreneurs here in our audience today listening to you. And this session has been a bit of a breakaway from the regular conversation on wealth creation, etc., that we've been having all day long. But if you were to give them advice, if you were to talk to first-generation entrepreneurs, wealth creators, how would you tell them to harness regret? Because what you are saying, what your book says, is against what any of the leaders or any of the aspirators that they have been saying. They look at successful people who say, I don't have regrets. Warren Buffett says, I don't have regrets. But you are saying, own it.
I am. And what I'm saying, anybody who tells you they don't have regrets is not telling you the truth. What we know from 60 years of evidence is the only people who don't have regrets are 5-year-olds, because their brains haven't developed the capacity to do counterfactual thinking, people with neurodegenerative diseases, certain kinds, and sociopaths. Everybody else has regret. Around the world, it's one of the most common emotions. The key is what you do with it. And I think, especially for the investors and entrepreneurs in your audience, the key is to, as I said before, is to use it as data. And use it. What is this regret telling me? When you have that emotion, it's a signal. What's a signal? It could be a signal that I need to be bolder in the future. It could be a signal that I need to be more connected to other people in the future. It could be a signal that I need to act more properly in the future. One of the things that we see is that around the world, people have certain kinds of regrets all over the world. And what it yields is a set of lessons. Because when people tell you what they regret the most, they tell you what they value the most. And what people regret is not doing the work. What people regret is not acting boldly. What people regret is not being good. And what people regret is not being in close relationships, connected relationships with people they care about. And so that gives us a clue. Do the work, take the shot, do the right thing, and when in doubt, reach out to others.
Sounds so simple when you say it, but so difficult to implement.
That's because the goal is not perfection. The goal is being better. The goal is trying to do a little bit better today than you did yesterday. And I actually think that especially the talented people in the room where you're in can absolutely do these things. And I think what's also important for the leaders in the audience is to talk about your regrets. Tell your team, here's something I regret. Here's what I learned from it. Here's what I'm going to do about it.
Yeah. So key takeaways from what you've just said is that more people in the world regret not overdoing. They regret not being bold enough, and they regret more of their moral decisions over anything else, which is very, very interesting. But, the thing, Daniel, with regret is, where do you draw the line? Once you go down that path of understanding what went wrong, it's difficult to surface again. And that's the reason why people shut it down. So where does one draw the line?
Well, so first of all, the idea that you should treat yourself, when you have a regret, you should treat yourself with kindness rather than contempt. A lot of times when we make mistakes, the way we talk to ourselves is brutal and cruel. And what the research tells us is that that's not effective. It might feel like you're being a badass by being cruel to yourself, but it doesn't improve your performance. So what you should do is treat yourself with kindness rather than contempt. There's a strong case to be made for talking about or writing about your regret. But the most important thing here is this. I want to come back to this because these investors can understand this. It's a signal. It's a market signal. It's telling you something. And you need to listen to it and then say, what lesson is this teaching me? And what should I do next in response to that? And when we do that, we have piles of evidence showing that when people treat regret that way, they become better negotiators. They're less likely to avoid, they're better problem solvers. It is a way to avoid cognitive biases like confirmation bias and escalation of commitment to a failing course of action, which bedevil, both of which bedevil investors. It can help make you a better strategist. And so the key here is not to spend a lot of your time in regret just because for the same reason that in your portfolio, you're going to have way less debt than equity if you want to grow over the long time. But you want to have a little bit because it's functional. It helps you grow. And if we treat this painful emotion as a source of information, as a source of data, as a signal, we have evidence from around the world that it helps make you better at your job, better at your life.
Regret makes you better. Well, that's a good one to go for. But, if I were to use another market analogy or perhaps a finance analogy over here, would you say then that regret is like compound interest, painful early, but valuable in the long run?
Could be. I think that's not a bad way to look at it. I think the harder regrets that people have are the regrets that compound. So if you look at like individual investors, if you look at individuals, it's like, people who say I spent too much and saved too little and now I don't have enough money. That's a function of compounding. But yeah, no, I think that regret, especially regrets of inaction, can compound. That's why they stick around for so long. That's why people in their 60s and 70s have regrets of inaction and not that many of action. Because the regret of inaction, what I didn't do, I didn't speak up, I didn't take the chance, I wasn't bold, that sticks with you. And goes up 6% every year, which means it doubles in 12 years, right? So I think there is a good argument for that.
I see. Daniel, lots of more questions, but I have to end by asking you about what has been your biggest regret, apart from, of course, not being here in person. Apart from that, what has been your biggest regret in life?
In life, my biggest regret was that is a regret of kindness. That earlier in my life, I wasn't as kind as I could be to other people. I wasn't a bully, but there were many situations where people were not being treated well. People were being left out. I saw it. I knew it was wrong, and I didn't do anything. And that really bothers me. And so now the question is, I can beat myself up and say, you're a terrible person. You're awful. Bad idea. I can say, don't worry about that. It's in the past. Also a bad idea. Or I can say, wow, things that happened 30, 40 years ago still bug me. That's telling me something. It's telling me that I value kindness and that in the future, I should treat people with compassion, treat people kindly. And if people are being left out, then I have an obligation to bring them in.
Daniel Ping, thank you so much for joining us, for sharing your thoughts. And this book is one that provokes a lot of thought. Thank you so much. Daniel Ping, ladies and gentlemen.
Thank you.
All right, moving on from that. The brutal market reset is underway, sort of stalling corporate earnings, steep valuations, and a cyclical downturn that has all triggered a sharp sell-off. Now, do you chase the battered blue chips, scoop up the shaken small caps, or sort of ride the next wave of momentum? The game has changed, and we need to learn how to pick winners and thrive in 2025. So how do you really do that? Anuj is here. And I'd like to welcome him back on stage to help us decode that question. Joining him will be the panel, Amit Jaiswani, founder and CIO Stallion Asset, Rajiv Thakkar, CIO Director, PPFAS Mutual Fund, Vikas Khemani, founder, Carnelian Asset Advisors, Lakshmi Iyer, CEO, Investment and Strategy, Kotak Alternative Asset Managers, and Vikas Sharma, Head, Wealth Management and Private Banking, IDFC First Bank. Please welcome your panel on stage.
Thank you, ladies and gentlemen. It's time for this market session. The theme is the Great 2025 Market Hunt, Timing, Trends, and Alpha Plays. And of course, we got who's who of financial markets here, and they're going to help us decode this current bearish phase that we are part of. Is this just a cyclical bear market? Is this a crunching bear market which is going to last a bit long? Is it giving opportunities? Or is it giving signals that you made your money over the last 3 years, it's time to pay back a bit to the market? Of course, on my right, I have Lakshmi Iyer, CEO, Investment and Strategy, Kotak Alternate Asset Managers. To her right, of course, Vikas Khemani is there. Vikas is someone who has made great strides and now, of course, runs a very successful fund of his own. To my left, of course, we have a lot of gentlemen. Amit Jaiswani, founder and CIO of Stallion Asset. Amit, thank you so much for being here. Vikas Sharma is here, Head of Wealth Management and Private Banking at IDFC. And of course, on the extreme left, we have Rajiv Thakkar, the CIO and Director of the Parag Parikh Mutual Fund, which is one of the most successful mutual funds in India of late. So let us start. And considering that we are at the cusp of International Women's Day, let me start with you, Lakshmi. First of all, a very happy Women's Day. And I'm told that you link markets and Bollywood. So right now, given the kind of market we are in, what picture comes to your mind?
Oh, that's like a straight googly off. But halchal is the right word in the market, which is increasing your and my dil ki dhadkan. And so much so that we have to keep telling ourselves that कुछ कुछ होता है तुम नहीं समझोगे.
कुछ कुछ होता है. Market में बहुत कुछ हो रहा है, लेकिन because a lot of people are asking that is this time to just sell lock, stock and barrel, or is this a market in which we just really have to hold on for some more time and good times will come?
No, surely not to sell. I think nothing has changed from long-term India structural story. It continues to remain intact, and I think these kind of corrections are very much par for the course and happens every 2-3 years. I mean, we have a short memory, of course. We very often we keep forgetting, but very similar kind of correction had happened in Jan to June 22 when the Ukraine war was around. We had a roaring bull market mid-20 and 21, and then everybody kind of came in and said it's going to last forever, and then we had Ukraine war and market corrected from 18,500 Nifty to 15,500, right? And that time, by the way, narrative was very similar. Global concern, inflation, earnings slowdown, and this is going to go away. And then we saw second half of this 22 started recovering on legs of skepticism, most amount of skepticism, and then we had a roaring 23 and first half of 24. So the point I'm trying to tell you, to me, it is kind of reminds me of the similar time period where Nifty has corrected from 26,500 to 22,000, which is almost again 18-20% correction, and again same geopolitical, worries, earnings slowdown worries and all. So I think by and large, I feel that most of the damage is done. There's no point if you didn't sell last year, no point in selling now. Lock, stock and barrel. Rather, I would say that evaluations have corrected. It's a time. These kind of corrections are par for course in long structural bull market. So long-term investors have to remain invested. And if you have money, invest. If you don't have money, stay put.
Okay. Rajiv, coming to you now, because this time what's been different is that the valuations when the correction started were way out of whack, especially for mid caps and small caps. And since your founder's philosophy is something that, of course, you very ardently follow, is this a market in which you have taken a lot of cash call? Is this a market in which now you're deploying cash? How are you approaching it? Your fund size is pretty large now, so you have fair bit of idea of how the market is acting right now.
Sure. So, Anuj, the market is what it is. I don't think there's anything exceptional that has happened. It's just that so many new investors have come to the market and they have to learn some old lessons. There's nothing wrong with the market per se. Today, a 1-year bank CD is giving you 7.5%. A lot of people spoke about long-term equity returns, 12%. So if you are not buying equity and if you are putting money in a bank CD, you are, let's say, losing around 4.5%. Now, given the kind of volatility that is there up and down, there are plenty of opportunities to deploy that cash that is there. I don't think we are in a hurry. There's no need to force yourself to buy if you're not convinced either on management quality or on balance sheet quality or on valuations, business model, etc. Today the market is, I think, I'm finding pockets which are looking very interesting to deploy money, as well as there are pockets which are still looking very frothy. So I don't have an index view or a overall view, but we will be able to find opportunities surely, given the kind of fall that has been there.
Oh, absolutely. I mean, that's a very interesting point, right? Because, like it or not, a large part of new money, which sort of got in after COVID, has not seen a bear market. I think all of us are old enough to remember the 2003 to 2008 phase where 20% was par for the course. I mean, 10% was par for the course. We had 2 or 3 instances of 20%, where the global financial crisis, when the market, even at index level, fell 58%. I mean, it felt bad, but we all knew that, it's going to bounce back. But the new money has not seen it. And all of a sudden, they used to think the market's like an ATM machine. Just go there, put your card, take the money out by evening. That has changed. How do they negotiate with this new reality?
See, a lot of people will learn in this bull market, and I hope we are ahead of the curve. But the stocks that most people own will not come back. There'll be new leaders, brand new companies which are not so large right now, not owned by anyone. They will be in neglected zones. There will be some kind of change that'll happen. There'll be new leaders to the bull market. The bull markets keep changing every cycle. From COVID as well. If you think, since you talk about COVID, it's been about 5 years to COVID right now. When COVID happened, the stocks that were leading were technology stocks, pharma stocks, chemical stocks. No one was looking at government stocks that time, and they topped in October 21. 9 months there was a bear market after that, and then you had a brand new kind of stocks, government stocks, Adani Group, that came from nowhere and created the largest ever market cap. And if that point of time you owned technology and chemical stocks, you would be a sucker, basically. You would have lost a lot of money. Even if the markets went higher, there'll be a new kind of stocks that will go higher. They will have patterns of high growth. Typically, trends get created by some kind of disruption. COVID created China to stop exporting, and that's how chemical prices went through the roof. That's how, like in 2021 2022 war created a tailwind for defense stocks, and government started spending very aggressively in India. I think the next tailwind, we need to see where's the next change. I believe the next change will come in April when the tariffs, all your tariffs go online. Clarity will come. The biggest change that I see today is Trump. And that policies of Trump can have an impact, like 20% tariff on China and 0% right now on India. You already start thinking that which are the kind of companies which start benefiting. Of course, that can change on the 2nd of, and that will change on the 2nd of
But surprisingly,
April.
China is doing better than India. The Chinese market is on a tear right now.
Because the kind of stocks that are moving higher in China are not export-driven stories. They are local Chinese technology companies. So the quality of Like basically it's basically your Alibaba's, Tencent, etc., which are moving higher. It's not your exporters. That is not where the trend is. The trend is towards local Chinese consumption, and basically that's what I think. But I think there'll be new leaders. Hopefully we'll be able to catch them, and that is where the large alpha would lie.
Oh, absolutely. That's the key point, right? Catching the next leader. Now, because since you head the wealth management business, a lot of money in the market has come from family offices. A lot of money has come from corporate treasuries. A lot of money has come from CEOs, some of them perhaps sitting here and investing in the market. What is your sense? Is this money still here? Is this going to be sticky money, or is this going to be, saying, oh, maybe this is not for us. Let's just take our money somewhere else?
No, so the segments that you mentioned, Anuj, I feel that clearly is sticky long-term money. And I'll tell you the reason also, what you started off asking Lakshmi and Vikas, that is it a time to start selling lock, stock, barrel and move out? This is typically an investor psyche problem. There's a Morgan Housel session after this where he's talking about psychology of money, and I'm sure he's going to talk about this. Because when, the markets are in a phase like this, which is a bear phase, people start thinking on, whether this is the right time to exit, should I sit on cash? And when the markets are in the very euphoric stage, everybody's talking about, adding more money and entering the market. What we need to realize is that valuation is not the only factor that determines, if it's a right investment to make. There are so many other investments. For example, valuation in Indian markets have never been cheap. Very, very few cycles you've seen where valuation has come cheap. There are a whole lot of other factors like liquidity, for example. Post-COVID, there was so much of liquidity. Nobody really cared about valuations, right? Similarly, there are various other factors which need to be taken into account when, when you're putting your money out. And India is never going to be really a cheap market. The current, correction, which is largely led by lack of liquidity. There's a liquidity deficit. Earnings have been muted. Earnings have been, dramatically lower than what it looked like it would be a year back. So it's a good correction. It's a good time for the market to resort back to reasonable valuations. And, I'll conclude with a quote by, one of the very famous authors, stating that anything that is fundamentally great but having a temporary problem to be fixed is a great investment to make, And that to me defines India at this point in time, fundamentally great, but facing, headwinds at this point in time which seem very temporary. So great investment opportunity, anything, that defines that kind of
The problem is this temporary phase is now entered 7th month and it's almost created a bit of a record that we have never had this kind of correction because India has always been expensive. I take this point, but India has been expensive because it gives you the kind of returns that it used to give in earnings, and the market essentially in the long term has just tracked earnings. If you see the Nifty's CAGR, it's matched the Nifty's EPS growth, but we've had record quarter after quarter earnings downgrade, and it doesn't look like it's going to end anytime soon. So what makes you confident that, okay, maybe, we are very close to some kind of bottom?
Very good question, Anuj. I think if you see, what was the reason for slowing down of earning, in last 2 quarters? If you study, see last year,
elections? Elections?
No, not elections. I think if you see last year, RBI took maybe it fell in love with rupee and it defended rupee, and in the process ended up creating huge amount of liquidity deficit in the system, right? Secondly, and rightfully, they came down heavily on unsecured loan and microfinance loans, so NBFCs were curtailed. So basically, there was a lot of liquidity related issues driven by the RBI policies last year. That got coupled with, your government elections, which obviously slowed down spending, as well as the payments released on the government contracts, right? So coupled, both of these issues created a huge amount of liquidity stress in the system. That impacted corporate earnings with a 2 quarters lag. Now, if you see, 2 policy pivots have happened. RBI has, visibly worked on liquidity surplus. They have cut interest rates. They have reduced risk weightage to microfinance, NBFC lending, and of course have been a lot more accommodative in that stance. So that tells you that RBI has clearly moved towards growth. Secondly, government came, and I think as much as it appears that the big tax rebate which government gave up to 12 lakhs of rupees, it is a very, very significant move. It's not only about consumption. Think about it today, 8% post-tax return for a very large population of society, middle class, lower middle class, where, you don't pay much tax on that. So effectively bank deposits become very, very attractive. So that will drive money flow back to the banks, which was constrained earlier in last 2-3 years. We've been kind of complaining about it. Yeah. So all these big policy, and government has of course come out aggressively spending money and releasing payments and all those things. So what basically created a liquidity strike in the system is pivoting. Now I do believe that like it had negative impact with the 2 quarters lag, it will also have impact on the corporate earnings with 2 quarters lag. So maybe Q1, Q2 of next year, it will start impacting. I have no doubt in my, because I don't think fundamentally anything is changing, except the fact only thing which you can worry about, it will be the policy of Trump and the impact of in India. But I don't think they are materially changing India's manufacturing stance or anything else. We will have to see, but I don't think, so far at least whatever little understanding I have, the corporate earnings I do believe will start picking up, in a quarter or two, because this macro tends to have impact with the lag. That's my perspective.
Oh, absolutely, Vikas. And I think all of us would have seen those memes, right? Papa कहते हैं बेटा इससे अच्छा तो मेरी FD में ही रहने देता पैसा, and mummy is saying कि gold ने इससे अच्छा return दे दिया, तू बेकार में equity में डाल के मेरा पूरा पैसा तूने खराब कर दिया.
These memes will change sometime. अरे पहले equity में डाल देते तो बेटा ठीक हो जाता है.
बिल्कुल. But Rajiv, the first part of solving a problem is to accept that there is one. So at least the panel here agrees that there has been a problem. And we all know that we've seen a slowdown in earnings. Now let's address how do we sort this? We have a problem. We have to accept it. FIs are selling because they're getting returns somewhere else. Confidence is low. Earnings growth has taken a bit of a hit. And to make matters worse, we keep putting more expensive stocks in the index. So that also takes away the index earnings, right? The 2% earnings taken away by the last inclusion of 2 stocks in the Nifty. So how do we address this problem of earnings, of markets?
I think it's a self-correcting problem in some manner. Some of the things are inherently cyclical, so input costs keep going up and down. So the corporate profit share of GDP sometimes is higher, sometimes is lower. I think what happened in the era of extremely loose liquidity is that competitive intensity across sectors went high dramatically. Let me give you a few examples, and this will probably incite some passions in the audience. Some people may have strong views here. Everyone wants to give 10-minute grocery delivery to you, right? There are 2 listed players. There's a 3rd player, arguably pre-IPO. Yeah. There are some 5 other players in the wing setting up dark stores. Now everyone wants to subsidize you on grocery and go after market share. We got excited that big box retailers will do well. Then we gave them 100p multiples. We got excited about quick commerce. We said earning ki bhi zarurat nahi hai. We'll value in lakhs of crores. We said India is a growth market. FMCG companies should trade at 80-90 times earnings. We said, okay, D2C ko bhi itna valuation de dete hain. All the old paint companies, big moats, we'll give them high valuations. The new entrant, challenger, usko bhi free pass mil raha hai. So somewhere, discipline in capital allocation, focus on cash flow, profitability, that will have to come. And that will only come when a few of the startup companies fail. If everyone and their uncle want to set up discount brokerage, there's only so much room for discount brokerage in the country, zero cost brokerage. So some weaker players will have to go out for the profitability to come back.
So do you expect that to happen in the startup industry this year? Do you see
startup or listed, ultimately when a business model is unsustainable and when they are unable to raise a new round of money, either from the public or from private investors, some players get shaken out. So the challenge again is, we had a panel in the morning people are still talking about raising 5 lakh crores from public markets. There's a new REIT which has filed for 7,000 crore money raising. So much money raising is in pipeline. There will be enough opportunities for investors. There's no hurry to purchase anything, and buy only when there's limited competition, there's genuine cash flow and profitability.
I was scared because I was moderating that panel, so obviously I heard that. So you're not still buying Zomato or Swiggy?
I can't name companies, but I'm not a fan of the consumption-oriented names. Despite the fall, like something which was at 100 times earnings, if it's fallen 20% in the cash, it's now 80 times earnings. Doesn't make it that exciting. And growth rates have started coming off for some of these big box retailers.
Oh, absolutely. Amit, do you think, we went through a period in which, I would say the second half of 2023 and first half of 2024, where, it was, as they call it, the BAP investing, buy at any price. And, valuations were thrown out of the window. You could just say that only momentum investing works in the market. That was the one thing that we were all hearing. Now, the momentum index and all the momentum stocks are down 40 to 50%. Now, this year, if you're chasing alpha, what would your approach be?
Buy liquid fund. I'm joking. So, so what you just said, market started chasing high growth stocks, or this is part of every bull market. This is not the first bull market. Show me one bull market in last 30, 40 years where you didn't have the highest growth stocks bid up to the highest level ever. Be it Infosys, be it 2018, you'll have infrastructure names, you'll have some other names. It is not this bull market. It's how markets work. And we have to make money off it. We don't have to argue that why is the market working like this. We have to think, how do we make money out of it? Our job is simple. Our number one goal is to make money of market alumni. This year is going to be a tougher year. It will take time. We've all made decent money. And if people didn't make money in 2023, 2024, it's okay. You'll have more bull markets coming ahead. But right now we are in a somewhat bear phase. Let's not be like super, let's protect capital. If we can protect capital and we can just, like this is how I think for my fund. If we can protect capital in typical bear markets, if you go back in 1992 Harshad Mehta times till now, all bear markets, the downfalls are for 9 months to 12 months, typically. Now, it doesn't mean that this downfall will also be from 9 months to 12 months. It can be 15 months, it can be 8 months. But broadly, it takes some time for the markets to correct. And then you find those new winners. There's a wave of consolidation. And that is how we want to play. First, we pray to God we don't fall more on the fund level. First is protect capital, protect your drawdown. If we survive this year without losing too much money, hopefully 2026 and 7, we'll have again those high growth stocks. Again, we'll play those markets. Again, these stocks will go back to 100p, I'm telling you. In 2027, now I'm telling you that there'll be again a bull, like that can be in 26, I don't know. But again, that is how markets work.
Oh, absolutely. That's how the markets work, and that's how the psychology of money works, right? I'm just trying to talk about the next session as well here. But anyway, Lakshmi, in that case, what's the best asset class right now? Do you think equity is the best asset class given how much the market's fallen? Or is it now time to put your money in hybrid funds or put your money in some sovereign, some G6? How are you approaching the various asset classes now?
See, Anuj, this is the year of the snake, as per the Chinese calendar.
Of the snake?
This is the year of the snake.
Okay.
So the markets will play snakes and ladders with all of us. So when you reach number 98, if you played snakes and ladders?
Oh, absolutely.
Yeah. So if
I play it even now with my 2 daughters. So
that's right. Yeah. So I play it on the mobile. So if you go to number 98 and you just think you're going to reach 100, there you come down. You come down right to number whatever, 15 or 18, and then you start up front. Okay. So I think in that kind of a market, there are going to be ups and downs, and the gully boys are going to become Jawans, and the Jawans are going to become 3 idiots. And then suddenly you have a deep-seek moment, and then you said, koi mil gaya, and that's what NVIDIA will say. In that kind of a market, you cannot be wedded to one asset class. That's point number one. Gold has been the absolute student of the year, 1, 2, 3.
Absolutely.
And maybe it's a sequel for the next year and this year as well. But can you just excessively get carried away and do just gold? Answer is no. So what is your end objective? That is going to be the critical driving factor, point number one. So if your yardstick is that 100 ka 200 rupiya banana and maybe in a span of maybe 5-7 years, then equity is still the answer. Irrespective of what numbers we are talking about, equity still has a very significant bearing on your portfolio. Gold will actually be the last person standing. It is going to be more like the Vishnu. Vishnu is a protector, okay, in mythology. So Vishnu of your portfolio is actually going to be gold. So I think it's a blend of all financial asset classes with the tail end of gold. And let's not forget the Cinderella, which is fixed income, which today is actually the shining star over and above gold in a lesser manner. But clearly that also plays a very integral role in your portfolio. So one can't give up one asset class to the other. Today the mood has become like this, that everybody wants to give up equities, or most of them want to do that, and probably get into safer alternatives, including alternate assets. And I find that a very misconceived notion, just because the recency bias in our mind is very, very strong.
Absolutely. Since you've raised this point, because I want to come to you now, because I now will talk purely about the equity market. The big complaint that the banks had was that we're losing money to stock markets. Nobody is depositing because everyone's moving their money to equities. In the last 3 months, we've seen some bit of reversal of that. People are now saying it's better to be in fixed income, right? So in some sense, do you think that could be the sector that could lead the market's next charge, banking and financial services, going forward?
No, I think so. Like I said, of course, some part of the money, because suddenly the fixed income as an asset class for a very large population has become attractive post-tax return, right? Because of the sheer tax benefit which was given in the budget. And if you are a family of 4, I mean, you're going to do investment in the name of so practically up to 50 lakhs rupees of income, you can, be tax-free. And that's a very, 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 very big deal. So I think, this will drive money deposits into the banking system, which is good, because ultimately you don't want, for any economy to do well, forget stock market, for the economy to do well, you need to have credit flow. Banks were struggling for the last 2-3 years on the deposit growth. So I do believe that this is a great sort of initiative, and it will have impact on the banking as a sector, but more importantly, I think it's healthy for the economy. So, if you ask me this year, last year banks didn't do well. So far it's been all right, but I think banking going forward could be big winner from a sectoral perspective.
Because what about you? Do you agree? What's the theme that you are backing right now at IDFC?
Yeah, so one theme, Anuj, that I've been a trend rather, not a theme, is that, and what Amit said, everybody is looking, we have to make money off the market, right? And family offices and HNIs, rather any investor is looking for that alpha creation, alpha generation idea, right? And what we've seen in the last couple of years is that we've seen very expensive IPOs landing in the market, very expensive IPOs, right? Which means if you start investing in a company right from day one, you're starting at a very expensive valuation, because IPOs have been very, very red hot, steamy valuations. So the trend that I notice is that a lot of interest is now moving to pre-IPO, moving to unlisted private equity space, because we feel that by the time the company is ready for a valuation, it is so expensive that I need to look at an opportunity to probably enter into that investment before that. And last year was great for IPOs, because at least the early part of the year was great for IPOs because markets were buoyant. Typically in years where markets are expected to be muted, where we are not expecting very, very expensive valuations, you will not see, and I heard one of the panel discussions in the morning where somebody said that we will have 60 to 70% lower number of IPOs as compared to last 2 years average, right? That will lead a lot of activity in the private equity space. And that increased activity in private equity space, I feel, is going to generate a lot of demand and interest of the investor community to look at, private equity space very, very actively, because they feel that the valuations, would be far, far attractive, before, let's say 2 years ahead of, if you expect an IPO to happen in 2027, this is a great year to probably catch some of those trends to kind of, so that one trend I feel is emerging very last 2 years, but I think 2025 is going to be all about that.
Oh, absolutely. Rajiv, do you think that would be a bit of a relief for the market that last year a lot of money was sucked out by primary issuances, and we reached a stage where a lot of money is now saying, let me go into the unlisted space. There's no point chasing some of these IPOs. Now, it looks like the IPO pipeline is going to dry down a lot, and a lot of money could be available for secondary market. Market valuations have corrected a lot. So, do you think that we could be staring at a situation where everyone is so bearish, so nervous? This could perhaps be start of another big bull run?
Maybe. I don't know. I'm not, however, that sanguine about IPO pipeline drying up. So, one is that whenever listings happen, everything does not hit the market on day one. So there's a lot of stock which is locked up or only a partial exit happens. A lot of these funds could come for maturity, the PE funds, etc., and where they may have to exit. Again, in some cases, the valuations are so egregious that even a 25% drop, people are willing to exit. Now, in the panel that you had on the IPO, someone made a point that we wanted a 2x valuation. Finally, we came to the market at X valuation, and then the stock went up again. But why were you wanting 2x valuation in the first place? So, I think 20% lower will the IPO pipeline dry up? I am not so sure. Investment bankers have to finally earn a living. I don't think they will give up that easily.
Okay, we got about 9 minutes left. We enter the last phase of this discussion. I'm going to ask each one of you what's your top bet is going to be for this year, for the remainder of this year. Because I'm going to start with you. What's your top bet for this year, 2025? If you want to name a sector, you want to name a stock,
I think,
whatever.
In my opinion, banks will be the sector for the year. It will outperform. That's my call and bet also. We are overweight in banking and financial services.
Banking is a large universe.
Banks and NBFCs.
Okay.
And again, key thesis is again pivot by the RBI growth accommodative stance. I think growth is coming back. So yeah, and valuations are very, very attractive. Many banks are available at in some PSU space 0.6, 0.7 time book. So a lot of correction. I mean, yesteryears of Kotak is available at 2 book, HDFC is at 2 book. So I think a lot of corrections have happened. Last year's sector underperformed. So I think this year, and many NBFCs are also attractively priced. So we think that that's a sector which will beat this time.
But problem ये कि सब पूछ रहे हैं चलता क्यों नहीं HDFC बैंक? The argument सब ठीक है, but हर level पे selling is just not moving.
No, I was not recommending a stock. I was just saying generally. But HDFC Bank, I think, is going through an interesting transition phase because of the merger. The growth is compromised, and they have to raise deposit. They have to repair their balance sheet or prepare their balance sheet rather, post merger. And I guess probably you might see that another 12 months. So I was not actually commenting on HDFC Bank in per se, but in general, I'm not saying HDFC Bank will do well. Banking sector will do well. We don't own HDFC Bank. So
maybe I'll ask Samir ki chalta kyun nahi HDFC Bank at some point. Huh?
He's saying aaj tak highlight girta nahi hai.
Lakshmi, what would your top bet be for 2022?
I would want to agree with, I can say copy that. I think within BFSI, I would say banking definitely, it's been a laggard for a very long period of time. We like the consumer-facing NBFC segment, for example, those which are lending to the consumers in that's
They've done well.
They've done well,
yeah.
but we think that their space or their phase or their positive spiel can continue. We like the insurance sector because interest rates will come down, but obviously there is incremental money which is getting locked at higher yields. So they will be definitely one beneficiary. Additional to that, of course, this is definitely the pole bearer of the sector, is the highest weightage. We also like the hospitality sector. whether it's hotels, whether it's, travel and tourism. It's a niche sector, but there is independent or very individual stock picking plays available in that segment. Again, they've had a very, very good run up. And we like this both in the listed, because I toggle through listed as well as unlisted. There are very exciting opportunities available even in the unlisted segment there.
Oh, absolutely. The problem is most of them are not.
Kotak is our largest holding.
Good, at least my ESOPs will start running. It is so far been sleeping like worse than Kumbhkaran, I would say.
Okay, let's not talk about ESOPs, but anyway, let's move on. Amit, what would your top bet be for 2025?
See, actually, Anuj, my topics are changing so fast. I'll just give you an example. Rajiv spoke about quick commerce. Quick commerce was my largest weight about 3 quarters ago. And now I don't even know if it'll be there. Like right now, it's in the bottom. Because this blue ocean high growth industry just moved into a red ocean in no time. It's happening in exchanges. It's happening in cola wars. The speed at which blue oceans are turning into red oceans, from your paints to in all consumer type this thing, is mind blowing. And this kind of competition intensity we've not seen before. So what I'm seeing is, let the markets tell me. This is a little contradictory, but the leaders of the next bull market will hit new highs at some point of time. Let the markets tell me where the markets are showing new signs of high earnings growth.
The stocks that first hit the new all-time
No,
high.
but they need to be value. Like initial neglect plus value should be there.
Okay.
It will not come with high P multiple. This is what historically has happened.
Okay.
We are only, see, I was a student in college where I used to see the last 10 question papers, study the last 10 question papers and attend the exam. I do exactly the same thing now in fund management. Historically, initial large leaders are value, but making new high, and it has some component like PSUs. It had massive neglect. They were value, and nobody in his right mind, including me, unfortunately, because my mind was wrong, but I thought it was right that point of time, would touch it. It will always start that way. But hopefully, I don't know if we'll get it right or wrong, but we'll try.
Okay. Vikas, you want to come in?
Yeah, I would have said BFSI, but since Vikas and Lakshmi, both of them mentioned that, my next best pick would be infrastructure. I think one thing that one cannot really question about this government is their intent and push on infra, right? I mean, that can trigger a debate where people who are harrowed by the dug-up Mumbai roads, but the larger picture is that an example of how the Mahakumbh was, orchestrated recently. And I mean, imagine maybe 20 years back, could a small, medium-sized Indian town could have accommodated, so many million people coming over and, managing it practically seamlessly. I'm sure there is a lot of thinking that the government would have put behind that event, and similarly they're putting a lot of thinking behind. I mean, if you travel anywhere in the country, you see a lot of development, a lot of infra-related activities happening. India seems like a country that is work in progress. So I think any theme that's related to infra all across the entire infra ecosystem, I think is the next 1 decade theme according to me. After obviously BFSI.
Oh, absolutely. I think we've seen some of that in Mumbai with the coastal road and metro. Just don't talk about this whole digging up the roads.
Fabulous. I mean, ask people who live and work in BKC.
Yeah.
Going to town has become absolutely...
But how do you exit the BKC? That is the tough part, right?
You walk, you crawl, and then you drive.
No, because I tell you, I did my show, I came here, and then I told my driver, look, there's a good chance that I'll have to walk to the Geo, because once you enter BKC, after that it's a bit of a nightmare. So anyway, that's for some other day. Maybe that's a different angst. Rajiv, what would your top bet be for 2025?
It's the same, private sector banks. I can give you more reasons if you like.
Absolutely.
Yeah. So one of the things that has happened is, if you look at the yield curve, and Lakshmi will know this very well, it's been very, very flat. So 1 year, 10 year, more or less same thing. So today a bank is raising 1 year money at 7.5%, and at that rate there's hardly any spread for their home loans or for their other high quality lending. Given the relatively high short-term rates, the CASA also has been under pressure. So today, people are very particular about making FDs and then doing those smart money swaps and things like that. And RBI is serious about adding liquidity. I think short-term rates will come down eventually, given the seriousness of RBI. And valuations are good. Asset quality is good. They haven't done much for a long period of time. I think it's a consensus buy in that sense.
Oh, absolutely. It's a consensus. Rajiv, Vikas, Amit, Lakshmi, and Vikas, thank you so much for your time today. And that's all that I have from this fabulous panel. Thanks a lot. You've been a great audience. Thank you so much.
Thank you.
All right, we've come down to our last two sessions, last two panels, last two speakers of the evening. And let's talk a little bit about psychology now. Psychology plays a crucial role in financial decisions, often leading to irrational choices driven by emotions, biases, herd mentality, even regrets, causing investors to overreact to market fluctuations, chasing trends or holding on to losing investments longer than necessary. Understanding these psychological traps is key to navigating the complexities, and to take this ahead, let me now bring up on stage Prashant Nair for the next discussion. And who better to talk about psychology than Morgan Housel, financial writer and renowned author of The Psychology of Money and Same as Ever. A lot of people have been waiting in for this session. His best-selling books have sold over 8 million copies in more than 60 languages. He's also a partner at the Collaborative Fund and a board member at Markle. Please welcome on stage Morgan Housel.
Thanks, Sonal, for that. Good evening, ladies and gentlemen. Thank you very much. And I think this is the session, I dare say, all of you have been waiting for. It's quite remarkable, Morgan's journey. Morgan, thank you very much, first of all, for being here. It's a great pleasure to be with you in person. Psychology of money. I mean, that's the, I'll tell you, I was telling Morgan a small anecdote. I have a 14-year-old daughter, and I was telling you this earlier. I've been trying to get her interested in finance and money for the last few years now without success. And I finally got her sort of onto The Psychology of Money, Morgan's book. And she's taken to it, hopefully, I think, in a full way over the next couple of years. So once again, thank you very much, Morgan.
Thank you. Thanks so much for having
So I
me.
want to start by asking you, how did you get started? How did you start writing? And writing so prolifically?
I started writing by accident. It was never part of the plan. I never wanted to be a writer. I never aspired to be a writer. I wanted to be an investment banker or a hedge fund manager. And I graduated college in 2008. Fun year, awesome year in the global economy, 2008. So, of course, nobody was hiring in 2008. Everybody was laying people off. One little story about that. In 2008, I submitted my resume to a large investment bank. And a week later, they hadn't responded. And I reached out and said, hey, I just wanted to make sure you got my resume. And they said, oh, I'm sorry, we laid off the entire HR department. There's nobody to receive your resume anymore. So that was what trying to find a finance job was like in 2008. So I needed something to do. I had no idea what I had no backup plan. And out of desperation, not out of enjoyment or skill, out of desperation, I took a job as a finance writer for the Motley Fool. And I thought I would do that for 6 months or so before I found a real finance job. But I ended up just sticking with it. And the first couple of years, I really didn't like it. I was not any good at it. It was not any fun. But I just needed a paycheck. But and then as the years went on, it got a little bit more enjoyable. I kind of found my niche a little bit. But I think lots of careers are like that. You often hear from college graduates in particular, or like recent college graduates, and they have a plan. I'm going to do this for 2 years, and I'm going to move to this career and get promoted here. And it never works like that. Like, it's great to have a plan, but almost everyone's career will just end up more serendipitous like that. And that was definitely true for me.
And you, in your books, you talk about the role of luck. So I think this is one of those, and I'll get to that in just a bit, right? But right at the beginning, how do you invest your money? I believe index funds, Morgan, a large part of it?
I keep it as simple as possible. And I always say, just because I invest like this doesn't mean I'm recommending other people do it. Because everybody is different. There's different geographies, different countries, different generations. But I keep it as painfully simple as I can. It's overwhelmingly index funds. And the reason I do that is not because I think nobody can outperform the market. I don't believe that. I think smart investors can, have, and will.
So just to be clear, you've got nothing against active investing?
Nothing in the slightest. But the variable that I want to maximize for is endurance. And if I can be an average investor for the next 30 or 40 or 50 years, I know that I'm going to achieve all of my goals and then some. And so it just comes down to what variable do you want to maximize. And some very smart people can maximize for annual performance. And that's great. They can do that. Some of them will do well. A lot of them won't, but some of them will. But if you instead just say, I'm going to maximize endurance and strength and longevity, I think that is more in your control. And over time, over the course of your life, I think you will maximize the actual dollars of wealth that you accumulate.
We've had in India, Morgan, I think the US is starting a bit of a wobbly, it's had a few wobbly sessions now. In India, of course, the market topped out in September. We had a painful correction, and now we're finding our feet once again. And a lot of people, when they are asked to describe what kind of market we had, they use this term, we had a narrative-based market, right? I mean, stories, narratives. And I think it's a topic you touch upon in your writings quite regularly, that at the end of the day, investing is storytelling. It's a number now multiplied by a story in the future. How important is that? I mean, is that recognition essentially? Because, you go through these cycles. Sometimes these stories and narratives do very well, but then we have periods when you have to go back to the numbers.
Yeah, it's always the case that markets are narrative driven, and the narratives change all the time. And I think sometimes we want to pretend in investing that of that equation, every valuation is a number from today multiplied by a story about tomorrow. We want to pretend that the number from today is the most important part, because it's what we can quantify, it's what we can look at. But the truth is, the story that we tell ourselves, positive or negative, is always the more important thing. And now, not to get too technical, but the lower interest rates are, the more powerful that story is. And for a lot of the last decade, at least in the United States, we had 0% interest rates. So the story was everything. And particularly in a social media driven world, the stories that people can tell themselves get ridiculous. Because no matter what you want to believe in investing, somebody is on Twitter saying it. You can find that narrative anywhere, and it creates a situation where the wildest stories, the craziest stories, just grab a hold and go and run away. I mean, look at Tesla, for example. Tesla makes a tiny fraction of the number of cars of Volkswagen, Toyota, General Motors, going on the list, but it's worth 20, 30, 50 times more than those other car companies. The other stat I saw the other day is that Ferrari makes 13,000 cars per year and is worth $90 billion. Volkswagen makes 9 million cars per year and is worth $40 billion. The difference between that is overwhelmingly just narrative. It's that Ferrari is fun and whatnot. There's different narratives involved. And I think this throws a lot of people for a loop if you are like analytically minded and you want to think that the world should work in clean, rational ways. You think like a spreadsheet. Then this world will drive you crazy. And you constantly think that the world is either a bubble or just like losing. You're always confused about what's going on. But when you view it as a narrative, then it starts to make sense. Yes, things are crazy. Yes, a lot of things don't make any sense whatsoever. No, you can't put a statistic on everything that's going on in the world. And it's always been like that, and it always will be.
And also a lot of it, what you said, those numbers about how many cars Ferrari, Volkswagen, etc. sell. I mean, one is looking back, and the other, of course, is betting on the future, which is the story, which is what you're talking about. Not necessarily wrong, but you have to acknowledge that's what's happening all around you, right? That's what you're saying.
Yeah, and those stories can change by the day, by the week.
Yeah.
You know, Donald Trump has come up with 17 different trade policies in the last week. So those stories change all the time. And it's always been the case, too, that hindsight gives us this idea that the past was way more certain than it actually was. So we go back and say, like, oh, there's a lot of uncertainty today, but we pretend like there wasn't uncertainty 10 years ago. That if we went back to 2015, that we were all calm and happy and everything was great. And of course, that's not the case whatsoever. If you went back to 2015, people were actually so worried and nervous about all the uncertainty that we had back then. We were just worried about something else. And so it is always the case that we assume that we never had uncertainty before now. which is, of course, complete nonsense. So is there uncertainty today in global? Of course. Of course, there's a lot, and no one knows what's going to happen next. And that has always been the case. So just coming to terms with that, I think makes investing, it's not that it becomes more comfortable, that you say like, oh, you know what's going to happen next. You become much more comfortable just shrugging your shoulders and say, I have no idea and nobody else does. And by the way, that's what you get paid for in investing, is putting up with uncertainty rather than assuming that you do know what's going to happen next.
I mean, as someone said, I'm much better with someone who tells me broadly what's going to happen rather than precisely what's going to happen. Right. I mean, that's the idea, right? And the other thing, of course, I mean, is it's a FOMO, fear of missing out. And it's a powerful sort of, it sucks people in. We've seen that here in India, right at the top. I mean, a lot of investors who write into us, ask us questions, and we say, well, show us your portfolio. And we look at the portfolios. There are a lot of stocks that we ask them, well, why did you buy it? There are no clear answers. I mean, there was that strong pull. Money begets money. And so that you can't resist it. It's just too strong. Just talk to us for a minute about that, because you write about that quite often.
Yeah, I think social media and just broader financial media makes it harder than it's ever been, because no matter how well you're doing, there is somebody out there who at least will tell you that they're doing better, whether they actually are or not. And so it creates this idea that you're always falling behind. And I think if there is one single financial skill that you have to have, absolute prerequisite to doing well over time, it's a lack of FOMO. You cannot do well financially over time if you're susceptible to FOMO. It's impossible. And really what FOMO is it's outsourcing your analysis to somebody else's emotions, is effectively what you're doing. You're looking at somebody else, some other asset class or some investor, and you're saying, they're doing better than I did. I need to catch up with them. You can't outrun that train. And so I think there's so many different financial skills that are important over time. The base of that pyramid, if you cannot control FOMO, you should give up at investing. It's never going to work.
But how do you get rid of it? I think everyone has it. One is born with it.
I think a lot of people have it. I don't know if everybody has it. There's a great quote from my friend Brent Beshore where he says, I am 100% happy watching you make money and get rich doing something that I have no interest in. And so I think you just have to understand what you're good at and what you're not. And if you can't describe what you are not good at, it's going to be very hard to do well as an investor. So most investors, if you ask them, what's your skill, they'll tell you what they're good at. Oh, I understand this industry. I have these connections. I think more important is for people to be able to very clearly outline what they cannot do and that they're staying away from. And this is another thing in investing where a lot of people are very well educated, a lot of big IQs, very smart people in the industry. Those are the people who are least likely to admit or to be able to explain what they are incapable of doing. And I think the best investors of the world are the ones who will list 100 things that they can't do, and they stay away from them. They never want to get close to it. And I think that's one way to avoid FOMO, is you can watch somebody getting rich in crypto or commodities. And I would say, I don't know anything about those industries. I know nothing about those industries. I'm going to stay 100 miles away. There's nothing I can do about it. I think knowing what you can't do and are incapable of is more important than knowing what you can do.
I think that's very well put. The role of luck is another thing you sort of talk about in your writings quite frequently, Morgan. In bull markets, we're all geniuses. I mean, it's a timeless story. But when the tide goes out, we start to look to blame someone. I mean, macros or Trump or tariffs or interest rates or something or the other, right? There's always something. But if you acknowledge that a large part of it is essentially, luck in a variety of ways, it's again admitting that you don't know you don't know it all. So it's kind of a buffer, isn't it?
Yeah, I mean, when people say luck, they hate that word, because if I say you got lucky, it just makes me look jealous and bitter. So I think luck can sometimes be the wrong word. But if you ask, what is repeatable? What is something that I know I can keep doing over and over again? That's very different. During the last 20 or 30 years, Bill Gross from PIMCO at the time was known as the greatest bond fund manager to ever live. He was known as the bond king. Nobody was better at managing bonds than he was. And he gave this very honest and humble interview a couple years ago where he was like, look, my career started when interest rates were at an all-time high and ended when interest rates were at an all-time low. As a bond fund manager, it does not get any better than that. And that was just a dumb piece of luck based on when he was born. And he said in the interview, he was, look, if I were born 10 years earlier or 10 years later, I would not have had the career that I had. Same with Warren Buffett. He, the greatest investor of all time, absolute genius, et cetera, everybody knows. If he were born 20 years later, he would not have had the career that he had. You know, when he made most of his money in percentage terms, kind of around the 1960s, 70s, he was buying blue chip companies for 2 times earnings. That doesn't exist anymore. So if Warren Buffett were 40 years old today, he would do well, he would do fine, but not nearly like he did at the time. It was a product of when he was born. And nobody wants to admit that they got lucky again. It's just, if I were born in a different country or a different generation, I would have a very different life. And so would you, and so would all of you. And sometimes that difference would be better, sometimes it would be worse. And so everyone wants to think that their successes were due to their hard work and genius, and any of their failures were just due to poor luck. Like, we're very cognizant of bad luck. We're very cognizant of risk. And we can identify very clearly when something didn't go right in our favor. But good luck, on the other hand, we always want to say that it was because of what we did right.
You know, you say focus on what is repeatable, what never changes, rather than trying to predict the next big thing, the next big event, the next big change in that sense. You know, there are those who would say, push back to that and say, well, you know, take where we are now, AI and all these big, huge technological changes which are happening. Of course, we don't know in what part of that entire value chain maximum amount of money would be made. But is it wrong to bet on those things? I mean, emerging technology. I mean, for example, internet back in, 99. I mean, if you just had to get that right to make a lot of money.
I think we know that now. Yeah. We know that in hindsight that was the case. But there are a lot of smart people back in the late 1990s who really genuinely thought the internet was a fad. We could poke fun at that. But there were also a lot of things that we thought were the future that never happened. I mean, one of my favorite examples of this is the Wright brothers created the first functioning airplane. The people who invented the airplane did not think that it had any commercial use. They targeted their airplane almost exclusively to the U.S. Army because they thought that was the only use case that they would have for an airplane. No, even the Wright brothers did not foresee that you could fly around the world, you could go on your vacations, you could fly from Seattle to Mumbai like I did yesterday. The people who invented the plane didn't see it coming. And I think, too, if you asked Bill Gates back in the 1980s what the personal computer would come to, he would not have gotten it right. So even the people who have the most inside information, who create these products, cannot foresee what they're going to go to. So it's obvious now that AI is going to do something very different to the world, that the world 10 years from now will not be the world that it is today because of AI. But even the people who work at OpenAI, even the people developing these models, have no clue what those changes are going to do. That's always been the case with new history.
I think you're absolutely right. Here in India, for example, a lot of people always say, well, HDFC Bank, one of the largest private sector banks in the country, compounded for 20% for many, many years. We'll say, you should have bought HDFC Bank back then. I mean, but it was never clear. I mean, the people running HDFC Bank did not know that it would become HDFC Bank. I'm just giving an example, like what you did with Microsoft or, other companies in the US. So just a quick point. I mean, in the US right now, AI and tech, since we're on that topic, do you think, is there any way to tell whether it's a bit of a bubble at this point, Morgan? I mean, the way these companies are being valued?
I think, one example I've used before is if you go back to the early 1900s, there were 2,000 car companies in the United States, and 1,997 of them went bankrupt. And don't exist anymore. The survivors were GM, Ford, and Chrysler, 2 of which themselves ended up going bankrupt eventually. And so it's always the case that in any new industry, in 10 or 20 years time, 90% of the companies don't exist anymore. It's true, too. If, let's say it's back in the 1990s, and you believe the internet is the future, what companies would you have bet on? AOL, AskJeeves.com, all these companies that don't exist anymore, Yahoo,
Pet foods or something.
Exactly. And nobody would have said Google, which was a tiny little startup, Facebook, which obviously didn't even exist yet. Mark Zuckerberg was still in high school. And so it's always the case in any new industry that even if you get the trend right, getting the individual names right is 1,000 times harder.
Do we have but in the AI space in the US, do we have a bubble, you think so? Or you have a view, you feel strongly about it at all? one way or the other?
I think I think it's not mutually exclusive to say this industry is going to fundamentally change the world, and the vast majority of investors will lose a lot of money. I mean, this is true for railroads in the United States, which is probably the most transformative new industry that we've ever had in the U.S. was railroads back in the 1800s. It just took the country from the Stone Age into the modern world. And I forget the exact statistic, but I think 97% or something like that of railroads went out of business. So this completely changed the world. Like nothing was more transformative. And if you're a railroad investor, almost everybody lost money. I mean, same with airlines. You know, completely transformed society in every way imaginable. And virtually every airline investor for the last century has lost their money. So it's not uncommon for that to be the case, that industries that are the most transformative for society are the most difficult for investors to make money on. And by the way, if the opposite is true, would have been some of the best investments to make over the last 100 years, cigarettes, beer, toilet paper, like the most boring things that don't change the world at all can in some cases be incredible investments as well.
Impact on investing, just to finish that point about AI, is it already changing the way investing is done? Artificial intelligence, tools related to it?
I think it's an extension of a trend that's been going on for a long time, which is that even 20 years ago, having information, having different information was what set different investors apart. So Buffett used to talk about this. The reason that he was so successful back in the 1960s is because he was the only investor in the world practically who was willing to sift through every single annual report. And he would go through thousands and thousands. He had an informational advantage just out of effort that other people didn't have. And you know, that was true 20 or 30 years ago, that Goldman Sachs had information that you and I didn't. And so they were going to earn better returns than us. And I think by and large that doesn't exist anymore. That virtually every investor is looking at the same information with the same models. Broadly, that is true because it's all right here and it's all for free. And so AI is an extension of that, where, you know, now it's moving into having knowledge is not really that much of any competitive advantage. That the information that you could get by having your CFA or whatnot, that takes years and years to get, and they're, you know, very educated people, that now you have that in an LLM and everybody in the world has access to it on their phone. And I think what that means in that world where information and even intelligence is not a competitive advantage anymore, of course I'm talking my own book here, but that's when behavior becomes more important. It's like if everybody has the same information and the same models, then the person who has the best behavior is going to be the one who wins. That's definitely the case. Was not the case in the past, but it is more and more the case these days. And that's why I think it becomes less and less about, can you pick the right companies? Do you pay attention to where the economy is going this quarter? That becomes less and less important, and all that matters effectively is, can you keep your head on straight during moments of turmoil? Are you going to panic?
Behavior and temperament.
That's always been important, but it's more important now than it's ever been.
Yeah. Mogul, we read what you write. What do you read?
I read anything that looks even remotely interesting to me, from any topic imaginable. So a very wide funnel where I'll start reading anything. But I have a very tight filter in terms of if a book or an article is not hooking me in, I abandon it very quickly. And so I probably only finish maybe 5% of the books that I start. And I think a lot of people don't like reading because they feel obligated to finish every book that they start. And I think that's a mistake. If a book's not working for you, you should quit very quickly. And so I'll start reading almost anything, but I quit it quickly.
Ladies and gentlemen, we have the Chief Minister of Maharashtra, Devendra Fadnavis, in the hall with us. A round of applause for Mr. Fadnavis. Thank you, sir. I mean, just to wrap this up, Morgan, who are your heroes in life and investing?
There's a great song, or a great quote from the Foo Fighters song, There Goes My Hero. And the quote is, "There goes my hero, he's ordinary." And I love that idea because if you're a student of history, like most people in this room are, most of history is about the big figures. Winston Churchill, Thomas Edison, like the big people that we all know. But that is such a small fraction of history. The vast majority of history are ordinary people who are trying to do a little bit better, raising their family, living a better life, that I think have the most interesting stories. And so many of my heroes are just ordinary people that never get any attention, never get any press or limelight, but those are the people who in aggregate can live incredible lives and actually move the world forward.
Absolutely, so well put. And I think you bring out those stories so well in your books. And that's what makes your books so enriching, insightful, and entertaining. And I hope I get my daughter to sort of stay on the book and sort of ignite a spark in finance through your books, as I think all of us have done here. Thank you very much, Morgan House, for being with us here this evening. Appreciate it. Thank you very much.
Prashant. Ladies and gentlemen, we've come to the final session of the evening and I'd like to invite upon stage Nalin Mehta to introduce our next guest.
Thanks very much, Sonal. As we race towards the grand finale of the Moneycontrol Global Wealth Summit, it's only fitting that we close with a leader who's been instrumental in driving India's economic powerhouse, Maharashtra. Under his visionary leadership, Maharashtra has not only cemented its status as India's financial capital, but is also on the path to becoming the country's first trillion-dollar sub-economy. He's championed a policy-driven approach that attracts global investments, fosters technological advancements, and promotes sustainable development. Ladies and gentlemen, it is our great privilege and honor to have amidst us the dynamic Chief Minister of Maharashtra, Devendra Fadnavis, for a conversation on Maharashtra. देवेंद्र जी, सबसे पहले बहुत 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 धन्यवाद। आप असेंबली का सत्र चल रहा है, आप बजट सत्र वहां से समय निकालकर मनी कंट्रोल ग्लोबल वेल्थ समिट के मंच पर आए, बहुत बहुत धन्यवाद।
मैं सीधा असेंबली से भाषण करके यहाँ पहुंचा हूँ।
सो देवेंद्र जी, आप हिंदुस्तानी राजनीति के कमबैक मैन हैं। आपने बहुत फेमसली कहा था, मी पुनः येनार। नाउ यू आर बैक विद अ बैंग। आपकी जो सेकंड इनिंग्स है एज मुख्यमंत्री, अब 3 महीने हो गए हैं, तो ये पहली इनिंग्स और इसमें क्या अंतर है?
मेरे लिए तो एक प्रकार से एक्सटेंशन है। पहली जो मेरी इनिंग थी उसमें जो चीजें हमने की थी, उन चीजों को कंप्लीट करने का पिछले 2.5 साल में हमको एक अवसर मिला और उसी को मैं आगे बढ़ाने की कोशिश अब कर रहा हूं। हाँ, मुझ में खुद में एक अंतर मैं देखता हूं कि नाउ आई एम मोर काम एंड कंपोज्ड, और पहले 5 साल में जो एक एंजाइटी होती थी वो मेरे लिए अभी बची नहीं है, और पूरे फोकस के साथ अब मैं काम कर रहा हूं। तो मुझे लगता है कि इस इनिंग में जो हमने 14 से 19 में नींव रखी थी, अब उस नींव पर महाराष्ट्र को बिल्ड करना, ये हम लोग इस 5 साल में करके दिखाएंगे।
देवेंद्र जी, आप कह रहे हैं आप काम एंड कंपोज्ड हैं, लेकिन आपने जो टारगेट्स लिए अपने लिए वो बहुत अग्रेसिव हैं। आपने कहा कि आप महाराष्ट्र को 1 ट्रिलियन इकोनॉमी बनाएंगे और बहुत जल्द। ये कैसे होगा और कितनी जल्दी होगा?
देखिए, एक्चुअली हम लोगों ने 2016-17 में पहली बार इस आइडिया को मूट किया, इस आइडिया को लोगों के सामने रखा कि महाराष्ट्र ये पहली $1 ट्रिलियन सब नेशनल इकोनॉमी बन सकती है। और पिछले समय हम लोगों ने एक इकोनॉमिक एडवाइजरी काउंसिल तैयार की, और उस काउंसिल में एन चंद्रशेखरन जो टाटा सन्स के उसके अध्यक्ष थे, अलग अलग सेक्टर के 20 सीईओज हमने उस काउंसिल में उनको सदस्यता दी, और एक रोड मैप हम लोगों ने तैयार किया $1 ट्रिलियन इकोनॉमी की तरफ। हम लोग जानते हैं कि अभी देश में महाराष्ट्र इज द ओनली स्टेट कि जिसने ½ ट्रिलियन का मार्क पार किया है, बाकी सारे काफी दूर है। और अगर आप कोविड ईयर्स को अगर छोड़ दे तो हमारा CAGR 10% है, और बिजनेस यूजुअल को छोड़कर थोड़ा और हम लोग इसको डेवलप कर पाए तो मुझे लगता है कि 2030 तक हम लोग महाराष्ट्र को $1 ट्रिलियन इकोनॉमी बना पाएंगे। और उसी दिशा में हम लोगों ने इंफ्रास्ट्रक्चर लेड ग्रोथ होगा, टेक्नोलॉजी लेड ग्रोथ होगा, इन्वेस्टमेंट लेड ग्रोथ होगा। ऐसे अलग अलग प्रकार के हम लोगों ने इसमें जो सेक्शंस है वो तैयार किए हैं और उस दिशा में बड़ी तेजी के साथ हम जा रहे हैं। और मैं ऐसा मानता हूं कि महाराष्ट्र की अपनी एक ताकत है इन्वेस्टमेंट अट्रैक्ट करने की, और उस ताकत को हम लोग लिवरेज करने की कोशिश कर रहे हैं, क्योंकि महाराष्ट्र एक ऐसा राज्य है जो एक अपनी रफ्तार में चलता है। आपका काम यानी सरकार का काम केवल गुड गवर्नेंस देना होता है। उस रफ्तार को हम नहीं तोड़े, इतना भी हमने कर लिया तब भी महाराष्ट्र आगे बढ़ता है। तो मुझे पूरा विश्वास है कि ये जो $1 ट्रिलियन इकोनॉमी है यहां तक हम पहुंच पाएंगे। और विशेष रूप से आज जब हम लोग देखते हैं कि टेक्नोलॉजी ने, एआई ने जिस प्रकार से हमको अवसर दिए, उन अवसरों के कारण हम इसको एक्सीलरेट कर पाएंगे।
निरंजन जी, आपने इन्वेस्टमेंट की बात की। इस ऑडियंस में बहुत ग्लोबल इन्वेस्टर्स बैठे हैं और हिंदुस्तान के कई इन्वेस्टर्स बैठे हैं। तो महाराष्ट्र को ऑलरेडी फॉरेन डेवलपमेंट, फॉरेन एफडीआई जो है सबसे ज्यादा भारत के सब स्टेट में मिलता है, 52% पिछले क्वार्टर में। तो ऐसा क्यों है और आप क्या स्टेप्स लेंगे कि आपका एफडीआई और बढ़े ताकि आप बिजनेस एज यूजुअल से ऊपर चले?
देखिए, एफडीआई में तो ये साल हमारे लिए बहुत ही अच्छा रहा है, क्योंकि अभी तक एफडीआई का हमारा जो रिकॉर्ड था वो 2016-17 का था, जिस समय हमको 1,31,000 करोड़ का इन्वेस्टमेंट आया था उस पूरे साल में। लेकिन पिछले 9 महीनों में ही हम लोगों को 1,39,000 करोड़ का निवेश ये एफडीआई के माध्यम से आया है। तो हमने खुद का ही रिकॉर्ड तोड़ा है। और मुझे ये बताते हुए खुशी होती है कि हमारे पीछे के जो 4 राज्य है, 3 राज्य है, उनकी टोटल भी हम मार ले पूरा उसको, मतलब उनको जो एफडीआई मिला है उसकी टोटल भी कर ले तो उससे ज्यादा एफडीआई ये महाराष्ट्र को मिला है। और मैं ऐसा मानता हूं कि लगातार बीच के अगर 2 साल छोड़ दे, जिस समय महाविकास आघाड़ी की सरकार थी, 2015 से हमने टॉप करना चालू किया एफडीआई में, और वो हम लगातार टॉप कर रहे हैं। और मैं ऐसा मानता हूं इसका एक ही कारण है कि जो फॉरेन इन्वेस्टर होता है वो स्टेबिलिटी देखता है, वो वर्क कल्चर देखता है, वो हम लोग बिजनेस फ्रेंडली कितने वो देखता है, ईज ऑफ डूइंग बिजनेस, कॉस्ट ऑफ डूइंग बिजनेस, ये चीजें देखता है। इन सब चीजों पर हम लोगों ने बहुत वर्किंग किया है और उसके कारण मैं ऐसा मानता हूं कि ये आ रहा है। और सबसे बड़ी बात यह है कि जो आपने कहा इसको और कैसे बढ़ा सकते हैं, तो जितने इमर्जिंग सेक्टर्स है, ये सारे इमर्जिंग सेक्टर्स की पॉलिसीज हमने तैयार की है टू अट्रैक्ट द इन्वेस्टमेंट। बड़े पैमाने पर ये पॉलिसीज तैयार की है और इन पॉलिसीज के कारण मैं ऐसा मानता हूं कि बड़े पैमाने पर ये निवेश महाराष्ट्र में आ रहा है।
जी, आपने ये भी कहा है कि आप महाराष्ट्र को भारत की फिनटेक कैपिटल और डेटा कैपिटल के रूप में देखते हैं, मुंबई को। तो ये इसके क्या मायने हैं आपके हिसाब से और ये किस तरह से होगा?
देखिए, मैं ऐसा मानता हूं कि महाराष्ट्र डी फैक्टो फिनटेक कैपिटल भी है और डेटा कैपिटल भी है। फिनटेक कैपिटल इसलिए कि आज मुंबई, अगर आप देखिए हम जिस बीकेसी में बैठे हैं, यहां पर फिनटेक में हुज हु ये इसी बीकेसी में। और अभी हम लोगों ने एनपीसीआई को यहां जमीन दी है। एनपीसीआई अपना ग्लोबल हेडक्वार्टर यहां बना रहा है। हम लोगों ने नेशनल स्टॉक एक्सचेंज को हम लोग जमीन दे रहे हैं, वो भी यहां पर आ रहा है। तो कुल मिलाकर फिनटेक में जो सारी हमारी इंटरनेशनल बैंक्स है वो सारी यहां पर है, इंटरनेशनल फंड्स है वो सारे यहां पर है। अलग अलग प्रकार की जितनी मुझे ऐसा लगता है कि फिनटेक की जो अलग अलग विधाएं है वो सारी आपको इस बीकेसी में या मुंबई में दिखाई पड़ती है। और साथ साथ मैं एक चीज और बताना चाहता हूं कि चूंकि अभी जो स्टार्टअप इंडिया का एक नया रिपोर्ट आया है, इस रिपोर्ट ने 3 चीजें एक प्रकार से यहां पर अधोरेखित की है। पहली चीज, इन एब्सोल्यूट नंबर महाराष्ट्र स्टार्टअप कैपिटल, सबसे ज्यादा देश के स्टार्टअप्स ये महाराष्ट्र में है। इन एब्सोल्यूट इन्वेस्टमेंट महाराष्ट्र इज नंबर 1 इन स्टार्टअप्स, क्योंकि सबसे ज्यादा इन्वेस्टमेंट स्टार्टअप का महाराष्ट्र में है। और इसके साथ साथ फिनटेक के सबसे ज्यादा स्टार्टअप ये भी महाराष्ट्र में है, ये भी हमको देखने को मिलता है। तो मैं ऐसा मानता हूं कि एक प्रकार से ये फिनटेक कैपिटल डिफैक्टो है और धीरे धीरे बन भी रहा है।
अगर मुंबई में कोई कंपनी स्टार्टअप हो बैंगलोर के बनस्पत तो उसकी वैल्यूएशन ज्यादा होगी
जी।
अगर मुंबई में कोई स्टार्टअप हो और बैंगलोर में हो तो मुंबई में वैल्यूएशन ज्यादा होगी।
अभी तो हो रही है ज्यादा। एक समय था लोग मुंबई में स्टार्टअप शुरू करते थे और बैंगलोर जाते थे, अब रिवर्स माइग्रेशन चालू हो गया है, क्योंकि अभी मुंबई में अगर पिछले 2 साल की ग्रोथ आप स्टार्टअप्स की देखें, फेनोमेनल ग्रोथ है। और कुछ स्टार्टअप्स ने तो इस प्रकार की इन्वेस्टमेंट अचीव की है कि जो बिल्कुल अप्रत्याशित इस प्रकार की है। तो इसलिए मुझे लगता है कि नाउ ऑफ कोर्स फॉर लॉन्ग टाइम बैंगलोर ने स्टार्टअप इकोसिस्टम को अच्छे से नर्चर किया है, बट अब मुंबई यही स्टार्टअप कैपिटल अपना बना है और जो एब्सोल्यूट नंबर में और एब्सोल्यूट इन्वेस्टमेंट में भी दिखता है। और साथ साथ आपने डेटा की बात की तो ये भी मुझे बताते हुए बहुत खुशी होती है कि हमारे देश में जितनी डेटा सेंटर कैपेसिटी हमने तैयार की है उसकी 65% कैपेसिटी ये अकेले महाराष्ट्र में है और लगातार वो बढ़ रही है और बहुत बड़े पैमाने पर इस क्षेत्र में निवेश हमारे पास आ रहा है। हमने हमारी डेटा पॉलिसी तैयार की है, जिस डेटा पॉलिसी में डेटा सेंटर के लिए जो चीजें आवश्यक है वो चीजें हम दे रहे हैं। सबसे महत्वपूर्ण है कि डेटा सेंटर्स के लिए मतलब एक प्रकार से पावर इज देयर रॉ मटेरियल, तो उनको पावर मिले, वो क्लीन पावर मिले, उनको ग्रीन पावर मिले, इस दृष्टि से भी बहुत बड़े पैमाने पर हम लोग वर्किंग कर रहे हैं। तो इसीलिए देश का मैं ऐसा मानता हूं कि डेटा सेंटर कैपिटल भी अब महाराष्ट्र बन चुका है।
सो देवेंद्र जी, इस वक्त ग्लोबल बिजनेस में काफी वॉलेटिलिटी है, मार्केट्स में वॉलेटिलिटी है, टैरिफ्स की बात हो रही है और चाइना +1 की भी बात है। तो ग्लोबल सप्लाई चेन में महाराष्ट्र को इंटीग्रेट करने के लिए आप क्या क्या कदम उठाएंगे?
मुझे ऐसा लगता है कि एक नेवर बिफोर अपॉर्चुनिटी हमारे लिए तैयार हुई है, क्योंकि कोविड के डिसरप्शन के बाद जब दुनिया के ध्यान में आया कि वी कैन नॉट पुट ऑल एग्स इन वन बास्केट और हम लोगों को सप्लाई चेन में दूसरे सेंटर्स खड़े करने पड़ेंगे। ये बात भी सही है कि शुरुआत में लोग कुछ 2-3 देशों की तरफ गए, पर बाद में उनके ध्यान में आया कि इन देशों में इतना इन्वेस्टमेंट लेने की कैपेसिटी भी नहीं है, इतना ह्यूमन रिसोर्स भी नहीं है। तो अब धीरे धीरे सबको ये लगता है कि नई सप्लाई चेन का सेंटर भारत हो सकता है और उसी दृष्टि से भारत में बहुत बड़े पैमाने पर अभी सप्लाई चेन तैयार हो रही है। हम लोगों का प्रयास है कि सप्लाई चेन का, ग्लोबल सप्लाई चेन का एक प्रकार से भाग होने के लिए जिस प्रकार की इंडस्ट्रीज की आवश्यकता है, जिस प्रकार के इंफ्रास्ट्रक्चर की आवश्यकता है, जिस प्रकार से उसके कल्चर की आवश्यकता है, ये सारी चीजें हम लोग महाराष्ट्र में डेवलप कर रहे हैं। वी आर डेवलपिंग बेस्ट ऑफ द इंफ्रास्ट्रक्चर इन रोड्स, वी आर डेवलपिंग बेस्ट ऑफ द इंफ्रास्ट्रक्चर इन डेटा, क्योंकि हम लोग ये जानते हैं कि अब हम मतलब स्पीड ऑफ डेटा जो है वो बहुत महत्वपूर्ण है इसके लिए। उस स्पीड ऑफ डेटा के लिए हम लोगों ने उसी प्रकार का काम किया है और बड़े पैमाने पर इंडस्ट्रीज हमारे यहाँ जो आ रही है मैन्युफैक्चरिंग की, तो मुझे ऐसा लगता है कि एक प्रकार से वो साइकिल या जो है उसको कंप्लीट करने का काम हम लोग कर रहे हैं। एक उदाहरण के तौर पर आपको बताना चाहता हूं कि समझ लीजिए पुणे है, तो एक जमाना था कि पुणे में बाहर से इंजन आता था और यहाँ पर सारी चीजें असेंबल होती थी। अब धीरे धीरे हमारी सप्लाई चेन ऐसी तैयार हो गई है कि 80 to 85% सारी जो चीजें बनती है वो इन एंड अराउंड पुणे ही बनती है और अब वहां से एक्सपोर्ट होना शुरू हो गया है। सो ये जो एक सप्लाई चेन तैयार हो रही है ये मैं ऐसा मानता हूं कि बहुत महत्वपूर्ण है। और जैसे आज जेएनपीटी पोर्ट है वैसे ही हम लोग वाड़भन पोर्ट तैयार कर रहे हैं, जिसके कारण एक प्रकार से ये सप्लाई चेन को एस्टेब्लिश करने में हमको बहुत फायदा होगा।
देवेंद्र जी, आपने डेटा की बात की, फिनटेक की बात की, आजकल एआई की वजह से सारा डिस्ट्रप्शन हो रहा है, तो सेमीकंडक्टर्स को लेकर इन्वेस्टमेंट के लिए आप क्या करेंगे? महाराष्ट्र में वो इन्वेस्टमेंट अभी नहीं आया है, तो कैसे आप उसको बताएं?
ऐसा नहीं है, सेमीकंडक्टर में हमारे इन्वेस्टमेंट आया। वैसे आपको पता है कि सेमीकंडक्टर ये 7 स्टेप इस प्रकार की प्रक्रिया है। इनमें से अलग अलग स्टेप्स के लिए हमारे पास 6 इन्वेस्टर्स आए हुए हैं जिन्होंने ऑलरेडी इन्वेस्ट किया है। कोई वेफर बना रहा है, कोई और कुछ बना रहा है, इस प्रकार का इन्वेस्टमेंट है। लेकिन एक समग्र जो प्रोसेस होती है इसके लिए भी टावर सेमीकंडक्टर विद अडानी इन्होंने हमारे यहाँ पर निवेश किया हुआ है और कंप्लीट जो सेमीकंडक्टर इकोसिस्टम है वो इकोसिस्टम हमारे यहाँ पर टावर के माध्यम से हो रही है। बाकी ओसैट में हमारे यहाँ इन्वेस्टमेंट आया है, वेफर में हमारे यहाँ इन्वेस्टमेंट आया है। तो सेमीकंडक्टर की जो एक इकोसिस्टम है उस इकोसिस्टम को हम लोग एस्टेब्लिश कर चुके हैं, उसमें निवेश भी आया है और मुझे लगता है आगे और निवेश इस क्षेत्र में हमारे पास आएगा।
क्या आपकी टेस्ला से कुछ बातचीत हो रही है इन्वेस्टमेंट्स को लेकर?
देखिए, टेस्ला आया ऐसा कौन नहीं चाहता, कई राज्य चाहते हैं, वैसे हम भी चाहते हैं, फैसला उनको लेना है। पर अगर वो मुझे पूछे तो मैं तो बताऊंगा कि बेस्ट केस इज महाराष्ट्र, और वही बताने का प्रयास हम लोग कर रहे हैं, वी आर ट्राइंग।
तो मुंबई को का फाइनेंशियल कैपिटल का जो स्टेटस है उसको और इन्हांस करने के लिए आप क्या स्टेप्स लेंगे? क्या आप एक और गिफ्ट सिटी यहाँ बनाएंगे, सेकंड गिफ्ट सिटी ऑफ इंडिया?
देखिए, कुल मिलाकर अगर हम लोग देखें तो मुंबई जो अभी अपना शहर है, इस शहर में आज हम लोग देख सकते हैं कि फिनटेक हो या अलग अलग प्रकार की बिजनेस अपॉर्चुनिटीज हो, ये तो बहुत बड़े पैमाने पर तैयार हुई और ये एक डिफैक्टो हमारा एक प्रकार से फाइनेंशियल कैपिटल बना है। लेकिन अब हम लोग ये प्रयास कर रहे हैं कि मुंबई और नवी मुंबई इसके बीच हम लोगों ने अभी 22 किलोमीटर का अटल सेतु तैयार किया है। इस अटल सेतु के कारण अभी मुंबई को हम हिंटरलैंड तक एक्सटेंड कर पाए और यहाँ पर हम लोग एक, चूंकि हमने वहां न्यू एयरपोर्ट भी तैयार किया है, तो बिटवीन अटल सेतु एंड न्यू एयरपोर्ट हम लोग एक नया शहर बनाने की कोशिश कर रहे हैं। जो नया शहर ये मतलब मुंबई के भी 3 गुना बड़ा शहर होगा, जिसको हमने नैना कहा है, न्यू मुंबई एयरपोर्ट इन्फ्लुएंस एरिया, इस प्रकार से उसको हम लोगों ने कहा है। और यहाँ पर हम लोग एक प्रकार से स्कीमेटिक इस प्रकार का काम कर रहे हैं। तो यहाँ पर हम लोग करीब 300 एकड़ में एक इनोवेशन सिटी बनाना चाहते हैं, जिसका अभी हम लोगों ने एन चंद्रशेखरन जो टाटा सन्स के उन्होंने वॉलंटियर किया है, उसका एक पेपर वो पुटअप कर रहे हैं। और जैसे ही हमने ये इनोवेशन सिटी अनाउंस की तो हुज हु इन इनोवेशन ये हम लोगों के साथ अभी बातचीत कर रहे हैं। तो एक बहुत ही मुझे ऐसा लगता है कि नेक्स्ट लेवल की इनोवेशन सिटी हम तैयार करेंगे। एक एजू सिटी हम लोग वहां पर तैयार कर रहे हैं। ये एजू सिटी इस प्रकार का कॉन्सेप्ट है कि हम लोग चाहते हैं कि चूंकि अभी हमारे नए रेगुलेशंस के कारण जो फॉरेन यूनिवर्सिटीज है वो यूनिवर्सिटीज को ऑफशोर कैंपस वो खोल सकते हैं। तो उसके लिए हम लोगों ने एक एरिया तैयार किया है जहां पर हम ये चाहते हैं कि 10 से 15 जो बहुत ही हाई रैंकिंग फॉरेन यूनिवर्सिटीज है उनको हम लोग वहां पर लाए। और उसमें से
किसी यूनिवर्सिटी से बातचीत चल रही है?
4-5 अच्छी यूनिवर्सिटीज है। चूंकि नॉन डिस्क्लोजर अभी एग्रीमेंट हमारा उनके साथ हुआ है, इसलिए मैं अभी नहीं बताऊंगा, उचित स्टेज पर मैं बताऊंगा। लेकिन 4-5 जो यूनिवर्सिटीज के साथ हमारी बातचीत अंतिम स्टेज पर है, ये बिल्कुल दुनिया की वेरी हाई रैंकिंग इस प्रकार की, जिनका बहुत नाम है, इस प्रकार की यूनिवर्सिटीज हम लोग वहां लाने की कोशिश कर रहे हैं। तो मुझे लगता है कि कुल मिलाकर यहाँ पर हमारा जो इंडस्ट्री 4.0 हम जिसको कहते हैं, जो आज हमारे पूरे इकोनॉमी को एक्सेलरेट कर सकता है, वो सारा इंडस्ट्री 4.0 ये आपको न्यू मुंबई में दिखेगा। और एक नया बिजनेस मैग्नेट के रूप में या एक नया फाइनेंशियल कैपिटल का एक्सटेंशन इस रूप में हम लोग उसको तैयार करने की कोशिश कर रहे हैं।
देवेंद्र जी, लोग कहते हैं कि गुजरात को कई बार ज्यादा इन्वेस्टमेंट मिल जाती है महाराष्ट्र के मुकाबले। हाउ डू यू रिएक्ट टू दोस काइंड ऑफ कमेंट्स एंड दैट ऑब्जर्वेशन?
देखिए, पहली बात तो यह है कि गुजरात अगर डेवलप होता है तो उसका भी मुझे आनंद है, आई एम वेरी हैप्पी। कर्नाटक भी होता है तो आई एम वेरी हैप्पी। जहां तक इन्वेस्टमेंट मेरे देश में आ रहा है तो मैं बहुत खुश हूं। अब 10 स्टेट एक दूसरे के साथ कॉम्पीट कर रहे हैं, तो कोई इन्वेस्टमेंट उनके पास जाएगा, कोई हमारे पास आएगा। लेकिन हैविंग सेड दैट, मैं आपको बताना चाहता हूं, अभी जो मैंने आपको एफडीआई के आंकड़े बताए, गुजरात में जितना एफडीआई आया उससे 3 टाइम्स ज्यादा हमारे आया है महाराष्ट्र में, 3 टाइम्स। तो मैं ये कहना चाहता हूं कि महाराष्ट्र was, is and will be the most favored destination for the investors। इसलिए एखादा प्रोजेक्ट गुजरात में चला गया तो गुजरात आगे चला गया, एक आधा प्रोजेक्ट कर्नाटक चला गया तो कर्नाटक आगे चला गया, ऐसा बोलना ठीक नहीं है। महाराष्ट्र ही नंबर 1 है और महाराष्ट्र ही नंबर 1 रहेगा।
देवेंद्र जी, देवेंद्र जी, अभी बजट सत्र चल रहा है, चुनाव को हुए अभी 3 महीने हो गए हैं, तो रेवडीज को लेकर बहुत डिस्कशन है और चुनाव में कई प्रोमिसेस किए गए जिसकी कॉस्ट बहुत ज्यादा होगी उनकी। तो आप बजट को बैलेंस किस तरह करेंगे और ये जो प्रोमिसेस जो है, एट व्हाट पॉइंट विल यू ड्रॉ रेड लाइन अराउंड रेवडीज?
देखिए, पहली बात तो यह है कि आपने जो कहा उसमें सच्चाई है कि हम लोगों ने अलग अलग प्रकार की जो योजनाएं शुरू की, आज उसकी कॉस्ट हम लोगों को सालाना 60,000 करोड़ रुपया देनी पड़ती है, 60,000 करोड़। लेकिन इन योजनाओं के माध्यम से मैं ऐसा मानता हूं कि सोशल सेक्टर में हम लोग एक प्रकार की इन्वेस्टमेंट कर रहे हैं। और जैसे हमारी लाडली बहन योजना है जिसमें बहनों को 1500 रुपए हम लोग दे रहे हैं, अब हम लोगों ने उसमें एक नई स्कीम लाई। हमारे यहाँ नागपुर की महिलाओं ने एकत्रित आकर एक फाइनेंस सोसाइटी तैयार की एक, और उस सोसाइटी में 30 लाख रुपए उन्होंने जमा किए छोटे छोटे लोगों से ही, और उसका एक बिजनेस मॉडल तैयार किया। अब हम लोग प्रयास कर रहे हैं कि ये जितने हम लोग ये 1500 रुपए जो हमारी बहनों को देते हैं, इनकी हम लोग इसी प्रकार से एक फाइनेंस सोसाइटी हर जगह तैयार करके और उसमें से एक बिजनेस मॉडल तैयार करें, ताकि ये केवल 1500 रुपए लेकर वो खुश न रहे। तो हम लोग उनको अलग अलग प्रकार से अपने इकोनॉमी में कंट्रीब्यूट करने के लिए ह्यूमन रिसोर्स के रूप में या कंट्रीब्यूटर्स के रूप में उनका इस्तेमाल करते। जैसे हमारे प्रधानमंत्री जी ने लखपति दीदी की योजना लाई, तो महाराष्ट्र ने हमने तय किया कि हम लोग 1 करोड़ लखपति दीदी बनाएंगे। पिछले साल में हम लोगों ने करीब 23 लाख लखपति दीदी बनाए। इस साल हम लोगों ने टारगेट रखा है 25 लाख बनाएंगे, और ऐसा करके 1 करोड़ हमारी बहनों को जो सालाना 1 लाख रुपए से ज्यादा कमाती है, ऐसी लखपति दीदी बनाने का प्रयास हम लोग कर रहे हैं। तो ये सही है कि अब ये सारा इन्वेस्टमेंट जब आप लोग इस प्रकार का एक रेवेन्यू साइड पर करते हो तो उसका एक बजट के ऊपर स्ट्रेस तो आता है, लेकिन हम लोग मैनेज करने की कोशिश कर रहे हैं। और हम लोगों ने ये प्रयास किया है कि इसका असर हमारे कैपिटल इन्वेस्टमेंट पर न हो। उस दृष्टि से हम लोगों ने बहुत बड़े पैमाने पर प्राइवेट सेक्टर की मदद से और अलग अलग इंस्ट्रूमेंट्स को तैयार करके हम लोग हमारे निवेश हमारे यहाँ कर रहे हैं। तो मैं ऐसा मानता हूँ कि कैपिटल एक्सपेंडिचर को कम किए बिना हम लोग हमारे बजट को बैलेंस करने की कोशिश कर रहे हैं।
देवेंद्र जी, धारावी रीडेवलपमेंट प्रोजेक्ट का अभी क्या स्टेटस है?
देखिए, धारावी रीडेवलपमेंट प्रोजेक्ट शुरू हो चुका है। इसमें इसका पहला स्टेज ये है कि हाउस टू हाउस सर्वे, तो ये सर्वे 75% कंप्लीट हो चुका है और अपेक्षित ये था कि मार्च के एंड तक ये सर्वे हम लोग पूरा कंप्लीट कर लेंगे, जिसके कारण एलिजिबिलिटी और इन एलिजिबिलिटी इसको हम फाइनल कर पाएंगे। तो वो चीजें मुझे लगता है अप्रैल तक हम लोग करेंगे। लेकिन साथ साथ जो प्रोजेक्ट अफेक्टेड लोगों के लिए या जिनको घर देना है या ट्रांजिट कैंप देना है, उसकी शुरुआत ऑलरेडी हो गई है। जो रेलवे की लैंड हम लोगों ने ली थी, उस लैंड पर रेलवे को कुछ ऑफिसेस बनाकर देना है और बची हुई लैंड पर हम लोग घर बनाना शुरू करेंगे, और उसके बाद एक एक सेक्टर को हम खाली करते जाएंगे, और कुछ और जगह भी हम लोगों ने घर बनाना शुरू किया है। तो जिसके कारण धारावी का जो ये क्षेत्र है, इसको हम लोग स्लम फ्री कर पाएंगे। और मैं ये भी बताना चाहता हूं कि ये पहला प्रोजेक्ट ऐसा है कि जिस प्रोजेक्ट में हम लोगों ने तय किया जो इनएलिजिबल है उसको भी हम छोड़ेंगे नहीं तो दूसरी जगह जाकर झोपड़ा बनाएगा। तो हमने जो एलिजिबल है उनको हम फ्री घर दे रहे हैं, और जो इनएलिजिबल है उसको हम लोग रेंटल हाउसिंग दे रहे हैं। और रेंटल हाउसिंग में 12 साल रहकर रेंट पे कर फिर वो कुछ पैसे भरकर अपने घर का मालिक बन सकता है। इस प्रकार की योजना उसके लिए लाई है। तो मुझे लगता है कि अब धीरे धीरे लोगों के मन में भी उसके प्रति एक बहुत कॉन्फिडेंस तैयार हुआ है। आपने देखा होगा अभी पिछले 15 दिन पहले धारावी के लोगों ने धारावी प्रोजेक्ट के सपोर्ट में एक मोर्चा निकाला। ऐसा बहुत कम होता है, लेकिन एक बड़ा मोर्चा था और लोग कह रहे थे कि धारावी प्रोजेक्ट हमको करना है और इसको आप फास्ट कीजिए। तो मुझे लगता है कि एक बड़ी पॉजिटिव डेवलपमेंट ये है और धारावी को हम पूरा करके दिखाएंगे।
देवेंद्र जी, कुछ प्रोजेक्ट्स में अड़चने आई हैं लैंड एक्विजिशन को लेकर, जैसे कि आरामको प्रोजेक्ट में। तो आने वाले जो इन्वेस्टमेंट्स होंगे तो लैंड एक्विजिशन के इश्यूज को आप किस तरह से आपकी अप्रोच क्या रहेगी?
देखिए, मैं ऐसा मानता हूं कि ये जो हमारा रिफाइनरी का प्रोजेक्ट था उसमें हम लोगों ने हमारे स्टेट का बहुत बड़ा लॉस किया, क्योंकि जो जगह हमने तय की थी जिसमें लोग तैयार थे, लेकिन उस समय के हमारे पार्टनर उद्धव ठाकरे जी, इन्होंने उसको प्रेस्टीज इशू बनाया और उन्होंने कहा कि किसी भी हालत में हम यहाँ बनाने नहीं देंगे। और उसके बाद वो चीफ मिनिस्टर बने और शायद हम लोग वहाँ नहीं बना पाए। अब हमने नई जगह देखी, उसके भी कुछ अड़चने हमको आ रही है, लेकिन उसको हम दूर करने की कोशिश कर रहे हैं। पर मैं ऐसा मानता हूं कि ये प्रोजेक्ट एक ऐसा प्रोजेक्ट था जो महाराष्ट्र की इकोनॉमी को अगले 20 साल तक एक प्रकार से, और देश की अर्थव्यवस्था को भी बदलने की उस प्रोजेक्ट में एक क्षमता थी। अभी मैं केंद्रीय मंत्री महोदय से मिलने गया था और हम लोगों ने उनको ये कहा है कि अब इस प्रोजेक्ट को हम फास्ट ट्रैक पर लाए। वहां पर ये भी विचार चल रहा है कि 60 मिलियन टन की कभी हम लोगों ने कैपेसिटी तैयार नहीं की है, तो इसको 2020 की 3 में करे, इस प्रकार का भी विचार चल रहा है। लेकिन महाराष्ट्र में हम इसको करेंगे।
किरण जी, एक तरफ बात हो रही है 1 ट्रिलियन इकोनॉमी की, एक डबल साइज करने की, दूसरी तरफ महाराष्ट्र में एग्रेरियन डिस्ट्रेस है फार्मर्स को लेकर, मराठवाड़ा और विदर्भा में, और स्पेशली सोयाबीन और कॉटन फार्मर्स का। तो ये जो इश्यूज हैं, इसको आप किस तरह से इनको टैकल कर रहे हैं?
देखिए, जहां तक सोयाबीन फार्मर्स की और कॉटन फार्मर्स की बात है, तो हम लोग कॉटन और सोयाबीन को एमएसपी पर खरीदते हैं और इस साल हम लोगों ने रिकॉर्ड किया है। जितनी खरीद इस साल हमने की है, मतलब अगर हमारे देश के मध्य प्रदेश, उसके बाद गुजरात, हरियाणा, ऐसे 6 राज्य जो सोयाबीन में काफी अच्छा काम करते हैं, ये 6 राज्यों की टोटल खरीद जितनी है उससे 124% ज्यादा खरीद अकेले महाराष्ट्र ने की है। तो बहुत बड़े पैमाने पर हमने सोयाबीन की खरीद की है, कॉटन की भी खरीद की है। अभी सवाल ये उठता है कि महाराष्ट्र का जो इलाका ड्राउट प्रोन है, क्योंकि 52% महाराष्ट्र ये ड्राउट प्रोन महाराष्ट्र है, 48% ही ब्लेस्ड है। तो हम लोगों ने अभी इसको ड्राउट फ्री करने का एक प्लान तैयार किया है, जहां एक और हम लोग वाटर कंजर्वेशन के माध्यम से, स्मॉल स्ट्रक्चर्स के माध्यम से हम लोग इसको तैयार कर रहे हैं। वहीं हम लोगों ने बहुत एम्बिशियस ऐसे रिवर लिंकिंग प्रोजेक्ट्स तैयार किए हैं, जिसमें एक वैनगंगा नलगंगा प्रोजेक्ट है। इस प्रोजेक्ट में 450 किलोमीटर की नई नदी हम तैयार कर रहे हैं, और इसके कारण जो विदर्भ के 7 डिस्ट्रिक्ट है, ये डिस्ट्रिक्ट टोटली डाउट फ्री होंगे। इस नदी पर 31 डैम्स हम लोग तैयार करेंगे, 2 डैम्स को हम उसकी हाइट तैयार करेंगे, बढ़ाएंगे। और इस
कब तक तैयार होंगे?
इसकी शुरुआत हम लोग अगले साल करेंगे, 7 साल उसके बाद उसको लगेंगे। लेकिन इसके कारण ये ड्राउट अफेक्टेड एरिया में 10 लाख एकड़ जमीन ये सिंचित होगी, इरिगेटेड होगी, साथ में इंडस्ट्री के लिए पानी होगा, पीने का पानी होगा। सेम वे हम लोगों ने दूसरा एक योजना तैयार की है कि महाराष्ट्र जो है, इसमें 49% ये गोदावरी का बेसिन आता है, और गोदावरी का बेसिन ये डेफिसिट बेसिन है। और हमारे यहाँ वेस्टर्न घाट के कारण वेस्ट फ्लोइंग रिवर्स है, जो रिवर का पानी सीधा समुद्र में बहकर चला जाता है, जिसका उपयोग हमको नहीं होता। अभी हमने वहां एक नदी जोड़ का एक कार्यक्रम हाथ में लिया है, जिसमें 54 टीएमसी पानी, ये जो वेस्ट फ्लोइंग रिवर्स का, ये लाकर हम लोग गोदावरी का जो हमारा बेसिन है उसमें ला रहे हैं। इसके कारण नॉर्दर्न महाराष्ट्र और मराठवाड़ा, ये जो एरिया ये टोटली ड्राउट फ्री होगा, और इसके कारण पूरे महाराष्ट्र को हम एक प्रकार से ड्राउट मुक्त कर पाएंगे। तो ये बहुत एम्बिशियस प्रोजेक्ट है, करीब 2 लाख करोड़ के प्रोजेक्ट है, लेकिन इसकी शुरुआत हमने की है और हम इसको पूरा करेंगे।
देवेंद्र जी, आप मुख्यमंत्री होने के साथ साथ गार्डियन मिनिस्टर भी हैं गढ़चिरौली के, तो आपका गढ़चिरौली को लेकर ग्रोथ प्लान्स क्या है, स्पेशली क्योंकि वहाँ माओवादी चैलेंज भी काफी है?
देखिए, गढ़चिरौली को माओवाद के लिए जाना जाता था, और गढ़चिरौली का जिक्र जब होता था तो लोग माओवाद की बात करते थे। हमारे यहाँ पर तो हमारे प्रशासन में किसी को सजा देनी है तो इसको गढ़चिरौली भेजो बोलते थे, इस प्रकार की गढ़चिरौली की स्थिति थी। बट नाउ गढ़चिरौली इज बिकमिंग द न्यू स्टील सिटी ऑफ इंडिया। अब वहां पर जिस प्रकार से स्टील में निवेश आ रहा है, जिस समय मैं पिछले मेरे रेजिम में मैं चीफ मिनिस्टर के साथ साथ गृह मंत्री भी था, उस समय मैंने प्रयास किया, वहां पर पुलिस का संरक्षण दिया और माइनिंग की एक्टिविटी शुरू की। जब शुरू हुई तो माओवादियों ने भी विरोध किया, लोगों ने भी विरोध किया, लेकिन हम लोगों ने शांति के साथ लेकिन पूरी दृढ़ता के साथ माइनिंग को शुरू किया। धीरे धीरे लोकल कम्युनिटीज को उसका फायदा ध्यान में आया। परिणाम ऐसा हुआ कि आज हम लोग देख सकते हैं कि ऑलरेडी वहां पर और हमने ये कहा कि क्योंकि मैं बताना चाहता हूं कि जो आयरन ओर गढ़चिरौली में है हमारे देश का सबसे अच्छा है। द बेस्ट आयरन ओर इज इन गढ़चिरौली, ऐसा और ही कहीं नहीं है। और इसकी माइनिंग शुरू होने के बाद मैंने ये कहा कि इसको केवल एक कॉलोनी की तरह उपयोग मत लाइए, यहाँ पर एक पूरी स्टील की इकोसिस्टम तैयार होनी चाहिए। और उस समय हमने एक जगह वहां पर स्टील इंडस्ट्री के लिए दी। अभी अभी मैंने पिछले महीने उसका उद्घाटन किया और 25 मिलियन टन का एक और प्लांट अभी लॉयड के माध्यम से वहां लग रहा है। अभी अभी हम डावोस में थे तो हमने 25 मिलियन टन के प्लांट के लिए हम लोगों ने 30 मिलियन के, जो शायद देश का सबसे बड़ा प्लांट होगा, उसके लिए हमने JSW के साथ एक MOU किया है और वो भी वहां पर करीब 1.5 लाख करोड़ का निवेश कर रहे हैं। और ऐसे कई एक और हम लोगों ने वहां पर बड़ा प्लांट, उसका भी हम लोगों ने भूमि पूजन किया है। तो एक प्रकार से पूरी इकोसिस्टम ये वहां पर तैयार हो रही है और आने वाले दिनों में देश की सबसे बड़ी स्टील कैपेसिटी ये गढ़चिरौली में हमको देखने को मिलेगी। तो अभी तक जिस गढ़चिरौली को हम लोग माओवादियों के लिए जानते थे, अब वो स्टील सिटी एंड स्टील हब ऑफ इंडिया हो रहा है। हम गढ़चिरौली में एक नया एयरपोर्ट भी तैयार कर रहे हैं। हमने गढ़चिरौली को समृद्धि महामार्ग से एक एक्सेस कंट्रोल हाईवे से जोड़ने का काम शुरू कर दिया है। इसके साथ साथ ये जो माइनिंग है इसका एक कॉरिडोर तैयार करके सारा और कैसे ट्रांसपोर्ट हो सके इसका हम प्रयास कर रहे हैं। और इतना ही नहीं तो गढ़चिरौली से लेकर तो जालना, जो कि जालना में एक हमारे यहाँ पर एक बड़ा एक इकोसिस्टम है, और इतना ही नहीं तो कोकण तक हम लोग इस ओर को ले जाने के लिए एक कंप्लीट डेडिकेटेड पाइपलाइन का भी निर्माण कर रहे हैं। तो मुझे ऐसा लगता है कि बहुत बड़े पैमाने पर ये बदलाव आज गढ़चिरौली में हम देख रहे हैं और इसका परिणाम ऐसा है कि धीरे धीरे नॉर्थ गढ़चिरौली से नक्सलवाद माओवाद खत्म हो गया। साउथ गढ़चिरौली में मात्र 2 तालुकों में वो बचा है, लेकिन वो भी अगले 1 साल में हम खत्म कर देंगे।
जी अब थोड़ी राजनीति की बात करें तो कई अटकलें हैं कि शिवसेना और आप में मतभेद चल रहा है, क्या मतभेद?
कोई मतभेद नहीं है। हमारे मीडिया को जब कोई खबर नहीं मिलती तो वो खबर बना देते हैं। ये मैन्युफैक्चर्ड खबरें हैं। हम तीनों लोग एक साथ मिलकर राज्य को चला रहे हैं और अच्छा काम कर रहे हैं। और कई बार तो मुझे बड़ा आश्चर्य होता है जब मुझे मीडिया में देखने को मिलता है कि देवेंद्र फडणवीस इन्होंने एकनाथ शिंदे के काम पर स्टे दे दिया। मैंने आज हमारे हाउस में भी बताया कि भाई स्टे देने के लिए मैं उद्धव ठाकरे नहीं हूं, मैं तो काम करने वाला आदमी हूं। इसलिए ये सारी खबरें जो है ये खबरें थोड़ी मैन्युफैक्चर्ड है, थोड़ी एक प्रकार से कलर्ड है और थोड़ी मोटिवेटेड भी है। मैं आपको बताना चाहता हूँ कोई प्रॉब्लम नहीं, मस्त चल रहा है, बढ़िया चल रहा है, अच्छा चल रहा है।
शिंदे जी रुष्ट नहीं है आपसे?
एकदम नहीं। देखिए प्रॉब्लम क्या है, मैंने कई लोगों को ये बताया कि अभी शिंदे जी का एक अपना व्यक्तिमत्व है। उनके व्यक्तित्व में आप देखिए वो धीर गंभीर रहते, मैं हंसते हुए रहता हूँ, वो धीर गंभीर रहते, गंभीरता उनके चेहरे पर है। अब जब तो मुख्यमंत्री थे तब भी गंभीर होते थे, तब किसी ने कहा कि शिंदे जी हंसते क्यों नहीं, ये गंभीर क्यों है। अब मुख्यमंत्री नहीं है तो उनका चेहरा दिखाते, देखिए शिंदे जी हंसी नहीं रहे, ये शिंदे जी नाराजी है। अरे भाई कोई आदमी अगर चेहरा ही उनका अगर गंभीर है तो हंसते हुए कैसे दिखेगा। अब मेरे चेहरे पे गंभीरता कम रहती है तो लोग ये कह सकते हैं कि गंभीर ही नहीं, आदमी ठीक नहीं है। तो ऐसा नहीं होता है, प्रत्येक हर एक व्यक्ति का अपना व्यक्तित्व होता है, उस हिसाब से उनका भी व्यक्तित्व है, कोई प्रॉब्लम नहीं, हम साथ में है।
आपके आजकल ऑपोजिशन से रिश्ते कैसे हैं ठाकरे जी के साथ, पवार साहब के साथ?
देखिए रिश्ते तो कभी बहुत खराब नहीं थे। हाँ ये बात जरूर है कि बीच में महाराष्ट्र की राजनीति में एक ऐसा मकाम आया था जिस समय एक प्रकार से पॉलिटिकल विरोधी की जगह दुश्मनी इस प्रकार की व्यवस्था खड़ी हो रही थी। हम लोगों को भी टारगेट किया गया, लेकिन मैंने चुनकर आने के बाद पहली ही सभा में या पहले भाषण में ये कहा कि मैं बदले के लिए नहीं, बदलाव के लिए आया हूं। इसलिए मैं बदला नहीं लेना चाहता, मैं बदलाव करना चाहता हूं, मैं संवाद करना चाहता हूं। मेरा फोकस ये एक प्रकार से डेवलपमेंट है। तो मैं ऐसा मानता हूं कि एक प्रकार से जो एक रिलेशनशिप ठीक होनी चाहिए, ऐसी रिलेशनशिप है। फॉर्चुनेटली महाराष्ट्र में हम लोग आज भी एक दूसरे से बात कर सकते हैं। हमारे में इतनी दूरियां नहीं है कि हम बातचीत ही नहीं कर सकते। हाँ, ये बात अलग है कि सही समय उन्होंने मेरा फोन उठाया होता तो अलग बात होती, लेकिन उद्धव जी ने फोन ही नहीं उठाया, तो ये सारी चीजें यहाँ पर हो गई। बट अभी वो भी मेरा उठाते हैं, मैं भी उनका उठाता हूँ।
तो अब दोनों एक दूसरे के फोन उठा रहे हैं, तो फिर से साठगांठ हो सकती है?
देखिए, फोन पे हम लोग साठगांठ की बात नहीं करते। अभी 60 नहीं और गांठ नहीं, ये आप गांठ बांध लीजिए कि कोई साठगांठ नहीं है।
तो आप कह रहे हैं कि कभी एनसीपी के साथ आपका फिर से अरेंजमेंट नहीं होगा?
देखिए, मुझे ऐसा दिखाई नहीं पड़ता। मैं आजकल बड़ा बच के बात करता हूं, क्योंकि पॉलिटिक्स में नेवर से नेवर होता है, कब क्या हो जाए। और पिछले 5 सालों ने तो हमको ये सिखा दिया कि पॉलिटिक्स में कोई भी किसी के साथ कभी भी जा सकता है। इसलिए बड़ा बच के बात करता हूं। लेकिन जो पॉलिटिकल सिनारियो मुझे दिखाई पड़ता है, जो हमारी दिशा दिखाई पड़ती है, उसमें अब शरद पवार जी के साथ या उद्धव जी के साथ हमारा कोई गठबंधन हो सकता है, ऐसी परिस्थिति नहीं है।
अभी जो बीएमसी के चुनाव जो आने वाले हैं, तो उसमें कहा जा रहा है कि शायद भाजपा अकेले उम्मीदवार खड़े करेगी। ऐसा है क्या कि महायुति कायम रहेगी?
100% महायुति ही बीएमसी का चुनाव लड़ेगी, भाजपा अलग नहीं लड़ेगी। और मुंबई में महायुति का मेयर हम लोग बैठाएंगे।
आखिरी सवाल, आपने कहा कि अब फोन उठाए जा रहे हैं एक दूसरे के, तो अभी विधानसभा का सत्र चल रहा है, लीडर ऑफ ऑपोजिशन नहीं है, क्योंकि उनके पास दोनों पार्टी, सारी ऑपोजिशन पार्टियों में इतने नंबर नहीं है लीडर ऑफ ऑपोजिशन बने। विल यू अलाउ अ लीडर ऑफ ऑपोजिशन इवन दो दे डोंट हैव द नंबर्स?
सी, इट इज नॉट अबाउट मी अलाउइंग, क्योंकि लीडर ऑफ अपोजिशन किसको देना है, उसके क्या नियम है, ये अपॉइंट करने का अधिकार गवर्नमेंट का नहीं है, स्पीकर का है। इट इज अ सोल प्रेरोगेटिव ऑफ द स्पीकर। स्पीकर के पास उनकी अर्जी गई है। स्पीकर साहब हमारे लॉयर है, एक बहुत ही सूझबूझ के साथ काम करने वाले स्पीकर है। उनको कॉन्स्टिट्यूशन और हमारे नियम, इनके 100% जानकारी है। इन सारी चीजों को खंगालेंगे और एक उचित निर्णय जो भी इन द इंटरेस्ट ऑफ डेमोक्रेसी होगा वो स्पीकर साहब लेंगे। तो स्पीकर साहब का निर्णय क्या होगा ये मेरे लिए बताना कठिन है।
आपकी राय पूछी तो आपको आपत्ति होगी?
देखिए, स्पीकर अगर निर्णय लेते तो हमको क्या आपत्ति होगी? देखिए, मैं आपको एक बात बोलता हूं, मैंने पहले दिन कहा है कि आई विल नॉट जज द अपोजिशन बाय इट्स नंबर्स। हालांकि अभी महाराष्ट्र के इतिहास में सबसे कम नंबर अपोजिशन को इस बार मिला है। और आज भी आप देखिए, लीडर ऑफ अपोजिशन नहीं है, लेकिन हम उनको या उनके लीडर्स को लीडर ऑफ अपोजिशन की तरह ही ट्रीट करते हैं। कोई भी हमारे में बदलाव नहीं आया है, क्योंकि डेमोक्रेसी में रूलिंग पार्टी जितनी महत्व की है उतनी अपोजिशन पार्टी भी महत्व की है। हाँ, ये बात जरूर है कि देश की संसद को देखने के बाद ये भी लगता है कि अपोजिशन पार्टी का लीडर ये सेंसिबल भी होना चाहिए, देश का विचार करने वाला भी होना चाहिए।
And on that note, ladies and gentlemen, please give a big hand to Devendra Fadnavis, the Chief Minister of Maharashtra. Thank you so much for being so sporting, sir, and taking all the questions.
All right. Big thank you to the Chief Minister, Nalin, as well. And with that, ladies and gentlemen, we draw this incredible day to a close. Let us begin also our closing speech thereby extending our heartfelt gratitude to Devendra Fadnavis, Chief Minister Maharashtra, and for sharing his inspiring notes over there. A big thank you to Nalin as well. We would like to express our sincere thanks to all the distinguished speakers whose thought-provoking ideas have truly made Moneycontrol's Global Wealth Summit 2025 an unforgettable experience. A big thank you to our partners without whom this event would not have been possible. Presented by IDFC First Bank, co-powered by PhonePe and associate partners World Gold Council, SBI Mutual Fund and Reliance Industry. We now invite you all to join us for dinner and some chit-chat. Good night.